welcome. On behalf of Traders Corner, I'm Anthony Chapman, and I'd like to thank all of you for joining us for today's Investor Summit Stock and Options Special event. We are in a very unique market environment right now. Volatility remains elevated. Institutional money continues rotating aggressively across sectors, and traders are seeing tremendous opportunities develop across stocks and options. At the same time, we're seeing growing speculation surrounding future Federal Reserve policy changes, shifting market leadership, and increasing momentum in areas like AI, technology, and short-term options trading. For prepared traders, this environment can be extremely opportunity-rich. That's why today's event is so exciting. We've assembled an incredibly talented panel of professional traders and market experts who will be sharing the strategies, setups, indicators, and market insights they're using right now in today's markets. Throughout the event, I'll also be placing each presenter's promotional link in the chat box following their presentation. So let's get started. Our first presenter today is Chris Sayre of Big Trends. Chris has decades of experience in the financial services industry and specializes in systematic options trading and strategies designed for active traders. Today, he'll be presenting how to trade 0DTE options on QQQ. And this strategy has been hitting 6 times its target. So in this session, Chris will show how traders are using opening range breakouts and VWAP to identify high probability intraday opportunities on QQQ using short-dated options and structured profit-taking approaches. So everyone, please welcome Chris Sayre of Big Trends.
Anthony, thank you so much. Thank you to you, Marie, and your team there at Traders Corner and allowing us to present today at the Investor Summit. Glad to be here. As Anthony was saying, ladies and gentlemen, we're going to talk about how to trade the Qs as they are known in the trading world. And as you can see there, that's QQQ. If you're not familiar with that, it tracks the NASDAQ 100. It is one of the most highly traded securities day in and day out. If you don't trade it or not watching it, I would encourage you to at least put it on your watch list to keep an eye on it because it does move. Now, before I go any further, I got to read this disclaimer to you, so please bear with me while I do this. The information provided in this presentation is based on our proprietary research and is intended for illustrative purposes only and are not to be construed as specific advisory recommendations. Stocks and options trading have large potential rewards, but also large potential risks. The past performance of any trading system or methodology is not necessarily indicative of future results. See our terms of use on the bigtrends.com homepage for more information. So a little quick history for you. As Anthony was telling you, I work at Big Trends. Big Trends was started by Price Headley in November of 1999. So that means we're over 26 years old. I was actually a client of Price's shortly after he started Big Trends. As you can see, I have a background in the financial services industry, and I've been a part of Price's team now for almost 15 years here on the front lines, interacting with traders just like you. As Anthony was saying, I have decades of experience. Makes me feel old when I hear that, but I am 57 years old, been trading and investing since I was 18. Started with some money that my grandmother Sayre gave to me, took me down to the brokerage firm, and it's been on ever since. If you have any questions, please throw those into the chat box. If there's something on your mind after today's presentation, you see our contact information there at the bottom. We're here Monday through Friday, 9 a.m. until 5:30 p.m. Eastern time. Markets closed, we're closed. And now, and as Anthony told you, as you saw in the opening slide, we're going to be talking about 0DTE options. More about what that mouthful means here in just a second. But our trading system, we call them alert services here at Big Trends, as you can see there in yellow, simply called 0DTE options trader, because that's what we're doing. We're options on the Qs, QQQ, same day. Okay, so how to trade same day options on the Qs using our tactics from our 26 years of experience. Success stories and chart examples so you can see what these trades look like. Given my decades of experience interacting with folks, I just believe that most people are visual learners and they learn through repetition. So that's why you're going to see numerous case studies today. And of course, I'm going to share some of the strategy with you and have a special offer for you at the end of the presentation. So as I was saying, 0 days to expiration. As you can see, this is from Investopedia. What are 0 days to expiration options? 0 days to expiration options are unique contracts that must be acted upon the same day they are traded. That's right. We're in and out the same day. So as it says there in the definition, that creates a narrow window for action. Traders use these options for rapid gains. That's what we're looking for. As Anthony told you, and as you saw on that opening slide, we're targeting 6 times our money on these trades. We're not doing any premium collection. This is not a credit spread service, but the need for fast decision making, we assist with that, of course, and the importance of expertise to mitigate risk, we help with that as well, because we give you stops and targets for every trade. So let's kick off today's event with a recent winning trade example. Then I'll explain more about how zero DTE options works. So on these case studies that you're going to see today, there's some things I'd like to point out. First, down here in the bottom right, every trade is going to be based off allocating up to but no more than $1,000 a trade. But hear me when I say this. You don't have to be a $1,000 trader to be a subscriber to our zero DTE options trader. Why do I say that? Because the average recommended contract price going all the way back to 2023 has been less than $1 a contract. So if you're newer to options, there's 100 shares represented in each options contract. So for instance, if the contract is $1, it's $100 to buy one contract. So you can do this strategy for as little as $100 to $200. Now, what you're going to notice also are red and green bars or candles, if you will. Each one of those represents 5 minutes of trading action. Let me repeat that. Each bar, each candle represents 5 minutes of trading action. Now, this green line here is the VWAP, and that stands for volume weighted average price. And this black line here is an SMA. Now, I'm not going to give you the exact settings for those. As you can imagine, those are proprietary. But when you subscribe today, you will get access to those. Then you're going to notice at the bottom, volume and an average, okay? Then you notice this green line here and this red line here. This is a 15-minute range, okay? This is a 15-minute range. And what we're looking for is a break below that 15-minute range to trade puts. Now, we can trade calls as well, have examples of those. And you can see this contract was recommended at 88 cents a contract. So circling back, if you're trading up to 1,000, it would have been 11 contracts. Now, what we're going to do on this trade is we're going to sell at least 2/3 of the position when it gets to 50%. That allows you to get all of your original trading capital back. And if you have to round up so it's more than 2/3, you get a little bit of your original capital back. But what this does for you is now your trade becomes risk-free. Okay? So the remaining 3 contracts are risk-free. So we sold those 8 of the 11 there at that green rectangle as we got the move in our favor. And then you can see down here with this green rectangle, we sold the remaining 3 contracts, ladies and gentlemen, for 500%, which is 6 times your money. 528. Now, if you'd allocated up to 1,000 on that trade, you'd have made $1,672 same day. And remember, each one of those candles, red or green, represents 5 minutes. So you weren't in this trade very long. You're also going to notice on these charts, past performance doesn't guarantee future results. We got to have it on there. I got to say it. So there you go. You know it. So what is zero DTE options trader and why should you care? Well, let's go over some of the strategy guidelines. As I've taught you already, you're in these trades one day, okay? Less than a trading day. What type of strategy? Opening range breakouts or breakdowns, if you will, as you saw in that first case study. Filter it with VWAP. Again, that stands for volume weighted average price and volume. What options do we trade? Zero DTE. It means same day, right? And we're trading out of the money. That's what OTM means. Out of the money options expiring on the same day as the entry. Pretty simple. If you like action, you want in and out, you don't want any overnight risk, zero DTE options trader is for you. Now, as I showed you on that first case study, we are using a 5-minute chart. The 5-minute time frame allows us to identify the opening range, as I pointed out, for the first 15 minutes of the session. The 5-minute chart also catches breakouts quickly because we only need one bar to close outside of the range, as you saw on that first case study. Now, here you go. Trades are issued between 9:50 a.m. Eastern Time and 10:05 a.m. Eastern Time, which means you only need 15 minutes per day to catch these entry signals. So, folks, this is when you need to be available. If you cannot be available in that window, then subscribing to Zero DTE Options Trader is not for you. Intraday breakout patterns have resulted in ample trade frequency and large profits, as you saw on that first case study. How we're maximizing leverage and stability. Again, same day expiration options have allowed for large winners without overpaying for premium. Remember, average contract price less than $1, right? Out of the money options can be seen as aggressive, but we use a 50% stop to mitigate that risk. There is another key piece to the trading system for you already here in the first 10 minutes of the presentation. So 50% stops and contracts less than $1 going all the way back to 2023. So 50% stop. And as I taught you on that first case study, we're using a 50% target on at least 2/3 of the position. Why? Because it will turn the trade into a risk-free trade at that point. Okay. And as you saw, first case study and a 500% final target on the final third of the position. It's that simple. Trade calls or puts on the queues, be available in the first half hour of the trading day. We'll give you the stop. We'll give you the target. We'll help you navigate the trade. Now, here's a look at the overall performance. This strategy was started in January of 2023. And as of this morning, if you'd allocated up to $1,000 to every trade, all wins, all losses, total it up, $25,531 if you'd started with a $5,000 account. No commission, no subscription fee. But what I want to point out, tucked in over here at the left, 510% growth in that portfolio, trading just the Qs. 510% and no overnight risk because we're in and out same day. Now, past performance doesn't guarantee future results, but here's the results seen a different way. 5,000 has grown to $30,531. Again, 510% in those parameters. Now, we look for a specific setup. How do we do it? We identify the high to low range for the first 15 minutes for the Qs. Okay, QQQ. You're going to hear me call them the Qs. We then look for a 5-minute candle to close outside that range. When a breakout occurs, we confirm that momentum with VWAP, volume weighted average price, and our unique BTVC indicator, which stands for big trends volume confirmation. We only take breakout trades between, remember, essential for you to be a subscriber, 9:50 a.m. until 10:05 a.m. Eastern Time. If the breakout doesn't happen quickly, then there's no trade for that day, and you can go on about your day. The exact settings, as I told you earlier, are proprietary, but they are revealed to subscribers, okay? We give you the exact settings for everything that Price Headley, our founder and CEO, and his team of analysts use to find these trades. Now, here's some trade examples from a variety of market environments, starting with October of 2025. Now, what you're going to notice, this is a call trade, okay? We got in over here with the breakout. We're above the VWAP and we're above the moving average, okay? This is an SMA if you just joined me. And this green line is the VWAP. That should be a W, VWAP, okay? VWAP. We're above both of those. We get the breakout right here. We're selling 14 of the 20 contracts. Why so many contracts? Because it was only 48 cents. So as I taught you earlier, if you only want to trade at one contract, you're looking at 48 bucks. Now the idea is to trade multiple contracts. So you sell 14 of the 20 at 50%. Now you have your what? Risk-free trade. And the remaining 6 are closed out up here later that day because we're not going to hold right into the bell. We made 306 and a quarter on that. That trade made $1,218 gross profit. So why do we require confirmation from multiple indicators? Anthony and I were talking about the Kentucky Derby before we came on the air. Based in Lexington, Kentucky, the Derby's raced or run just up the street in Louisville, Kentucky. We believe we're in horse country here in Lexington, Kentucky. So horse trainer, horse jockey, and the morning line set by the odds maker. We believe one voice is noise, three voices are an edge. So if you get all of that coming together, you've got an edge. As it says down here at the bottom, one tip is a hunch, three tips from three independent witnesses. Now you've got an edge. So that's why we use multiple indicators for confirmation. If you're out there just trading with a single indicator, I'd be willing to bet that you're getting whipped back and forth on a lot of trades. Now, as you saw in the previous example, not every winner will hit its final target of 500%. Some are time stopped at 330. So that last trade that I just showed you, that last piece was closed out at 3:30 Eastern time. Here's another example. Back to the call side, $1.15 a contract. We've got our VWAP, we got our SMA. As you can see, the entry is above both of those. We got our breakout on volume down here. We enter, we close. 6 of the 8 contracts there for 50.43%. Now we have our risk-free trade, and then we close the remaining piece at 3:30 for 95.65%. Trade generated $568 gross profit. Remember, all trades today are based off a $1,000 allocation before any commission or subscription investment. As I taught you earlier, you can trade less. You can also trade more because we are trading one of the most highly liquid tradable securities out there. But please always trade with what fits in your financial situation. Now, I showed you historical performance information earlier, right? Up 510%. I told you those numbers factor in all wins and all losses. So let's talk about a losing trade. Why? Because they're going to happen. You need to manage your portfolio accordingly. If you subscribe today, don't go jamming half or all of your account into your very first trade, hoping to hit a 500% winner. It's not prudent. It's not wise, but you do need to trade with what's best for your financial situation. So here's a trade. We got the breakout that we like right there. We got the volume move that we like. We're above the VWAP. We're above the SMA. And it just pulled back and hit our 50% stop, 51.52% to be exact, okay? Now, the beauty of this strategy is that these are same-day trades, in and out, same day. No waiting around, no expensive options contracts, and here's what seems to be everybody's appeal. No overnight risk, no tweets, no bombs, no anything, right? You don't have to worry about any of that stuff. What's happening overnight? You're in and out, same day. Calls, 14 contracts entered, 67 cents a contract. 10 contracts are sold here when we're up 50%. Again, now we have our risk-free trade, and it takes off, and we make 131.34%. Again, it was closed out at 3:30. Trade made $692. Gross profit before any commission or subscription investment. Clearly see we got the breakout of the range. We're above the VWAP, we're above the SMA, and we're above the big trends volume indicator as well. Now, sometimes we hit the first target of 50% and the remaining will be closed at a loss. The system is designed for that to be as I told you and have taught you thus far, a risk-free scenario. So what does that look like? Well, let's talk about it. 11 of 16 contracts entered and sold, okay? 16 entered here. We're above the VWAP. We're above the SMA. We're above the volume indicator here, right? We got everything that we like. We close 11 of the 16 up there with the green rectangle. Now we have our risk-free trade. So we let it run. The remaining 5 contracts were worth nothing when 3:30 came around, okay? It's going to happen, but you didn't lose on that trade. You actually made $31. $31 gross profit, okay? Now, the trades we just looked at were bullish call signals, but this strategy also trades puts like that very first trade that I shared with you. We get in over here on this put 79 cents a contract. Now we're below the VWAP. We're below the SMA. This is an SMA. If you just joined me, this is V. Let's get a W this time. WAP, volume weighted average price. Need to be below both of those. This is the big trends volume confirmation down here. We get that. We're selling 8 of the 12 contracts there at the green rectangle at 50.63%, because remember, we're going to sell at least 2/3 of the position when we're up 50%. Okay, at least 2/3 of the position when we're up 30%. Now, this is what we're looking for, 500%. That's what we're looking for on the remaining piece of these trades. And it did it there on that green rectangle. This trade made $1,900. Same day, if you'd allocated up to $1,000 to that trade before any commission or subscription investment. Here's another one, 34 cents a contract. Okay, 29 contracts entered here. Below the VWAP, below the SMA, get the big trends volume confirmation. Selling 20 of the 29 there, 50% risk-free trade. And what happens? Another 500% winner. 9 contracts sold here at that green rectangle. That trade made $1,870 gross profit. How about this one? 5 of 7, 50% risk-free now. You see the move up here below the range, below the VWAP, below the SMA. Got the volume confirmation, selling 5 of the 7 there. And then the 2 remaining contracts sold here for 500%. That trade made $1,675. And if you just joined me and you missed it, what time frame are we trading? This is a 5-minute chart. Each one of those bars, each one of those candles represents 5 minutes. So think about how short of time frame that move was. When you're trading same day options and they're out of the money, you can make money like this in very quick fashion. Now, past performance doesn't guarantee future results, but results like these have occurred. Here's another one. $1.22 a contract, 6 of 8 contracts sold, 50%. Risk-free trade. Got in up here. We got our breakout. We're below the VWAP. We're below the SMA. We got our big trends volume confirmation. We're selling right here at the first piece. And then the remaining 2 contracts sold all the way over here for 500%. Remember, that is the end goal. That's why we let these trades run. This trade made $1,586 gross profit. Now, here are a few more call trades that were closed recently. Let's go back to the call side. So what are we looking for now? We're looking for breakouts above. We're looking above the SMA, above the VWAP, still getting the volume confirmation. So we enter 8 contracts. We're selling 6 here. We have our risk-free trade now. 2 of the remaining contracts sold at 224.56%, all the way over here. Trade made $854 gross profit. Are any of you trading like this currently? I won't call you out by your full name. I would love to know if anyone out there scales in or gets in and scales out. Would love to know. Again, it's one of the joys of my job here at Big Trends for the last 14 plus years is getting to know how traders trade, because that's the beauty of the markets. There's so many different ways to do this stuff. But if you don't have a system, if you don't know you have an edge, then to me, you're just bouncing around like a ball in a pinball machine, maybe, just bouncing around. Don't bounce around. Have a plan. Have a trading system. That's what we bring to you today. Now, we get the breakout of the upper range. We enter 14 contracts here. We're above the VWAP, above the SMA, and down at the bottom, we have the big trends volume confirmation. We get in, we get out just a few bars later for our risk-free trade to be on right now. And then all the way over here until 3:30, we do 262.69%. That trade made $1,044. Remember, we will close these trades down at 3:30 p.m. Eastern time, okay? Now, you may say, Chris, these options trade until 4:15 Eastern time. That is correct. If you did not know that, yes, the bell rings at 4 o'clock for the main market, if you will, but options on the queues trade until 4:15. We're not going to play that game in the last 45 minutes. Our research says 3:30 is the optimal time to get out. Now, you may say, well, look at that. It continued to move afterwards. That's fine. I can show you examples where it turned against us after we got out as well. Again, you're not going to be perfect every time. If you're looking for perfection, you're going to drive yourself crazy. Enter 13 contracts, 76 cents a contract this week. Look at that. May 26, 2 days ago. Got in 13 contracts, 76 cents. VWAP, VWAP, right? Here, SMA, we're above both of those. And then down here, you got your big trends, volume confirmation, okay? Everything set up, 76 cents a contract. 9 of 13 sold at 50%. We have our risk-free trade. And then we lost 28.95% when we closed it down at what? 3:30 p.m. Eastern time. But the trade still made money. $254 gross profit. And you may say, well, Chris, that's not a lot. It's not, but it may fill up the SUV or take you and a significant other out for a decent meal. Not every trade's going to print 500% winners, just like not every trade's going to be a 50% loss. You got to manage and navigate the trades consistently. Now, Traders Corner special offer. Again, thank you to Anthony and Marie and their team for inviting us, Big Trends, to today's Investor Summit. Now, I'm going to show you how you can get real-time trade alerts when this strategy triggers a new signal. Now, the trades are only available to the first 34 traders, and I can tell you there's more than 34 of you in the room. So, again, the name of the alert service, as we call them here at Big Trends, is Zero DTE Options Trader. 12 months of trade alerts from the Zero DTE Options Trader Alert Service. Now, I told you earlier, I'm 57 years old, been doing this since I was 18. When I first started trading, there wasn't a whole lot of education for young 18-year-old guys, gals to do options, much less stocks, okay? So Price Headley, our founder and CEO, when he started Big Trends back in November of 1999, wanted to make educational resources available to our subscribers. Do you have to use these to be a subscriber? You don't, but they're there if you want to educate yourself. Price does weekly video updates, okay? He also recorded a strategy session. What is that? It is a deep dive into the Zero DTE options trading system. Do you have to watch the weekly videos? Do you have to watch the strategy session to be a subscriber? You don't. Do you have to go study the settings and rule sheet? What is that? That is a condensed version of the strategy session. Again, 57 years old. We used to use what was called Cliff Notes back in the day if we didn't want to watch a movie or read the entire book. If you don't want to watch the entire strategy session, you can check out the settings and rule sheet. And one of the other things that we offer to you is a dedicated email address to contact the analyst team for any questions about trades. Why did you all pick that particular option? Why do you all use those particular settings for VWAP and the SMA? Okay? We're here to help. Been around for more than 26 years. Now you can see total package value, $3,564 for a year subscription. It's based off the monthly list price of $297. But I told you, I have a special for you today. So $3,564 is going away. Now it is available to the first 34 traders. We're over 34 traders today. How about $297? You simply go to bigtrends.com/corner, bigtrends.com/corner. Now, what I want to point out about 297. Now, if you remember from the previous slide, what did I tell you? 3,564 up here that's marked out. Remember, that was 297 times 12, right? That was 297 times 12 equals to 3564. So you can look at today's offer, 297, like buy 1 month, get 11 months free. Think about that. Buy 1 month, get 11 months free. And I showed you numerous trades, depending on what size trader you are, that could cover 297. Anthony, thank you for posting that in there. Let's go to that checkout cart now, folks. Let me show you how simple this is. This is the checkout cart. Let's start over here at the top left, billing information. You all get this. You all have done this with us and other organizations. First name, last name, email. What I will tell you here about email, please type it in correctly. Why? So you can get your purchase receipt, your welcome email, and of course your trade alerts. All right, so take just a few seconds, make sure you type that in correctly. Contact information. You saw it earlier. Remember, we're here at Big Trends today until 5:30 p.m. Eastern time. Okay, if you have any questions, reach out to us. 1-800-BIG-TRENDS. Payment information right below that. We accept the 4 major credit cards: Visa, MasterCard, Amex, Discover. Slide down that right-hand column there. You see a golden rectangle with the word PayPal in it. That lets you know that we accept PayPal as well. So 5 ways for you to join today if you're one of the first 34 traders, and it's just $297. Terms and conditions are there, and the contact information, if you get to the bottom, is listed again. It's 1-800-BIG-TRENDS. That's 1-800-244-8736, or email clientcare@bigtrends.com. And you heard me utter this phrase earlier. We're proud of it because we deliver. We're here to help. You have questions, we will help you. We're here to help. Remember, 26 years in business. bigtrends.com/corner 297. Please note, Big Trends is plural. Very simple. No www needed. Simply go to your favorite browser, go up to that URL, type in Big Trends, or copy the link from Anthony, or maybe just click on it. See where it takes you. Okay? Now, FAQ. Let's talk about it. What type of strategy is used? As I showed you today on these case studies, we can go in either direction, calls or puts. How are you going to receive these trade alerts? Real time via email. You just heard me talk about the importance of the email field. Make sure you type in that correctly. Now, out there to the right, you see WhatsApp in green. What is that? It is a free, no-cost application that you can put on your computer, your laptop, your tablet, your mobile device, or all of the above. Do you have to use WhatsApp? You do not. You can simply get your trades via email. We do not text. Why? Because WhatsApp is faster, more flexible, more efficient than texting. Okay? We give you setup instructions for WhatsApp in 2 locations. In a welcome email that you'll receive from us, you also find them in your Big Trends account under the My Account section. Remember, it is essential for you to be available between 9:50 a.m. and 10:05 a.m. Eastern time to be a subscriber. When are we going to close these trades out? What are they? If they haven't been stopped or they haven't hit our profit targets, we're going to close them same day, 3:30 p.m. Eastern time. How many trades per month will you receive? Up to 10 trades per month. So what, a couple trades a week, maybe 3 trades a week? What is the recommended price? As I taught you today, averaging less than $1 a contract. So you don't have to be a $1,000 trader. I would suggest 300 maybe, so you could do at least 3 contracts, because remember, the idea is to sell 2/3 when you get up 50%. Resources. Do you have to use them? You don't, but we make them available for you because we want you to be educated if you want to go there. Weekly video updates from Price Headley, our founder and CEO. Settings and rule sheet, which is the condensed version of the digital on-demand strategy session. And don't forget, we give you a dedicated email address to reach Price and our analyst team. Now, here's a reminder how this strategy has performed over time. Started in January of 23 through this morning. If you just started back then with a $5,000 account, allocating up to $1,000 a trade, all trades all losses, all wins, no compounding, no commission, no subscription fee. You're up $25,531. And as I pointed out to you all earlier today, folks, that's 510%. It's 510%. And you think about what we've gone through in the markets over that time frame. Think about it. And remember, you have no overnight risk. Zero overnight risk. Getting in same day, hence the name, Zero DTE Options Trader. Visually, that's what that looks like this way. $5,000 has now grown to $30,531. Past performance doesn't guarantee future results. Future results are going to vary, okay? Now, 12 months, resources, prices, weekly video updates, the strategy session, the settings and rules sheet, the dedicated email address, total package value, $3,564. That's based off the monthly list price of $297. But remember, for Anthony, Marie, and everybody at Traders Corner for today's Investor Summit, we are marking down $3,564 for the first 34 traders. Again, there's more than 34 of you in the room. $297 when you go to bigtrends.com/corner. And as I taught you a few minutes ago, that's like buy 1 month, get 11 months free. Okay? $297. And think about how many trades I showed you if you were a $1,000 trader that easily covered $297. This is the very first trade that I showed you all today. It was the put side because remember, we can go in either direction. These are 5-minute candles, and this is the 15-minute range. Okay? We've got our VWAP here. We got our SMA here. SMA. And we have our VWAP right there. Okay? When we're trading puts, we need to be below that range and below those two indicators. And don't forget the big trends volume confirmation at the bottom. 88 cents a contract. Got in, got out, 50%. Now we have our what? Risk-free trade after taking 8 of the 11 off. 3 remaining contracts were a full target profit of 500%. That trade generated $1,672. Now that's a full profit trade. But I showed you trades that we lost on the second piece, right? So again, depending on what size trader you are, one trade could easily cover your offer today. So remember, $3,564 market list price goes away. 34 traders today, $297 when you go to bigtrends.com/corner. Anthony's thrown that in there. I'm going to throw our contact information and that link in there as well. So give me just a second here. Let's do this. There we go. Remember, we're here today until 5:30 p.m. Eastern time. Should you have any questions, here's the checkout card again. If you just joined, you see that email field highlighted in red. Folks, I do that on purpose. I want you to get it right. I want you to start off on the right note with us. I want you to get your purchase receipt. I want you to get your welcome email. Okay? And you could get your first trade tomorrow morning. I'm not guaranteeing you a trade tomorrow morning, but you could be well on your way tomorrow morning. Type that email address in correctly. Contact information is at the top. I'll also just put it in the chat for you. Remember, it's at the bottom. We accept the 4 major credit cards as we discussed: Visa, MasterCard, Amex, Discover. Slide to the bottom of that column. You'll see that we also take PayPal down there in that golden rectangle. $297 does not automatically renew. You heard me correctly. No surprise charges from us in a year. Okay? No surprise from us in a year. What'll happen is 3 days prior to your expiration, we will send you an email stating, Mr. Jones, Mrs. Jones, your subscription to Zero DT Options Trader is about to expire in 3 days. Here is your opportunity to renew. If you miss it, you ignore it, your subscription will simply expire in 3 days. No surprise charges from us. Remember, we've been around for more than 26 years. I was a client early on when Price started Big Trends. I've been a part of Price's team now for almost 15 years. We've been around a while. We've experienced a lot of things. If you want to be in and out same day, no overnight risk, you like trading the queues, you like trading contracts that are typically less than $1 a contract, you're available that first half hour of the trading day, please go to bigtrends.com/corner. Anthony, I think I'm right close to my time.
Yeah, that is correct, Chris. Thank you so much.
Thank you. And in behalf of Price and all of our team here, thank all the attendees. Thank you, Marie, and your team once again for having us today.
Thank you, Chris. Fantastic presentation and
Thank you.
extremely valuable information as always. Chris's promotional link is in the chat box now for anyone who'd like additional information. All right. And now moving on to our next presenter, Jeff Beamer. Jeff is a professional fund manager and trader with over 37 years of experience in the financial industry, including hedge funds, mutual funds, and investment advisory firms. Jeff, I just got to make you an organizer. Let me make you presenter first. Jeff will discuss behavioral patterns around earnings season, non-directional trading strategy, implied volatility analysis, and high probability earnings and trading opportunities. His presentation is called Earnings Edge, How Smart Traders Target Volatility Around Earnings. Everyone, please welcome Jeff Beamer.
Hi there. Good morning. How are you
Jeff.
this morning?
I'm good.
Good. Got the right screen now up and showing. You should see Earnings Edge on your screen. Are we
Yes,
got good sound and good visuals?
Do we need to turn on your camera as well? I turned it off because I think you entered the room with it on accidentally or something.
Yep, I did. We don't need it on unless you want me to appear. We can leave it off.
No, you're good. Yeah,
save,
you present it however you want to do it.
Okay, sure. And if we're ready to get started, I can jump in because we got a lot to cover in our time allotted for today.
Yeah, it's all yours.
Okay, great. So my name is Jeffrey Beamer, and I'm going to talk to you today about a strategy that does not involve picking market direction. Okay. So we don't need to worry about if the market's overbought or oversold or anything. We're going to be focusing on a little system here that I've traded for many, many, many years. And it's just become one of my favorite little things. And that's trading earnings around stocks that have earnings announcements. Okay. Now, before I get into this, we do have a little disclaimer. You can pause during the recording, but we are not an investment advisor. Options do carry risk. Okay, so let me kind of move forward here and tell you a little bit about myself. So we're going to cover in this section here the behavioral patterns in stocks that repeat quarter after quarter. We're going to talk about why smart traders prefer non-directional strategies using options. Okay, now we're going to screen for these stocks that have earnings, and we're going to trade an earnings trading system using options. So if you're not really familiar with options, that's okay. I'm going to cover some basics and then very quickly move through that to get to kind of what the strategy and strategies are. So once again, my name is Jeffrey Beamer. I'm a 35 plus year industry veteran. I've founded multiple hedge funds, 2 different mutual funds. I've created 3 different investment advisory firms. I've been very active in the industry. I'm the past president of the Security Traders Association and the Market Technicians of Texas. And I've been a member of the National Association of Active Investment Managers for many years over the years. So I'm heavily involved still to this day in the industry. And am aware of a lot of things that are going on. All right. So let's talk about the system overview, capturing earnings related price moves. All right. Now, this is a unique trading system that profits off of earnings announcements. So this is a regularly occurring company event that happens and every quarter and impacts a company's stock. Every quarter, these traders are faced with the potential stock moving event, and this usually scares some traders. Okay, what's Nvidia going to do? What's this stock going to do? What's that stock going to do? Are you long? Are you short? We're going to take that kind of fear away. So traders have a consistently search for a successful option strategy, But the secret isn't one single strategy. It's actually a combination of three. Okay. And two of the three are really basic, and one is somewhat, it's kind of medium advanced, but it's based upon simple, basic principles. Okay. So what we look for here is repeating behavioral stock patterns. All right. So when you look at a chart, you can see what it's done in the past around these earnings events. I'm not concerned with long-term trends. I'm not concerned with, what it's doing kind of during the week. I'm just concerned with the earnings event. So we're going to target stocks that have an upcoming earnings announcement, and we're going to make money. We're going to attempt to make money, okay, from breakout moves, quiet reactions, which are two opposite things. Okay. Some stocks break out, some stocks consolidate, or something called an IV rush, which stands for implied volatility rush that comes into the options ahead of the event. Okay. Now we utilize these strategies. Okay. Straddles, strangles, and iron condors. Now, the good thing here is straddles and strangles you probably learned about at the very beginning of your options trading education. Now, I have known from my years of teaching that a lot of people don't have success trading straddles and strangles. And the reason why is because they don't give themselves enough time, or they trade a stock that doesn't have a particular event occurring and the stock just doesn't move enough. Okay. Well, that's why I like earnings, because there's a few stocks out there that really move around earnings. And then there's a lot of stocks that just don't move at all. What's the difference? We're going to talk about that starting right now. Okay. So let's start with a quiet stock. Okay. This is a stock that just doesn't go anywhere. This is Pfizer. Okay. I've got the earnings announcements highlighted with an ellipse here. All right. On this particular chart. And if you can see over the past 6 earnings cycles, Pfizer moves less than 4% through earnings. We call that a quiet stock. Anything that's 9% or less, so single digit moves, 9% or less through earnings is a quiet stock. Okay. And even when the stock is not having an earnings announcement, you can see how quiet it is. It barely moves. All right. It's just a place to park your money and collect a dividend, I guess. All right. But we can actually make money off of these earnings events because of a certain thing that happens to the options going into that earnings event, which I'll talk about in just a moment. Okay. Now, then you have a stock like Akamai, okay, that is a breakout stock. We call this a breakout because the average move of Akamai is 15% over the past 6 earnings cycles. Now, that's not taking the price of the stock and then it moves 15% after, over a 6-week period. No, we're talking about literally overnight. Okay. Or during the day, if a stock has earnings, so stocks either declare before market open or after market close. Okay. If it's before market open, these stocks are moving big during the day. Okay. And if it's after market close, they're gapping overnight. Okay. And you all of a sudden wake up the next day and you're going, oh, well, looky there. Okay. So Akamai has an average move of 15% over the past earnings cycles. This is actually one of my favorite stocks to trade, actually. Okay. So here's the step. There's 3 steps. Okay. And we're going to talk about these 3. Step 1 is quite simple. All you need to do is find a list of stocks that have an upcoming earnings announcement. Okay. You can do this with a simple Google search. There's lots of free places. You can search Google, you can go to Yahoo, you can go to Reddit, you can go to Seeking Alpha, you can go to your broker's website, your charting package. There's lots of different vendors that provide earnings information. Okay. When is a stock going to declare earnings? And that's really easy to find. All right. I use a platform called hub.com, which I'll explain a little later, but that's, where I get this information from. All right. The second step is identifying behavior patterns. Now, you'll find that some stocks exhibit a consistent behavior around these earnings announcements. Okay. Pretty consistent. Some stocks may be quiet going into or out of the earnings announcement, while others may be extremely volatile. Okay. Look at like Dell Computer or Dell Technologies recently. It really rallied up into its earnings, and then it has earnings actually today after market close, but this stock has rallied from 240 to 322. So $240 to $322 in about 4 days. Okay. So it really rallied going into its earnings announcement, and we'll see what it does after the announcement today. Okay. So for breakout stocks, we're looking for regular explosive movements around earnings like Akamai. Okay. For quiet stocks, we're looking for consistent non-movement around earnings. And that, depending on what the move is dependent on what strategy we use. Okay. And it's pretty simple. So let's talk about a volatile stock. Okay. Now I gave you Akamai, but here's Lamb Weston. This is another notorious volatile stock around earnings. Okay. They have an average expected move of 14% through earnings. This stock constantly gaps. Sometimes it does something in between the earnings announcements, sometimes it doesn't. But you can see the big pops or the big drops around the earnings announcements. Okay. In fact, if you look at the last earnings announcement that I have here, which was back in April, okay, this one probably was a loser, quite honestly. The stock dropped 8% on earnings and then rallied over the next couple of days. But that's more than made up by all these others. In fact, the previous, back in December, this gap down on Lamb Weston was what we almost call a home run. Okay. Usually doubles and triples I like taking. I'll define what those are in a few moments, but that gap down was just great. Okay. For us, because the strategy that we traded in this was either a straddle or a strangle. Okay. One of those two. So this is what we call an explosive stock or a breakout stock. Okay. All right. So let's talk about straddles. Okay. And I'm also talking about strangles here, that you can use them interchangeably. I'll define what they are. Okay. Again, for those of you that are new to options, you're simply buying a call and buying a put. It's done at the same strike price and the same expiration date. That's it. Okay. That's a straddle. All right. Now, this is a good strategy if you think the stock will experience a large price movement in the near future, but are not sure of the direction. Because remember, a call gives us the right to buy, but not the obligation. And a put gives us the right to sell, but not the obligation. So we can make money really either way. And this is known as a delta neutral position. I'll show you why here in just a second. Let me introduce you to risk graphs if you're not familiar with these, because I'm a visual person. I like to visualize these things. All right. As I trade them, when you buy long stock, this is your risk graph. Okay. You have unlimited reward to the upside, and you have unlimited potential for loss down to zero to the downside. Okay. And if you don't think stocks don't go to zero, you have not been trading very long. All right. They do. They do. And they have. All right. So that's a long stock position. When you build a straddle, okay, it's usually start with a long call. You buy a call that gives you the right to buy at $50. There's a small debit there. Okay, let's say this is $2 for that call, and it gives you a certain right to buy until a certain date into the future, whatever date that is. Okay, now when you add a put, and in our example here, it's also priced at $2. You could make money to the downside as well. All right. This is called a straddle. All right. And this gives us the ability to make money going either direction. So let's look at the option chain here. Okay. You have an option chain. We'll go to that $50 strike price there. Puts are on the right, calls are on the left. I actually have a column for the delta as well. Okay. So you buy the call at $2, you buy the put at $2. That would be $4. But look at the delta. The delta on the call is a positive 50, and the delta on the put is a negative 50. That equals zero, and that is why they call it a delta neutral trade. Now, in the real life, it's hard to get a perfectly zero delta, but if you have a delta of 3 or a delta of 5 or a delta of 7, that's okay. All right. But it, that's where but that's where the term comes from, is that delta neutral. Now, visualize with me here. Go to the 48 strike. Okay. Look at the put. It's $1.08. Okay. Go to the 52 strike and look at the call, and it's priced at $1.08. Now, this is in a perfect world where everything is kind of linear on pricing. You add those two up, that's $2.16. Now, if you bought the 48 and the 52, that would be a strangle. Okay. If you did it with the same expiration date, that would be a strangle. All right. But notice here, it's $2 away, okay, from where the stock is trading. And then you add a $2 debit. So it's $2.16 for that strangle. The break even, which is going to be the better play? Well, remember, when you buy a straddle at $50 and it's cost you $4, okay, or $400 because you multiply times 100, your break even is going to be your strike price plus your debit to the upside. So $54 to the upside, and then $50 minus your debit to the downside. So $46 to the downside. So if I calculate that out, my break evens are $46 and $54. Well, guess what? It's going to be about the same for the strangle, but a little bit bigger, because instead of moving $4, it's got to move $4.16. Okay. Now you can play around with your broker's website and look at straddles and strangles all day long, but essentially that is what, that's what the reality is. Sometimes the cheaper play is the strangle, and sometimes it's the straddle, but I price them both out just for, that purpose right there. Cause sometimes you get the strangle for a little cheaper than you can get the straddle, and your break evens are going to be, around the same. Okay. So let's talk about capturing the breakout. Now we have our straddle here, and we can trade in either, so we make money in either direction. But as I mentioned, the stock's got to drop. And then below that break even on the downside, or the break even on the upside, that's where you make money. In the middle is where you have the potential for loss. Okay. So if the stock doesn't move, then you have the potential to lose money. Now, I like flipping my risk graph. Some brokers allow you to do this, some do not. Okay. Um, they have what we call a traditional risk graph. This is a modern risk graph where we flip it over and rotate it 90 degrees. And then we look at the stock, compare that to the stock chart. Okay. And we're looking for that stock to run into that risk graph, either up or down. Okay. It's a little easier to look at. Now, you're going to want to place this straddle or strangle before the earnings event. Okay. And then there is a chance that, because of something called IV rush that I mentioned at the very beginning, we could actually make money on this trade, because implied volatility is rushing into these options. And there's times when I've made a 20, 30, 40% return on just the IV rush, and I take the trade off before the earnings event because I've already made 30% or 20% on my trade. I don't need to worry about the earnings event. But going through the earnings events, that's where usually the big money is. Okay. If you're going to make big money on a straddle or strangle, you need a big movement, and there's nothing better than an earnings announcement and a stock that has a history of moving big around earnings. Okay. They're a lot of fun. Now, let's talk a moment about that implied volatility and theta decay for a moment. We call this IV rush and IV crush because after the earnings announcement, after that implied volatility is rallied up, rushed into the options after the announcement, it drops, it collapses. And then we call that IV crush. And then time decay. Now, time decay on these straddles and strangles works against us. On the quiet stocks, which we'll talk about in a minute, it actually helps us. So two different effects here. But let's talk about IV rush, IV crush, and time decay. So look at the bottom chart here for a moment, the red and the black. The black line is implied volatility that's greater than 90 days. That takes in all the options that expire in greater than 90 days, averages them out, and that is a plot of what their level is. The red is short-term IV, 30 days and less, meaning all the options that expire within 30 days. Okay. Now notice that as we go into the earnings announcements, which you can see on the chart itself with the little ellipses, again, this is on Akamai, and this will happen on every single optionable stock. You get this rush going into the earnings announcement, and then look what happens right after the announcement. You get this collapse, and it collapsed so much that we usually go into what's called backwardation. Okay. So, you get this front month IB trading lower than the back month's IB. And that's, not really normal. Okay. Usually front month IB is a little bit bigger, or, it kind of goes through the curve. All right. So we get this effect every time, this IB crush and IB um, rush and the IB crush around every earnings event. All right. And sometimes look at this. 2 earnings ago, back in February, okay, um, the IB was at a high level that it's ever been. But the drop, now we still made money on that trade, but the drop was not as big as the most recent earnings announcement that happened in May or earlier this month, May 7th. Okay. Um, Look where IB was. It was actually not near its 1 year high. Okay. But it was still inflated. And so that's where the pricing issue comes in, pricing like advantage sometimes. And we look for those advantages. And sometimes when there's a disadvantage, we don't trade it. Okay. But sometimes there's an edge. Okay. We'll call that advantage an edge. Sometimes we do get the edge in our favor, and we're all about it. Okay. Now, time decay. Time decay and straddles. To remember, they work against straddles, and strangles, but they work for are iron condors. Okay. Now, um, days expiration. Uh, People think that um, theta decay, time decay, is linear, and it's not. It looks like this pink line here, and whether it's a call or a put, you go out in time, and theta decay doesn't really affect you. But coming into the last 30 to 45 days, it really starts to take a toll on that options price. Okay. And we used to, in a classroom setting, we used to take a piece of paper, roll it up, and throw it across the room to show this effect. Okay. You initially throw that piece of paper or a ball or whatever it is, and it'll sail for a while, and then gravity starts to grab hold of it, and it starts this arc and starts to drop. Okay. Now, can you imagine what happens when you buy a call and a put together? Well, that straddle or strangle loses value much faster. So timing on this is critical. All right. Timing on this is going to be very critical. And, you know, that we're going to talk about that. We're going to give you the time frame here. So, in fact, right now, we're going to talk about the ideal time frames here. So, how close should you enter this trade? Well, I usually like a couple of days before the earnings announcement. Okay. Sometimes a week, maybe even 2 in advance. If I'm playing that Ivy rush game, I'll probably enter 2 weeks before. But if I'm playing the move itself, I will wait sometimes until the day before to um, to purchase that straddle or strangle. Now, it's a little counterintuitive because we are actually buying higher implied volatility. Okay, remember the rush? Okay, we're actually buying that with the straddle or strangle. But the thing is that once an option goes in the money, it has what's called intrinsic value. It has real value. And IV, okay, they theta decay and IV don't matter so much anymore. Once that option, either the call or a put, has actual value, we call that intrinsic value, it doesn't impact you anymore. That's why this strategy works. Everyone's like, wait a minute, you're buying expensive options and then it crushes after on a normal event. Like if you traded a straddle or strangle after an earnings event, okay, when implied volatility is low, great, you bought it for cheap, but there's a reason it's cheap. Okay. And if you didn't buy enough time Like if I bought a straddle or strangle outside of an earnings event, which I do every now and then, I'm giving myself a couple of months with those options. Okay. I'm giving it plenty of time for me to be right. All right. A lot of people are like, oh, I'm going to buy weekly options on this, and there's no event, there's nothing coming up. And that's why earnings are so great. It just happens like clockwork every earnings cycle. Okay. Um, and here's the thing, before I move on to iron condors here, you want to do it before the earnings event. And again, it can be, if it's a consistent breaker, I will wait because I don't want the time decay. All right. Uh, a good example today is Snowflake. Okay. Great move today. The stock's up 35% on earnings this morning. Okay. Up 35%. But I didn't buy it last week because we had a 3-day holiday this past weekend. I did not want that time decay over the weekend. All right. So I waited until Tuesday. Okay. Until Tuesday to go ahead and pull the trigger on that. And then up 35% today. Okay. Beautiful move for Snowflake. SNOW is the symbol there to give you an idea of a big mover, which was on our radar. It was on our list, which I'll show you how to get our list. I actually send my list out every week. Okay, I'm going to show you how to get it here in just a moment. So you're going to want to hang around. So now let's jump into iron condors. Okay, because this is a little bit more complicated, but once you get the hang of it, it's really simple because, well, honestly, it's two vertical spreads combined together. And even, usually on your second day of option training, you usually learn about vertical spreads. Okay. But you usually learn about buying them. We're going to be selling them. Okay. We're going to be selling them, and it creates a defined risk strategy. Okay. We never sell options naked. Okay. We never sell it, well, unless it's under $5, maybe $7. Okay. Why? Because on a $5 stock that has options, and you might say, well, what stock had options? Well, I was trading BlackBerry. Now, BlackBerry's now an $8 stock. BlackBerry has options, and that was really fun to trade. Okay. Selling naked options on. Okay. Because your risk is zero, right? So you only have $5 risk minus your credit, and it goes to zero. So that's my note on selling naked options. We don't do it. Okay. You especially don't want to be doing it on a $80 stock or a $300 stock or, whatever. Okay. So let's get into a quiet stock. Now I showed you Pfizer. Pfizer is honestly a little difficult to trade an iron condor on, just because the stock's $27 and it's cheap, and it's always cheap. And okay, even though implied volatility comes in around earnings, but this is one we do trade like clockwork. Okay, Home Depot. Um, Believe it or not, this is a stock that is just, the company's so big and it's just hard to move the needle. It's a $300 stock. Last earnings event, you can see it really didn't move much. The average move, the average expected move for Home Depot over a year and a half time, which is usually my window to kind of look back, is 4%. 4%. Okay. And it just doesn't move. Now, one thing to note here, and this goes for straddles and strangles too. Usually, 1 out of 4 or 1 out of 5, will be conservative. 1 out of 4 are a loser. Okay. Like back here in November, that gap down might have challenged. I think that was a 6 or 7% move for Home Depot. I think we squeaked out a win on that because I think I put my break evens around 10%, and I'll show you how to do that. I teach you guys how to do that. About 10% away of the money. So I'll have to go back and look, but that could have challenged us, just so you know. That could have been a challenge. But look at all these others. That's a winner, 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 maybe a loser there, winner, winner. Okay. So 5 out of 6. That's a good percentage. Even 1 out of 4, 75% wins, is a good number. You do that with these strategies, with any of these strategies, and you're making money. Okay. Yeah, you are making money. So let's move on here. So this is Home Depot. Iron Condor. This is a strategy combining two vertical spreads together. Okay. So we're going to sell a put spread on the bottom half, and we're going to sell a call spread on the top, okay, to open. So you're all you're doing is buying and selling of options, and you do it to open or you do it to close. All right, we're doing it to open. We're buying and selling options. So you buy a lower strike put and then you sell a higher strike put. That creates a credit. And then you do the same on the call side. Above the strike price, you buy a higher strike call and you sell a call below that near the current price. That's a call credit spread. The two credit spreads together create a larger credit than one. Okay. The goal is to generate income through the premiums that you receive while minimizing risk through the purchased options. That's why we like the Iron Condor. Okay. Generate that income through the use of those options. This makes money if the underlying asset remains within a certain price range to expiration and incurs a loss if the asset moves outside of the range. Okay. Um, when can that happen? I'll tell you. Walmart gave me fits this last cycle. I've made money on Walmart for a long time. Okay. This last earnings announcement, I didn't do the trade wide enough, and the CEO started talking about the consumer and started, in my opinion, went outside of his lane, talking on the earnings call, talking about the overall economy and all this stuff. And the stock reacted. It dropped over 8% and followed through the next day. Okay. All right. So, lots of winners, but what we did have a loser on Walmart. Okay. That's just an example. That's the reality of it. Okay. So here we go. Back to the risk graphs. You buy a long put that's say at $40 and you sell a put above, okay, say at the 45. That generates a bull put spread. Now, with this strategy, let's say the stock's trading at 50, for example, okay? So the max profit on this would be, in this example, would be $1. The max risk is $4. Now you say, well, why on earth would anybody do that where they're risking more than they make? Well, the answer is simple: odds and probabilities. Okay. It's why Vegas exists. And again, I'm not comparing what we do to gambling. However, when it comes to the math, it's all numbers and it's all the same. It's about odds and probabilities. Okay. Bear call spread, same thing on the top. You sell a strike. Let's say we sell it, well, at 50. Okay. Just for our example. So the stock's going to have to stay between 45 and 50, which might happen. Okay. And then our long call at 55. You combine these together. Okay. In this example, we're saying the pricing is similar. Okay. Which it often is, especially for a non-dividend paying stock. Risking 4 to make 1. Now, when we combine these together, here's the cool thing about this strategy. Okay. So in this example, here's my Iron Condor. My max profit is $2. Okay. Because I combine the credits together. But my max risk is $4. It's not 8. Why is it not 8? Because the OCC and the SIBO, they're smart fellows up there, smart ladies, smart fellows, and they know that a stock can't be in two places at the same time. So why charge people two margins for if the stock can't be in two places at the same time at expiration? So they don't. It's very nice. So while I get to add the credits together, I don't add the risk together. My risk is $4. Okay. And in this example, the break evens, and I had that incorrect. I was selling the 55s, buying the 60s. Sorry. So in this example, we have a nice little range here to enjoy the potential non-movement of a stock. So you see there's a range here. And if it breaks above or below, then that's the potential risk on the trade. Okay, so the best setup for Iron Condors is trading through earnings, and it's usually 4 to 10 days. Okay, that's the length of time that you're going to be in the trade, including the earnings announcement. All right. So these are short-term trades. They're not very long. Oftentimes, I will do a trade on, well, you'll see here in a minute. I mean, 3 days, 4 days, sometimes 5 days. Is the holding period. It's not very long at all. Not very long at all. So we have usually 4 to 10 days is our average hold time. IV rush. This is why I wait until that last moment. I'm only a couple of days ahead of time, because it, we get that IV rush in these, and implied volatility is rushing into these options, and it makes them more expensive. But we know, because of the history, and again, past performance is no indication of future results. Okay. Um, but we know that statistically it's going to be similar. Okay. And the average move, if the average move for a stock is 4%, okay, it's going to be, that's the average move, unless the CEO starts moving their lips. Okay. So statistical volatility, that means what you can see on the chart. Okay. That's statistical, also known as historical volatility. What you see on the chart is known by those two terms: historical volatility or statistical volatility. They're interchangeable. Okay. You want that to be ideally pretty low, but I'll give you an example of one that wasn't. Okay. So net delta, you want that to be closest to zero as possible, but that's a natural effect of trading an iron condor, what we call at the money. At the money, where the current strike price is centered in the middle of our break evens. Okay. That is a um, where your delta is going to be zero. Oh, I don't know why my pricing is washed out here, but here's an example. On the call side, we buy the 56s and we sell the 52s. Okay. On the put side, we buy the 44s and we sell the 48s. Now, if we did this trade, remember the 48 and the 52, that's $2.16 right there, minus the 24 cents of our wings. We call these wings, and their only purpose is to protect our position, to create a limited risk opportunity. That's their only purpose here. Okay. So for the example, if you're at $2.16 and you subtract 24 cents out of it, you come up with $1.92. Okay. So then on a $4 trade, because it's $4 wide. Again, 44 to 48 is $4. 52 to 56 is $4. Again, you're not doubling up on those. Then you subtract out the $1.92, okay? And that is going to be your max risk in the position. This would be a very nice trade. I would do this all day long if I had a quiet stock, okay? And my option pricing was there, okay? Because again, I'm not concerned with the overall trend of what it's done over the past month or the past 2 months. I don't care about the trend. I care about what it does through the earnings event. Okay. Some other considerations for iron condors are your strike placement. This is a careful consideration, with the objective being that the stock price at expiration ends up between the two middle strikes. So our two short strikes. Okay. The effects of time decay work in our favor. That's why for companies that have earnings on Mondays, which I don't like, but I do like them for iron condors in the sense that I get theta decay over the weekend. The announcement comes on Monday, say Monday morning. There's a few stocks that are notorious for having earnings on Monday mornings. I capture that. And then oftentimes I don't wait until Friday expiration for to get out of it. I might get out of it right after the earnings announcement. I will make less because of time value, but I don't want that stock to move on me. Now, notice what I said: weekly options. Yes, love trading these with weekly options. In fact, if we have a stock that has earnings coming up, like for example, today we have Best Buy, Costco, and Autodesk that's on our radar. I would trade options that expire on Friday, like tomorrow. Okay, so if these stocks, then I would have to confirm if Best Buy, for example, announces aftermarket close, I could put that trade on today for tomorrow's expiration. But because implied volatility is so high, I might get a pretty good deal on it. Okay, that's how all this works, and that's how it gives you build an edge into your trading system. Okay, the effect of implied volatility also works in our favor through what we have called IV crush, and you saw that on the Akamai chart where that red line just drops like a rock after the earnings announcement. Okay, so implied volatility increases before earnings, which gets priced into the options, making them more expensive. It drops right after earnings, which these options then lose value. Earnings moves are priced into the options, so positioning and timing is pretty critical. Okay, we profit when the IV collapses and when time goes by, and the stock remaining between our break evens. Okay, now I did have a chart of ExxonMobil. I thought I had it in here, but I failed to add it. If you look at ExxonMobil, the last, not the most recent earnings announcement, but their announcement before that, XOM is the symbol. This announcement was back in January. ExxonMobil was in a uptrend. Okay, it was rallying pretty hard, but we traded it for earnings because we're only concerned with the earnings announcement, and the stock did exactly what we wanted to do. In fact, it kind of volatile. Its volatility was centered around our middle strike for 3 days before it started moving again. It was great. I'm not concerned about the overall trend. Okay. So implied volatility increases before earnings, which I showed you, which makes straddles expensive, but we're okay with that because once it goes in the money and has intrinsic value, we don't have to worry about the IB crush. Implied volatility drops right after the earnings, which makes straddles lose value. So again, you want that stock to move. If it doesn't move, then you have a potential for losing money. Okay, so the price is pretty critical. Now, straddles profit faster when the stock breaks up or breaks down from implied volatility. Okay. Now, so let me just I'm getting towards the end here, and I got through that actually a little faster than I thought. But let me stress with those iron condors, if you're not familiar with that strategy, there is plenty of resources. In fact, you can learn about them on our website at ewotrader.com. I'll show that link in a minute. Okay. You can look it up online. There's all sorts of free resources to teach you how to structure it and how to trade it. Okay. But I'm going to show you a way where, in a minute here, where I'll actually kind of hold your hand a little bit and kind of walk you through it. I'll show you the entry, and then I'll tell you when to exit, and then I'll tell you why we're exiting and that sort of thing. That is something that we do through some publications that we have. All right. But the point I wanted to make about the iron condor is it is a little bit more. It's again a medium level strategy. But when you think about it, you've already learned probably about vertical spreads, about buying a bull call spread or buying a call spread or selling or buying a put spread. Okay. Well, we're doing the opposite here. We're selling the put spread on the bottom, we're selling the call spread on the top, and that is what's making that trade work. Okay. So time frames. Let me reiterate the time frames. Option values decay faster than when they get close to expiration. Okay. Theta measures the impact of changing time to expiration. So theta works against straddles and it works for iron condors. Okay. It works against straddles and strangles and for iron condors. Theta loss, or the rate of decay, increases as the options get closer to expiration. Okay. Straddles use at the money options, okay, which lose time value more quickly than out of the money options do. Okay. Now your strangle is still usually close enough to at the money to where you are affected by time value. Okay. And you need to be aware of that. That's why we will wait sometimes um, right up until a couple of days before the earnings events to put these trades on. Again, unless I'm trading an IV rush scenario where I will put the trade on a week or maybe two in advance. So while iron condors use out of the money options, which also lose time value, the collapse of IV and time value benefits us. Okay. So it's important to learn that concept. Now, let me introduce you to something called Earnings Club. Now, this is derived from a show that I do every Monday. We post it up on YouTube. We posted it up on our website at hub.com. Our YouTube channel is hub.com. All right. Earnings Club. I do a show every Monday morning called Earnings Call. And I always give out a trade in that. And that's how we came up with Earnings Club. Okay. Because there was that constant demand of, hey, can you send these trades out to us? Can you give us an alert on this? Well, it's every Monday. Okay. Right now we're making a big enhancement to that show, and it's going to go live here pretty soon. We record it every Monday morning, and it's posted pretty quick, so it comes out on Mondays. But I think we're going to change it up, and me and a colleague of mine, we're going to do this together, and it's going to go live. So if you, I'm going to show you how to get in touch with us and how to be part of that here in just a second. But let me go back to that. Okay, let me go back to that and talk about this. Winning trade percentage here, 76%. Like I said, sometimes there's losers. Average trade return, 44%. If you annualize the performance since we started tracking it last August, okay, started tracking it last August. Now, these numbers, keep in mind, I am basing every trade on a hypothetical $10,000 trading account, okay? So every trade needs to have a debit of $500 or less, okay? $500 or less. And this is the performance that is generated, okay? Almost 80%. Now, this was through the quarter end in March, okay? This was the performance through March. So I decided to show you, hey, since March, what's happened since March? Well, we're still cooking along. Here is what our those that subscribe see. Here's as recent as May 15th, we exited out of Baba. Okay, that was an iron condor. And look here next to the risk graphs on the right hand side. Look at the days in trade: 3 days in trade, 8 days in trade, 8 days in trade, 3 days in trade, 3 days in trade. Loser there on STZ, but Progressive, American Express. Okay. Rivian, look at that. We're long strangle on Rivian, and we scratched out a small win, a 7% win. Rivian did not move as much as it normally does, and we still were able to squeak out a win on that. Okay. We were in that thing for 8 days, and it just didn't move enough for us, which is not uncommon. But I'll tell you, one I love to trade that we did in earnings call back in earlier this year, January, I think it was Pinterest. Pinterest, man, that thing almost $600 in profits just on one trade in 3 days. $600. Now realize that's based upon a $10,000 trading account. That's a 6% return on portfolio in 3 days. So if you look at these numbers, 1.4%, that's a return. 0.22 basis points, 1.5% return. Oops, let me go back to that. Oops, sorry. Oh no, let me go back to that. I hit my button too many times. Stand by. I'll go back to it. Let me show you that offer, because you're going to be amazed at this. Okay. There it is. I got it. Here it comes. Here it comes. Oh, let me go all through it. Sorry if this bothers you. Close your eyes. I'll come down to what a rookie error here. Been doing this a long time. Rookie error. We're going through our presentation, building up to what I got to show you, and you're not going to believe it, what we're going to offer you here. Okay. So here's all those trades again. And then here is our offer. Earnings Edge newsletter. We do a newsletter for this. We generate it. It comes out every Monday morning. I generate it Sunday night. It comes out Monday mornings. It has a trade in it. It's kind of self-service, okay? But you can join here. No charge for this, okay? We send this newsletter out for free at ewotrader.com/earnings _club_TC for Traders Corner. That is how to get on the list for earnings, earnings newsletter. You can join the earnings call to tell you how to get on the earnings call, and also for the offer that we're going to be making here soon, probably in a week or two, about Earnings Club. And you're not going to believe the price that we're going to offer on that. Okay. One trade a week is what Earnings Club will be. One trade a week. And that's what was generating those numbers that you saw. One trade a week. So that's my time for today. I appreciate all your attention. I enjoy being here at Traders Corner, and everyone have a great day.
Hey, thank you so much, Jeff. Another outstanding insight and great presentation. And thank you for sharing your link. I'm going to repost it here as well, because I think it might have only posted to some of us, not all of us.
Okay. I appreciate that. Thank
You're
you.
welcome.
ewotrader.com /earnings _club_TC.
All right.
And
Yeah,
again,
I
no
just put in the offer there. Thank you so much, Jeff. Thanks for being here today. And thank you for your great presentation. We appreciate having you here today.
Okay. Thanks a lot. I appreciate it. Take care.
Thank
Bye-bye.
you. You too. Next up is Hima Reddy of Hima Reddy Trading. Hima, let
Hi
me just.
there, Anthony.
Yeah, how are you? I just
Good.
gotta
How are you? Good. I just turned my mic on, so you just can clue me into when I can share, etc.
Oh, you should be able to share.
Oh, okay, great.
Hima is a veteran Wall Street analyst and trader with over 26 years of experience and is widely recognized for simplifying market analysis and identifying major market moves. Today, she'll be presenting speed trading, how I break through limits and get into the consistent profit zone. During this session, Hima will discuss predicting market turns, identifying trend continuation opportunities, and simplifying charts and indicators for more effective trading. So please, everyone, welcome Hima Reddy.
Hi, thank you so much for the introduction. And I just want to make sure I get my housekeeping bearings here for a second, Anthony. So am I right that I have till about 12:45 Eastern?
Yeah, that's correct.
Okay. And then I have not been in GoToWebinar in a minute. So if am I able to see and interact with the attendees that are here? Like if they type something, will I see it in the chat, or is it just us?
You should be able to, but okay, let me make you an organizer, and then
Yeah, that. All right. So it looks like I was made an organizer. So whoever's here listening to me live, can you just type a Y in the chat so I know you can hear me and see my screen? I'm a very interactive presenter, but hey, if y'all are kind of just like listening half, taking your lunch break, don't worry, you'll still learn a lot too. All right. I am not sure where to look for this, so I'm not going to stress about it too much. Oh, there it is. Thanks, David. Appreciate it. Okay, I think I see it in the questions panel here, and we'll dive in. So awesome. Let me get myself organized on the screen. In the meantime, I would like to know in the chat, where are you trading from? I'm in Austin, Texas, and today it's a nice, cool, like low 80s, and I think it's hilarious that everyone in the UK is freaking out because it's like 85 Fahrenheit. But then again, they're not built for it. Us in Texas, this is what we are accustomed to. Okay. All right. Awesome. Well, let's dive in, because no matter where you are trading from, you are here for speed trading, how I break through limits and get into the consistent profit zone. Now, in a moment, you're about to discover the one squiggly line to add to your analysis for a heads up on major market turns. Even in volatile or unpredictable conditions where it seems like the trend turns on you out of nowhere, you're about to discover a simple way to take your existing chart setup and identify reliable trade setups that maximize risk reward, whether you trade for the very short term or the long haul. Now, I promise that by the end of our time today, you'll know everything you need to know on how to squeeze more out of the price action you're already staring at by using the speed behind the directional moves and be able to uncover trade setups that you can reliably take over and over again. Because here's the problem, right? Many traders aren't realizing that being on top of the pace of the price moves is vital to entering and exiting most efficiently. It's like surfing and not paying attention to the next wave sneaking up behind you. That's a recipe for a wipeout. Many traders are assuming that they need to get better at studying the direct price action, the Fibonacci ratios, Elliott wave, or Gann patterns like I do. And sure, there's a time and place for that. But first, they need to use the speed behind the moves because that's what will make all those patterns work even better. No one's ever shown them how to do that until now, and I'm here to share my secrets with you because you're ready to take action now. So notice I'm going to be absolutely upfront and transparent with you today. I'm going to show you current case studies and figures today. As you all know, trading involves risk, and it's your responsibility to evaluate any information, opinion, advice, or other content contained within my presentation. Your results are up to you, okay? I can't predict them. I'm not going to predict them. Anyone who says they can is lying to you. I don't know your trading plan, your account size, or your markets. I can only show you what's working for myself and others. Your success is up to you. So who am I and why listen to me, right? Well, I'm Hima Reddy, and I'm a chartered market technician, a veteran Wall Street analyst, and the leading published expert on the trading methods of W.D. Gann, a prolific trader from the early 1900s. I'm known for my expert ability to take the complex and make it simple, so that thousands of traders have been deploying my training that I've shared over the past 26 plus years of education and private market analysis. Now, it all began when I was learning futures trading from my dad, starting as a teenager. I came to recognize three main approaches to my analysis, a trifecta. It starts with price action, the movement of a security's price over time, and market timing, also known as forecasting, providing precise targets to manage my trades. But then the pace of the markets changed. I don't know if any of you here were trading before COVID versus after, but now the market picks up pace even more when there's any uncertainty looming. Hello, war in Iran, right? Strait of Hormuz. So it feels like every day now there's something that's kind of creating those market jitters. So what's helped smooth the volatile action, while still being a leading indicator, is the speed of the market, also known as momentum. And I started to blend what I had learned from Gann's works, guided by my late father, to squeeze even more out of traditional indicators, bringing them into a new way modern traders look at momentum every moment. And this is all detailed in my 4 zones RSI coverage system that has a major new 2026 update. And you'll immediately notice how much easier it is to make money trading. And I'll show you that a little later. So what's different about the 4 zones RSI coverage system? This system gives you my Jedi momentum indicator and Gann-inspired techniques that help you efficiently trade turns and large moves in any market on any time frame. But more on that in a bit. First, we're going to dive right in. So trading momentum can be easy, but first you need to understand how it works. A Formula One car racing track will have you understanding momentum in no time. So I'm just checking in on my chat here to see if I've got you guys engaging the chat. If not, again, no worries. I know how to carry the show by myself. Okay, so we've got a Q&A area and we've got the chat. Looks like you all were in the Q&A. Is that right? Okay, sounds good. Let's dive in. So here we are heading to the racetrack. Okay, so let's put ourselves in this driver's seat. It's the starting line of the track and that hot little red car. Okay, you rev up your engine and you go. Now, pick up speed really quickly or accelerate on the straight runs. You see a turn coming and you prepare accordingly by easing off the gas to slow down, even if it's just a little bit. So you can have more control as the car whips to the other side of the turn. Then after you make the turn and the road straightens out again, you hit the accelerator once more. Are you getting the idea of how you'd accelerate and decelerate on this track? Can you guys type a Y for me in the Q&A if you see that? Okay, because this is all the basics you need to translate over to understanding momentum. So we're going to take this track, we're going to bring it over to our stock charts, looking down from the helicopter and getting that point of view. So when you do this, the racetrack becomes price as you see it on your stock charts, with price on the right axis and time on the bottom axis, right? And then important piece of data I talked about, the speed of the market, it's generally plotted underneath, and it's from a category of indicators called momentum. Now, momentum refers to the speed at which the price is changing. So when prices are rising, you've got upward momentum that's improving, and that upward momentum generally begins to slow down and form a peak, like reaching the top of a mountain before price does. Okay, this makes momentum a leading indicator. Okay, it can give you a heads up on a price turn before it happens. Same for falling prices, right? There's falling momentum that's becoming a more and more powerful force, but when a price bottom is approaching, you usually see momentum bottom first. Therefore, momentum indicators can warn you about hidden strength or weakness, giving you a heads up, especially when it comes to potential market turns. So understanding the speed or momentum of the market action helps boost your trading results beyond just analyzing price or time alone. Now, you might be thinking, great, I'll just go look up a momentum indicator on my charting software. I'm sure I can figure that out and then drop it down, easy peasy, right? But here's the catch. The study of momentum, it's been around for a long time. And there are many indicators that have been developed. I mean, this is what one might say is an exhaustive list. But really, folks are tinkering all the time, especially now with AI, trying to find that next holy grail. So the list is never going to end. So which one do you use and how do you use it? Well, just like the car racing track got you understanding momentum, the speed of the market, I'm going to bring in another real world scenario to show you the one indicator that rules them all. We're going to dive into that indicator now, but first let me share results with you from our trading family. Hima, I value your insights. Your momentum indicator is an integral part of what I've put together. I believe I'm ready to go from paper to live trading, said Jim. All right. Now that we've made momentum easy to understand, in a moment, I'm going to show you how you can make money trading momentum. I'm going to let you peek behind the scenes of my trading and analysis and show you how momentum moves through markets that you know using my special Jedi indicator. So we're going to hit the football field, okay? And the team of our house is the Green Bay Packers. They have many rivals. Let's pick the Chicago Bears. So in the game of football, the team is just trying to cross the other team's defense to get to the end zone. Remember that word, zone. The same if the Bears have the ball, right? They're trying to get through the Packers defense. Now, traditional American football has a field that's 100 yards between end zones. So just remember that 100 and the word zone, okay? So let's take that back to momentum. We're going to turn the football field on its head. We're going to drop it down to where that momentum subchart would have been and look at it together, okay? So 0 to 100. Now, just like with football, there are momentum indicators that are also bound from 0 to 100, the exact same numbers. So in that big list, there's a couple here, and we're going to focus in on one, the relative strength index. Now, here we have E-mini S&P 500 futures action, an excerpt from earlier this year. It's what I still analyze and trade personally today. What I'm about to show you applies to anything. I know this is the stock and option summit, okay, but I lean towards futures, so that's where a lot of my examples are going to be from. Now, down below, I plotted the relative strength index, the traditional one, and I have the little football field for reference. So the RSI was first designed to give traders a heads up to stay out of the way on sideways markets so you could protect your capital and not get caught in the chop, okay? But it has challenges in trending environments. So for example, since this is mostly an uptrend that I'm showing here, overbought is above 70, right? This is a pretty standard arrangement and sell signals live here. But the problem is if in your strong price move, then at this instance here in pink or this one, you would have been in this sell mode, even though there was more upside. And you may have left profits on the table or worse, tried to take the top of the market. On the flip side, the traditional RSI enters oversold territory below 30, buy signals live there, okay? But if you're in a strong price trend, you're never even going to get a signal. You would have missed all these 3 blue arrows, okay? As opportunities to go long because you were waiting for a condition that wasn't going to happen in a bull market. So here is the twist that gives you a whole new way to trade this squiggly line. So remember the Bears from our football? Remember the 0 to 100 that the Bears want to get through to get to their end zone? Well, it's the same for the market bears. They want to push prices lower. So let me introduce to you the RSI power zones. With this twist on the traditional RSI indicator, you now have 4 distinct zones, okay? It's not just general overbought and oversold anymore. So in uptrends in price, the RSI power zones show that the RSI moves from this bull support power zone, this lower green neon, to the bull resistance power zone, this upper green neon, okay? And we'll look at how it reacts to the red zones as well. Now, I call these bull support and bull resistance because I think of them the same way I think of price action, right? A floor beneath or a ceiling above. So let's go ahead and look at this on some markets so that you can kind of get to know it and show you my 3 steps to how you actually trade it. Now, here's all 4 of the zones overlaid on a traditional RSI. And again, I'm going to have you getting to know it so that you can incorporate this into your trading. And you don't have to take my word for it that it all works. Here's what just some of our members say about the RSI after they get to use it. I install the RSI Power Zones indicator, and it's just amazing how accurate it is on all markets. It actually gave advance warning before the price moves, said David. Okay. Now, the exact numbers and specifics, they're all in the system, which I'll talk about a little later. But what I want you to see here now is that you can use momentum indicators and trending conditions and not the way they're originally designed, which is just for sideways trends. So here's a list of a variety of markets and timeframes. We're going to look at a commodity on a daily chart, okay? So here we have these 4 zones on the RSI, and this is COMEX gold futures, just an excerpt from earlier this year. Now I want you to look at the bear support power zone, bull support power zone, bear resistance power zone, and bull resistance power zone, okay? The space between the 2 lines is the zone. So the space between the 2 green, space between the 2 red, etc. Now let's just watch this action as it unfolded and see what we have. So early on this chart, there was a trough. So same terminology, right? Trough or peak in the bull support power zone. Its location was between the 2 lower green lines. From there, gold didn't rocket higher, okay? It had a few more troughs it formed. But the one here on August 19th, it coincided with a bullish pattern. And we're going to talk more about pattern setups in a moment. The gold futures traded higher from there, with the RSI extending into the bull resistance power zone. So can you see how this would have helped you stay long and bullish and not get spooked out just because the traditional RSI got overbought? Awesome, right? Suddenly you're now trading the whole field, not just one single overbought or oversold level. Now gold futures continued higher, and the RSI continued higher until there was what I call a disconnect between price and momentum, which we'll explore again more in a moment. Futures corrected lower, and the RSI moved back to the bull support. So green to green to green, okay? That's the most basic way that it functions for you. Then there was another journey higher, and again, it extended into the upper green zone. Like, this is so important because one of the biggest ways to boost your trading profits is to ride the price trends until they change. In our current market conditions, markets are up, and it's very tempting to want to pick the top, but you'll make a lot more money if you just keep riding the bull wave, buying the dips until you see true signs that there's a change ahead. So here's another example. This is an intraday chart, okay? E-mini futures on a 5-minute time frame. Now, this particular example, I'm showing you after a gap down. There was a news-driven gap down, and this is what it looked like on the E-mini NASDAQ futures, okay? Traded lower, RSI went into the bear support zone, 2 lower red lines, recovered to bear resistance while price still stayed lower. And then pressure from the bear resistance power zone continued to persist as the New York early hours unfolded. So there's already this set of opportunities to trade short if you were in Europe or Asia and trading this market, okay? So I'm showing you not only for a typical, hey, New York day trader situation, but others as well. So all these peaks were added opportunities when you apply the RSI power zones. Now, here's the thing. The zones are extremely helpful around expected news, unexpected news, regular boring market days, but it's not just about trading between the green and red zones, okay? There are pattern setups that appear that you can use to enter and exit, and I want to talk about those here in a moment. So can you see how looking at the RSI power zones on the E-mini NASDAQ at this time may have better helped you navigate trades and NQ or markets related to it? Okay, awesome. So you're seeing the benefit like Shanti, who sent us many charts where she was able to make winning trades using the RSI power zones. Here's just one of them. She said, just wanted to let you know that the RSI works well with Forex. Today, I made over 600 on Euro USD on the hourly chart. All right, so now you're getting it. So here on the next slide, I'm going to give you my 3 steps using RSI power zones to find great trade setups, okay? This is actual setups that I use and share with my trading family. So at the end of the slide, you may want to take a screenshot or a photo and have it by your desk. So step 1, review the chart and assess the price trend. Now, this has been a momentum talk this whole time. Why am I talking about price? Because price is king. Price is the source of data from which the momentum is even derived, okay? So you'll benefit more from trading momentum when you're clear on the price trend. And when you make this assessment, you have three choices: uptrend, downtrend, or sideways. And yes, recognizing a sideways trend is valuable because it allows you to be ready for the next move when the breakout occurs. Step 2, evaluate the RSI power zone's movement. This is specifically looking at the RSI value relative to the 4 power zones. Okay, each zone has a distinctive upper and lower border, and there are 4 total zones. So you want to look at whether the RSI is in a specific zone, moving into or out of a specific zone, or both. Step 3, determine the presence of a pattern setup between price and momentum. And usually the best setups come from when momentum and price are not connecting, okay? They're not vibing together. That's usually an opportunity that we can take advantage of for profit. All right, so you've got your 3 steps to using RSI power zones to identify trade setups. I'm going to repeat these steps. We're going to do a couple on my slide examples, and we're going to look at the live markets for a few minutes, and then you're going to have them down pat, okay? So let's check in. Let's look at a micro commodity future on a 15-minute time frame. Mix it up a little bit, time frames wise, right? So this is an expert of silver micro futures. And again, we're going to look at this in stocks in a moment. But here we have a piece of action, and step 1 is review the chart and assess the price trend. We have lower highs and lower lows, so this is a downtrend. Step 2, evaluate the RSI power zone's movement. Now, what you want to do is look at the very end of the squiggly line and determine what it's been doing. Okay, where's it been hanging out? Where is it coming back from or revisiting? So here, with my trained eye, which you'll eventually have when you dig into the RSI power zones, I can see that it is recovering from bear support, right? It went all the way down, it even went technically lower than the bear support power zone, and is attempting to stay higher. So most traders would look at this and say, well, we went from bear support to bear resistance, bear support. Okay, I should just keep looking for sells, short opportunities, right? But there's a third step. Determine the presence of a pattern setup between price and momentum. Now here, there was a disconnect between price and momentum. When I say disconnect, it means they were not moving together the way they're designed to. And that creates a trading opportunity. So I defined this in full in the system. Here, I'm just going to show you the result that unfolded. Boom, look at that move, okay? It would have been the perfect time to stop selling and start paying attention to opportunities to go long. So in this particular example, that's from 74.965 on silver micro futures to 83.190, where the RSI, look, extended into bull resistance. And that price section alone would have provided a trading move where you could have gotten a piece of the $8,225 size, okay? That's if you just trade even one contract and it's over 2.5 days. So short-term swing trade opportunity using intraday charts to dial in. Like here it is all together. And I have a whole training that gets into RSI power zones for true mastery. Okay, and I'll show you that signal in session number 2 because I cannot teach you everything you need to know here within 45 minutes. It would do you a disservice. It would shoot you in the retirement. Yes, I said shoot you in the retirement. Money isn't just money. It's the blood, sweat, and tears that it took you to make it. And you can't afford to lose any of it. I'm here to help you maximize it. And of course, I can't teach you everything that I've learned in 26 years in 45 minutes. So warning, don't go doing this at home without help. After all, that's what brought you here today. If you could do this without help, you wouldn't be here. So in a moment, I'm going to show you what you've been missing, and then we can look at how I can teach you more in depth. Making sense? All right, let's keep going here. So I have another example, and then we're going to look at the live chart for a moment. 3-minute chart. Like I said, I'm a futures gal, and even the S&P 500 futures on a 3-minute chart is something I look at all the time. Now, look at this here, okay? Again, pre-market conditions are very important when you're trading intraday and trading futures. They are also helpful to pay attention when you're trading stocks, when there's an earnings release so that you know where things are landing in the off session. But let's just look at this example here. Review the chart and assess the price trend. I think it's pretty easy to see that this is an uptrend. Sweet. Evaluate the RSI power zone's reading. At this time, what was the black squiggly line doing? Yes, it was capping in the bear resistance power zone, right? It's turning lower. So you're really just looking at where has it journeyed from and where is it currently. Step 3, determine the presence of an entry signal between price and momentum. Now, there was a pattern showing a disconnect between price and momentum, warning that this uptrend was losing steam. And here, on that move is what unfolded. I know, so dramatic. Well, first there was an initial decline, okay, from 7004 to 6997.5. If you trade the ES, you know 1 point is $50, $325 drop. But what's even more helpful is that using the RSI power zones, you've been able to literally see this trend shift and be ready for the opportunity that followed, where the market recovered, but it capped again in the bear resistance power zone, producing another high, this time at 7004.25, the beginning of the green arrow, with multiple moves lower past the market open down to 6960.5, producing another $2,187.50 decline. So here is this particular example altogether. And again, I have a whole training that dives into all 4 of the RSI power zones, and I'll give you that signal in the system. I'm just showing you here what you didn't know that you didn't know, okay? The trading can be simple and you follow the expert. So here for a moment, we're going to go over to my live charts. This is my to the charts best voice. And I'm just going to pull up my TradeStation screens over this. So you should see that now. This is your opportunity. You guys are a little quiet today, which is fine. If you have a ticker you want to look at, drop it in the Q&A or drop it in the chat. If not, then I'll pick markets that I'm going to look at. But what I want to do is show you how this works on the markets you actually trade, okay? So I'll go ahead and just start with looking at tickers that came in this week's episode of my free trading show that I do on Tuesdays. It's called Ticker Request Live. So here's a list, okay? So I'm just going to start with NVIDIA. NVIDIA has had a beautiful, like nice run up, okay? And I want you to notice how on the May 4th low, it held just above the bull support power zone. So if you were watching NVIDIA in this whole massive consolidation, and then there was a breakout, and on the pullback, you were waiting for oversold 30, you wouldn't have gotten it, okay? So that's why it's important for you to see how when there's a strong move, you're able to use the RSI power zones to take advantage. All right, how about Tesla? I'm just going to go to some of the popular names on this list. Now, don't worry about all the other markings. Okay, they pertain to some other types of analysis I do, because remember, I use price, forecasting, and momentum. But look at this one right here. So Tesla started to have a disconnect between price and momentum back on April 8th, started to turn higher, change the trend, and we have now had 2 buy opportunities since then. Both of them in the bull support power zone. So here you can see on April 29th, here you can see on May 19th. Pretty cool, right? So simply just having the RSI power zones on your chart helps you see the trend more clearly. And then on top of that, there might be opportunities where there's a disconnect between price and momentum. Let's look at Palantir. Again, since this is a stocks and options event. All right, so now I'm just going to squish up the history. I'm going to change the time frame. I'm going to go to weekly chart, okay? Because you can use the RSI power zones on higher time frame charts to what I call get a better perspective. So whether you trade Palantir all the time, or it shows up in a scanner result, right? Or they have earnings coming up and you want to monitor, don't be afraid of going to the higher time frame charts. The best part about RSI power zones is the settings don't change with your time frame. So you can be here on a weekly chart and see how beautifully it peaked. It actually had a nice disconnect between price and momentum. It was defensive setup, meaning back here, if you were long, this was your warning to take profits, which was super helpful, right? Because there was a deep pullback. But look at where it lifted up from the bull support power zone, the 2 lower green lines, and sailed away, okay? So the sense of how the RSI power zones move with price, you should be really getting here. Let's look at Lilly. Again, these are not tickers I came queued up with. These were ones my own traders asked me about at my show on Tuesday. All right, another weekly chart. This had an actual great disconnect between price and momentum for a bullish setup. It was more evident on the daily chart. Now, here's the thing. Not every setup is go, 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 and let's get longer, let's get short. Sometimes the setups are better because they're defensive, okay? Because they tell you to protect your profits. And here, there was a defensive setup that if you were short on Lilly or had a bearish option strategy, you might want to start taking profits and get out, okay? So this is currently sailing up higher. So I don't want you to think that just because the RSI power zones exist, it guarantees anything, okay? And everything I'm sharing here is my opinion, right? It's not actual market advice. My opinion is that Lilly will keep rising with the RSI moving into the bull resistance power zone. We also want to see the price action break above the highs from January. Okay. All right, let's go to Roku down here. So Roku here, oh, this had a good one. So this had a pattern between price and momentum from May 19th to April 28th, where you can actually calculate an upside target. So that's the other cool thing about the RSI power zones. When you understand all the pattern setups, and there's 6 main ones, okay? I don't overwhelm you all. 6 main ones when you're getting started. 2 of them, one bearish, one bullish, actually allow you to calculate an upside target, okay? So I demonstrate that. I walk through that when I have coaching with students, but I just want you to see that that exists. All right, let's look at a couple more. Let's go to INTU, so Intuit, okay? So this is a bearish market. And let me show you something, guys. This bearish market, right? Trends change. They don't stay one way forever. So check it out. Up here, if you were looking at the chart here at the, about a year ago, okay, June 6, 2025, you're like, oh, strong market up in the bull resistance power zone. But the bull resistance power zone is kind of like the party slowing down. It's not over. Nobody's kicking you out yet, but nobody's serving food anymore. The DJ's playing slower tunes. Okay, that's kind of what this is akin to. So price still kept going up, but not by much. See, it went up, but not on a percentage wise much more. And then it actually formed a big disconnect between price and momentum. So you could have warned you about trailing up stops. Then it shifted, and the first clue was coming down to the bear support power zone. Guess what? After that, it recovered, but only to bear resistance. This right here, when it recovered to about 700, this is when it's like, oh, the tune is changing. This is a basement party now. This isn't on the penthouse rooftop, okay? This is a bearish party. And then everything after that, bear resistance, bear support, bear resistance, bear resistance. Like it kept consolidating, but only able to get above bear resistance, or not able to get above the 2 upper red lines. And look at where we are now. How many times would the RSI power zones have been helpful to stay short or go short on Intuit? So many. And this is an expensive stock. So this is something where if you use option strategies, right, you can take advantage of the movement without just having to short or take advantage of the shares outright. All right. Google, let's look at a MAG 7, okay? So right now, Google came up, bull resistance power zone. That alone was super helpful. But then when you combine it with the existence of like a candlestick, okay? So I still used price action. And I love a good old candlestick pattern. Here we have what's a shooting star, okay? So shooting star plus a disconnect between price and momentum suggesting there might be a slowdown. If you were looking to take profits, that would have given you confidence to do so. And then you'd just be chilling, waiting here, okay? That's if you're a swing trader. If you're doing something intraday on this, that would have been your warning to maybe stop looking at bullish strategies and options, okay? Awesome. So let's look back on the list and see if there are any others. Let's look at SanDisk, okay? Again, I'm sticking to stocks because of the theme of this event, but you can use this for all kinds of markets and timeframes. I highlighted this here, talked about in the show, another disconnect between price and momentum that allowed you to start protecting profits on longs. RSI is lifting up again. And let me make a point to you here that when there's a strong market, okay, it's not going to always have the black squiggly line, the RSI, relative strength index, get back to bull support. Okay, here you had it get back to bull support back on March 6th. Here you had it get back to bull support March 30th. Okay, so March 6th, March 30th, beautiful. But then the trend started getting stronger. That's why it's not enough to just say, okay, I'll put these RSI power zones on my chart and I'll just trade between the green and the red. No, because they won't be the only times that the indicator is actionable. There will be pattern setups along the way. And in fact, on this one, there is a larger one. It's a little more complex, but it's still within the realm of what I teach in the full system. And this is what I see. Okay, so you get to follow along here. Based on the data points I just highlighted in yellow, you could have used price to calculate, you could use momentum to calculate an upside target on price. So again, this is one of the 6 setups that I get into deep in the system. But I hope this was a helpful look at markets trading right now, showing you how the RSI power zones is moving. Some of them have set up, some don't, but this kind of opportunity comes about a lot. All right. So I'm super excited to be sharing all this with you today because I'm very passionate about the work I do to provide traders with the best analysis and education to trade the markets so you can take control of your financial freedom and live the life you and your family deserve. So by now, you know that power zones and the RSI can really boost your trading because whether you're new to studying momentum or you've been doing it for years, this approach can really help you extract more profits from the markets and be more consistent. And consistent profits is what it's all about, right? Making sense? Do you want more consistent profits in your trading? You should all be nodding your head yes. All right, awesome. So let me ask you, did I provide value for you today? Did you learn? Are you ready for more? Then it's time to fully master RSI power zones. And here's the thing. This can boost your trading for years to come once you learn how to deploy it effectively. Like Henry, okay? Henry is just one of the trade successes. And he wrote in about this particular trade. He's an Australian trader and was trading the CFDs and using the RSI power zones back in November 2017. Okay, I've been in trading education for 10 years formally. So this is one chart he shared. Now, here's another message from the same exact trader, Henry, over 3 years later. He was still profitable using these techniques. So what you've seen is not a one and done. Okay, it's something you can apply for the rest of your trading career successfully. So will you be our next success story? Making sense? Are you getting this? How simple it can be to trade when you have help? Great. So imagine and picture this. You finally able to turn your trading around and make money with trading and live the lifestyle you've always wanted. Giving back to your community the ways you've always wanted to. Sounds great, right? Spending all the time you want with your kids and grandkids. Great. So here is what I have got for you. This is the 4 zones RSI coverage system. Newly updated. And before I give you this opportunity, let me show you the features and benefits it has for you. So rapid results. Okay, you can learn to use the system in as fast as 60 minutes and you'll be up and running. It's perfect for any account size, $5,000 or $10,000 or $100,000 or $1 million or more. You can trade this. You pinpoint your trades faster, so it takes less time. Get more profit because it's perfect to add to whatever you're doing right now. Perfect for beginners, so easy that anyone can do it. And perfect for experts to diversify their accounts because the 4 zones RSI coverage system gives you all this. But first, who is this not for? This is not for those who are trying to get rich quick. Like anything worthwhile in life, trading takes consistent work to get consistent returns. So if you're here to play the slot machines, this is not for you. So who is this for? This is for those who are ready to analyze the markets like the expert to optimize and boost their trading. This is for those who want to diversify what they're already doing for additional profits. And this is for those who are ready to step up and take action for their own financial freedom. Since you're still sitting here with me, you're taking the time to learn to boost your trading, you're ready to take action now because it's time to remember you forgot to remember. You can let it be easy. So in my 4 zones RSI coverage system, I give you my 26 plus years experience on a silver platter, and it's neatly laid out. Brand new video tutorials here in 2026. We updated them in January, and it starts with the foundations to price and momentum so you can make the most of the RSI power zones. I also give you my top RSI power zones bull pattern setups from years of study and observation with various real-world examples across multiple markets and timeframes like we did here today. And I do the same with the bearish pattern setups. And for both, I walk you through the best entries, exit, and protective stop strategy, the exact approach so you can extract the most profit from the market using RSI power zones. Every video tutorial is available to review over and over. Now, to make it even easier for you, you're also getting my set of cheat sheets that you can instantly download to use as a handy guide to keep your trading simple and not miss a step. Now, this will include complete pattern snapshots, including exact entry, exit, and stop rules. Because missing a step can be the difference between growing or blowing your account. Because when you're executing your trades, especially from a new system, it's important to get it right. So you'll use these cheat sheets to help you execute what you're learning in the videos. Now, you're going to love this, okay? This is the very thing everyone asks me for, but I got to get it specially coded for you. I'm also giving you the RSI Power Zones indicator on a variety of platforms. Okay, Wealth Charts, InSign, eSignal, Metastock, MetaTrader 4, MetaTrader 5, NinjaTrader, Sayre Chart, Thinkorswim, Trade Navigator, TradeStation, TradingView. You get the indicator for all of them. So if you use one platform, great, you plug it in. If you use 2 or if you're in the middle of switching, you have access to all of these for life. So I'm making sure you have what you need so that you can see the zones on your charts. And I've included everything to set you up for success, right? The patterns, the cheat sheets, the indicator. Only thing is you might still need help from me personally. So would you like that? Would you like if I hopped in the computer with you and showed you live how it's done and answered your questions right there on the spot? Okay, then you're also going to get me. Monthly live group coaching. Once a month, we're going to get together online with me and you're going to spend an hour and we're going to look over my shoulder as I demonstrate trade setups on current markets and answer your questions. I'm also going to help you analyze your personal trades. Okay, this is where you can show up and tell me everything going on with the trade you have going on right now, and I will personally analyze it right there for you. It's like getting a call from me and my team every month, giving you a behind the scenes rundown of everything that's moving the needle the most right now, and then showing you how to model it in your trading fast. And to really make it useful, you're going to get the recordings of the session uploaded to your members area. So if you're not able to attend for any reason, you can watch the replay, or if you did attend, you can go back and get the lessons over and over again. Okay, the only other way to have access to this information would be if you worked in my office shoulder to shoulder with me every day. Now you can see that I've truly built in everything you need to boost your trading with the 4 Zones RSI coverage system. The 4 Zones RSI coverage system with the on-demand video tutorials where I take you by the hand through how to best trade with the RSI power zones is valued at $1,997. The cheat sheets that you can use as a daily trading guide to learn the system faster and more easily is valued at $197. The RSI Power Zones indicator available for the most popular trading platforms is valued at $497. And live monthly group coaching with me, which has no end date, okay, is lifetime access to get you unstuck and even analyze your personal tickers is really priceless. But I'm valuing it at $797 because I easily charge $1,500 an hour for my personal coaching. So altogether, the 4 Zones RSI coverage system is a value of $3,488, and it's worth every penny. And let me ask you, if all this system did for you is help you trade market turns more confidently, even in volatile conditions, would it be worth it? Yes. If all the system did for you is help you finally make money trading with momentum, would it be worth it? Absolutely. If all the system did for you is help you make so much money with trading that you can quit your job, travel the world, and live the lifestyle you deserve, would it be worth the investment? Of course. The total value of the system is $3,488 because I want to make an investment in your future, because I want you to see a return on your investment fast. For a limited time, I'm making the system available for one low, easy investment of just $297 for a lifetime access. So you can visit himareddy.com/corner, because our host today, our Traders Corner, to get started. Now, when you head to himareddy.com/corner and invest in the system today, I'm going to give you all this because I want to see you finally succeed in your trading. So I'm giving you our personal 100% satisfaction buyback guarantee. Okay, take action now. Use the complete package for 90 days. That's 3 months. Wear the tires off the system. And if you aren't 100% satisfied with your investment, then I'll give you your money back as my gift to you. I want you to be 150% satisfied with the 4 Zones RSI coverage system. After all, my clients tend to stick around a long time and become my friends too. So follow the whole system, okay? I want you to get out there, treat it like a rental car, put it through its paces, drive it all over the place, wear the tires off of it. And if you don't feel you've gotten far more than your investment, then I'll hop on the phone with you, personally work with you. And what I really want is for you to be totally satisfied, and that's what we guarantee. If that still hasn't happened, then I'll give you your money back. Simple as that. Again, the total value of the system is over $3,488, and for a limited time, at this amazing stock and options investor summit hosted by our friends at Traders Corner, I'm giving it to you for the simple, easy investment of just $297. So you can go ahead and take action now. You can visit himareddy.com/corner to sign up. And let me show you exactly what happens when you join us, okay? You're going to get your login info sent right to you. You'll have your video trainings available instantly and your cheat sheets ready for download. Now, I'm also going to give you something to help you make the most of it all out of gate, which is our quick start guide. I literally personally went in the portal and we're like, what 3 steps does a person need to dive in? You just need your cheat sheets, your indicator download, and you need to know how to use the portal. It takes 2 minutes, okay? All of this helps you get set up. Now, if you're new to my products or new to my portals for my courses, you may want to dive deeper. We have a separate new members quick start guide. Just take a few extra minutes if you like. Now, today I showed you examples of RSI power zones at work, and it's important for you to know how to do the analysis on your own charts. So as another bonus, I'm giving you Power Zones Chartmaster training with Hima, okay? In this, it's on demand. I get into exactly how I set up my charts. I give you directives so that you can translate it to any charting software. I demonstrate on TradeStation because that's what I use. And this is, again, on demand now and ready for you to watch in your portal. The Rapid Results Quick Start Guide to get you using the system right away to boost your trading fast is valued at $197. The Power Zones Chartmaster to get you fully up and running on your screens is valued at $297. So with these added bonuses, the total value of the system is over $3,982. And for today's event, I'm giving it to you for one simple, easy investment of only $297 for lifetime access. So go ahead and take action now. And I'm looking forward to seeing you in there. And let me just ask you this quick. Are you worth the investment? Is your family worth it? Take action, boost your trading now. I'll see you on the inside. You can visit himaready.com/corner to join. This is available until 11:59 p.m. Eastern tonight, Thursday, May 28th. I appreciate you giving your attention here. Look forward to seeing you in the 4 Zones RSI coverage system. And I'll hand it back to our host.
All right. Thank you, Hima. Fantastic information and excellent market insight. And don't forget to click on Hima's promotional link. It's in the chat there. It's himaready.com/corner. Thank you so much, Hima.
Thanks. Take care.
Thank you. You too. All right. And moving on to our next presenter. We have our next presenter is Dr. Daniel Sinnig of Trading Indicators. Daniel is a trader, a software engineer, and globally recognized expert in trading indicators, algorithmic systems, and automated trading technologies. His presentation today is Day Trading Decoded, where high probability setups take shape. Daniel will discuss identifying hidden liquidity zones, structured low risk setups, and trading rules designed to improve consistency and execution. Everyone, please welcome Dr. Daniel Sinnig.
Hey guys, how's it going? How's everyone enjoying the conference so far? Great talk by Hima, by the way. I know her for a long time. She's a great person. And I'm glad to be here. And yeah, and I want to share something with you, which but before we get into this, Andrew, can you confirm that you can hear and potentially also see me? And that my screen is showing? Hope it is. I believe it is. I'm just going to give this the benefit of the doubt. I hope everybody can see me, and let's get started. So today's topic is a bit different, a bit deviating from the theme of this conference. It's about day trading decoded, how and where high probability setups take shape. But before we start about day trading, because I always like to talk about shorter term trades, because to me they're more exciting. There's something you can conclude within a couple of minutes, perhaps hours. You don't have to wait around too long to conclude this trade. But before I continue with this, what I will show you today is equally applicable to stocks trading, to longer term trading, to swing trading, to options trading. So there's no difference. But I want to show you the smaller time frames today because ideally we actually want to execute some trades as well in this session. If this sounds good, let's get started. So what I'm going to show you today for the very first time, because I used to only use it for myself and on my own, is my trading edge, my day trading edge. The setup which I trade all the time, the setup which has transformed my trading completely. And let me show you how extreme that transformation was. Because back in the day, when I started off trading, my thought about trading was, hey, trading and especially day trading should be something like this. Like where you have multiple screens, a million indicators on your charts, different charts open, and somehow you need to make sense of this setup. This is how I thought trading and especially day trading should look like. You can imagine this kind of setup is extremely complex. It's hard to learn. It's very expensive too. It's not portable at all. You know, Hima talked about traveling and enjoying life and, you know, trading from different places. Well, this kind of setup is very hard to transport. Imagine you have to, put this into a suitcase, bring it to a different location. Impossible. But, this is how I started off. This is what I thought trading should look like. But guess what? I don't trade like this anymore. Now I trade like this. Just one chart, two indicators on the chart, and one laptop. This is how I day trade. This has become my market edge. And this was possible because I use a particular setup, which is quite rare, but it's spottable. It will occur if you monitor multiple symbols. You find it many times a day when it comes to day trading, but also many times a day when you look at the entire stock market, when you swing trade. So it's rare, it's selective, but not too rare that it never occurs. And this setup is possible by using just two indicators, which I combine in a very unique way. And how this setup works, we're going to discover together today. But real quick, before we start, a quick introduction of who I am. You may wonder, hey, who is this guy talking about his special setup, his day trading setup, his strategy? Well, my name is Daniel Sinnig, and I am one of the founders of tradingindicators.com. And as our name suggests, we specialize on creating innovative trading indicators. This is our bread and butter. This is what we've been doing for many, many years, for more than 10 years, for clients all over the world. We've built thousands of trading indicators for clients all over the world. So we really have seen it all. But today, I'm going to show you my two favorite indicators. The indicators, with no exception, which are on every single chart I open. This could be a lower time frame chart. It could be a longer time frame chart. No exception. These two indicators are on every single chart. And how these work together and how these two indicators can be used to spot my day trading or my trading edge, we're going to discover together in this session. Now, real quick, I do need to remind you that trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies and setups discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, with this out of the way, let's get into the topic. Now, first off, I'm going to talk about something theoretical. It's not going to take long, but I think it's important to understand where this particular setup, which gives me my market edge, is coming from. So just a bit of theory. It will give you some context, which I believe is important. Then we're going to talk about my market edge, the particular setup which I trade every single day. I've traded today, I traded yesterday, I traded all the time. And all it takes are two indicators. I'm going to show you what these two indicators are. And then we're going to jump into the live market and see if we can spot the setup and potentially even execute a couple of trades if we can spot it. And of course, at the end, there will be time for Q&A as well. So if you have any questions, please don't be shy. Put your questions into your webinar tool. I'm going to keep an eye on those and I will address those questions as I see fit. All right. So with this, let's get into it. Landmarks on every chart. And this has been a revelation to us because, oftentimes, and you probably have seen this as well, oftentimes chart simply can be unpredictable and sometimes even chaotic, especially when viewed, in quotes, with the naked eye, with nothing on it, with no indicator help on it. Look at this chart here, where an uptrend, initially goes up, but then shortly reverses into a downtrend, only then to reverse once again into an uptrend. Quite chaotic and seemingly no pattern on this chart. But there was one observation which we found in our research lab, which can make sense of even the most chaotic chart. And this revelation was something that we discovered because we have found out that every single chart, it doesn't matter what it is. It could be a 1-minute chart, a 5-minute chart. It could be a daily chart, a stock chart, a futures chart, a crypto chart. It really doesn't matter. Every single chart has so-called landmarks, which are special areas of price, which have forward-looking properties. That's very important because in trading, let's face it, we want to predict what may happen in the future, what is relevant moving forward. This is what trading is all about. We want to predict where and when price will be in the future. And we have found out a technique which will find certain levels of price, certain landmarks of price, which have these forward-looking properties. And if we can estimate where these levels are, we can predict to some degree of certainty how price will react to these levels once price approaches these levels in the future, and we can benefit in the process. This is something we have discovered many years ago, and we have built an indicator around this concept. We're going to see this indicator in just a bit. Now, these landmarks, they have different names, and we're not the first ones out there who discovered that these can exist. But what we discovered is that under circumstances, these levels may have forward-looking properties. So they happened in the past. For example, here, this historical high, this happened in the past. And then many months or perhaps years later, price, like a magnet, is torn back to the level. And this level now acting as resistance. Price will bounce off this level towards lower price levels. And this happens in the future based on a level which was established many months potentially ago. Same thing here, a series of swing lows. Once again, there are certain events in the past which can create these special levels of price. Here, the series of swing lows which happened in the past, but later on in the future, price came back to this level, approached it, could not break it. It's acting as support, and price bounced off this level towards higher price levels. So these levels, they have several names in trading and different names out there. It's not really important how you name them. For example, some people may name them support levels or resistance levels. But what's important is that price in the future may react to these certain levels. For example, when price comes down to support, price will bounce off these levels, cannot go further down. It will bounce off these levels and go to the upside instead. And the same thing for resistance. Price comes into resistance, cannot break it because resistance is called resistance for a reason. Price bounces off this level towards lower price levels. You can see it here. We came up, bounced off, came up, bounced down. Now you may wonder, who is responsible for these magical levels on the chart to which price is reacting in the future to some degree of certainty? Well, it's definitely not us retail traders. I can tell you this. It's the big guys, the big money traders, the institutions, the ones who have the buying power to move the market in that way. But while the big guys are calling the shots, perhaps, we retail traders, we can follow the footprints, we can follow the patterns if we are able to identify where these levels are. And if we can predict how price may react to these levels and find promising trade setups in the process. Now, what I'm going to show you is my market edge now, which is based on that premise. So what is this market edge? I'm going to give you two examples. And it's quite simple. It's quite rare, but it's quite simple. It makes logical sense. What is this market edge? Let's consider the bullish case first. I call this the bullish power bounce setup. What can we see here? Well, we can see that price is coming down from the top. You can see the price is coming down from the top down to this reddish line here. That's a key level spotted by one of our indicators. Price comes down and approaches this level. We call this setup price is approaching support. This red line is a support level. And as you may expect, support may prevent price from moving further down, and instead price may bounce off towards higher price levels under certain circumstances. That's condition number one. Price comes down to support. It approaches support. Condition number two for the bullish power bounce setup is that we have a special event at the candle which approaches this level. You can see it a little bit here, this little shaded area. It's a bit hard to see. You're going to see it better on the chart later on, but it's there. This event is called a liquidity capture event. And it happens if price comes down to a key level and has abnormally high volume. And if this happens, this can be interpreted in a way that, hey, something is up. Somebody else might be interested in the current price level as well and is driving up the volume at this price level. So something is up. And oftentimes, when this event happens, it will increase the odds of actually seeing a bounce rather than a break of the level. So that's condition number two for our bullish power bounce setup. And condition number three is this label here. we are already in a bullish trend. You have heard it before. The trend is your friend. The chances that a trend is going to continue are simply greater than the odds of the trend to reverse. So why not take advantage of this? So ingredient number 3 for our bullish power bound setup is that we are already in a bullish trend, and we have an indicator for this which can identify the trend direction for us. So 3 things are coming together: predicting the same price move, future price move. Price approaches support, which may prevent price from breaking this level and going further down. There is a liquidity capture event, and we are already bullish. These are the 3 ingredients for the bullish power bound setup. Of course, what works for the bullish case also works for the bearish case. Let's see if you can spot the setup here. What do you think it is? I think the easiest ingredient would be this one here. We are bearish. You can see it here. Price is coming down. But within this bearish move, price is approaching this greenish line here. That's a resistance level. Price comes from below towards this greenish line, a resistance level, which may prevent price from going further up. And instead, we may see a bounce to lower price levels. That's condition number 1. Condition number 2, the liquidity capture event, this little shaded area at the candle, which approaches this resistance level. And condition number 3, we are already in a bearish trend. Once again, 3 things are coming together, which all individually predict the same future price move, which is a bearish move off this level here. We are bearish. The trend is your friend. We're betting on the fact that the trend will continue. That's a bearish pattern. We are approaching resistance, which may prevent price from going further up. Instead, when we see a bounce, that's a bearish pattern. And there's this liquidity capture event, a high volume candle. Volume is spiking up at this price level, which oftentimes can be interpreted as, hey, something is up, somebody else might be interested, may find this price level interesting, and perhaps also is betting on the fact that price will go further down, which increases or introduces a bearish bias to the market. So 3 things are coming together, supporting the same future price direction, which is bearish in this case. That's our bearish power bounce. I trade this setup every single day, both from a day trading point of view and from a swing trading point of view. I'm going to show you examples of both cases right now. Let's start with day trading. So where can we spot this setup? Let's look at the last candle here. You can see it here. Price is coming down to this support level. We are on a bullish trend. You can't see it here, but the trend is bullish. There was a label a bit further to the left. And we may predict a price may bounce off this level towards higher price levels. The trade I took recently. It worked. Price actually bounced off. Another example, silver on the 1 minute time frame, silver futures. Where can we spot it? Well, let's check it out. We are bullish. Take my word for it. There was this bullish label here. We came down to this key support level, this reddish line here, and we had this little shaded area here, the liquidity capture event. And look what happened to price. It bounced off this level towards higher price levels. Ethereum, a crypto symbol, Ethereum futures, same thing. We are bullish. Price came down to a key support level, this little shaded area here. Price bounced off this level towards higher price levels. And it goes on and on and on. And I trade this setup every single day, both for futures, but also from a swing trading, stock trading point of view. So many examples of exactly this setup. Here, price is bullish. Take my word for it. We came down to key support, the shaded area, liquidity capture event. We bounced off this level towards higher price levels. All these are tradable. And all it takes are 2 indicators on the chart. What I'm going to show you right now are exactly these 2 indicators, which are on my chart every single time. It doesn't matter what I trade. These indicators are on my chart every time. No exception. Indicator number 1 is called Liquidity IQ, an indicator designed to identify these key levels on your chart, support and resistance, and is able to spot these liquidity capture events, these little shaded areas. These are ingredients 1 and 2 for our power bound setup. And ingredient number 3 comes from this indicator here. It's called MA-Rush. That's our trend indicator. It identifies the prevailing trend direction for you by means of these labels on the chart, either bullish or bearish. And depending on what is the last label printed, It gives you the current trend direction. And as you know now, I always trade with the trend, not against it. That's condition number 3 of my power bounce setup. All right, so before we get review what these indicators do in particular, let's switch over to the charts. I'm going to go over to TradingView right now, and we're going to start with MES. In fact, you know what? This is a stock trading summit. Let's start with some stock trades. I found some really interesting one when the market closed yesterday. And one is called this one here, UGL. That's a double leveraged gold ETF on the daily time frame. Let's see if we can spot the setup that is prevailing right now on this chart. That's the daily time frame, UGL. Okay, what do we see here on the last candle? Let's just look at this together. Well, on the last candle that closed, that was yesterday's candle, we can see we came down to this reddish level here. Guess what this level is? It's labeled here. It's a support level. Price came down from higher price levels down to the support level. Ingredient number 1 of our power bound setup. Ingredient number 2, it's labeled here too. Liquidity capture at the last candle. You can see it here, right there, liquidity capture. Once again, that's this high volume event. Well, as we are approaching a key support level, volume is spiking up. If this happens, we may, or this may increase the chances of actually seeing a bounce rather than a break. And the prevailing trend, guess what it is? And for this, I have to scroll back quite a bit here. The prevailing trend is, of course, this is gold, you know what it is. It's bullish. 3 things are coming together. This is our bullish power bound setup. It works for stocks and ETFs, but also works for futures and other day trading contracts. And look what it says here in our indicator, long bounce. The indicator actually tells you exactly what the prevailing setup is. Let me give you one more example, also from the stock space. CME. We can define alerts for this. I'm going to show you this in the end. So I don't just randomly browse through symbols here. Actually was alerted for these setups. CME Group. All right, what do we see here? Okay, let's once again do our analysis. What do we see? Well, price is coming down from the top to this reddish area here. Okay, what's this? That's a support level. What do we see here on the last completed candle? This one here from yesterday. Liquidity capture event. What is the trend? Go back a little bit further. The trend is bullish. Bullish since September 2024. Once again, our 3 ingredients coming together. And if I was I am a swing trader. What you may consider, of course, that's not trade advice here, potentially looking for a long entry right now, either of options or perhaps a direct investment into the stock itself. Why? Because prices came down to key support. We have a liquidity capture event, and we are long-term bullish with this symbol. These are the setups I am looking for day in and day out, both from a swing trading point of view, from an options trading point of view, but also from a day trading point of view. So let's check out some day trading charts. I'm going to go over here to MES, the S&P Micro Futures on the 15-minute time frame. So I'm going to switch context now. All right. So 15-minute time frame, that's a day trading time frame. Let's see what we can see here. And let's see. So first of all, we can see, okay, our indicator, our trend indicator on the chart here. Let me just introduce this one a little bit more to you. You can see, okay, it shows us these labels. We're bullish, then we became bearish, now we're bullish again. And this gives us our prevailing trend direction. Think of this as your primary filter. You always want to trade with the trend, not against it. That's very simple. As long as we're bullish, we're only looking for long setups. Once we turn bearish, we are looking for short setups if we find some. All right, so that's this indicator. Now the other one is this one here, which prints us these key levels on the chart. Let's see what we would have traded here on this particular time frame. So let's say we are bullish here. Okay, I'm not going to do anything here. We're coming up to resistance. I'm not going to short it. We're bullish. I don't go against the trend. That's fine. There's plenty of fish in the ocean. I don't have to be super aggressive. I only trade with the trend. So even though there's a bounce, yeah, that's fine. I'll skip this trade. We came up again, another bounce. I'm not going to engage because we are bullish. I don't want to short my position here. I stay put all the way until this event here, all the way until yesterday. What happened here? We are bullish. Remember this. Now we came down to support. Now we see a liquidity capture event. It's a little shaded area here. It's a bit hard to see, but believe me, it's there. This is when I jump in, because now everything comes together. Now my three conditions for a long setup are satisfied. This is what I want to trade. So I'm very patient with my trading. I skip all these opportunities here. And if you were more aggressive, these are tradable too. But I just don't trade it. I only trade these high probability events. I'm waiting for everything coming together. Once again, let me repeat. Bullish trend. Down to support, this red line here. And a liquidity capture event. This is when I want to jump in. Okay? All right. So this is on MES, but let's go to smaller time frames even. This is the 50-minute time frame. Let's go MES on the 5-minute time frame. It's going to switch over here. This is 5-minute now. The same indicators on the chart. Let's see what we can spot here. All right, let's go back a little bit further. Starting from here, bearish trend. We're coming down to support, anticipating perhaps a bounce to the upside. Do I take it? No. I'm patient. I'm very patient. I will not take this trade here, even though it was a great trade, but I'm going to skip it because our trend is bearish. I don't want to trade long for as long as we're bearish. Then we're going to come up here. We're approaching this key green level. We have a liquidity capture event. Do I take this trade? Yes, I do. Why? Once again, our three ingredients are coming together now. Bearish label, we're coming up to resistance, this green line here, and we have this liquidity capture event. This is when I want to jump in. This is where I want to pay attention. And this is what my alerts in my trading view are configured for exactly these types of events. Will they work every single time? No, there's no such thing. But in my view, they give you a market edge. And this is the market edge which I exploit the most in my own trading, both from a swing trading point of view, but also from a day trading point of view. Let's change it up one more time. Let's go to M2K, the Russell 2000 futures on the 50-minute time frame. So I'm going to go back to my 50-minute time frame here. I'm going to open up M2K. Let's check it out. What's going on here? All right. What has happened recently? The indicator's loading. Look at this. Beautiful setup this morning at 10:15. I'm pointing to this event here, this little shaded area, as price is coming down to the support level. What has happened here? Well, let's check out the trend first. What's the prevailing trend? Let me go further back. Where can we find it? Bullish. Okay, we are bullish. I'm staying put all the way. I'm not going to short anything here. This would go against the trend. I'm just staying put until where? I'm even going to stay put here. Even though we're coming down to support, there's no liquidity capture event. This event here, this shaded area. Then this morning at 9:45 or 10 o'clock, then I pay attention. Price is coming down to support. We're having this liquidity capture event, and we are bullish to begin with. Our trend is bullish. This is when I want to jump in. This is my setup, and I can find this over and over again. And best of all, you can define alerts for exactly this setup. You can see all my alerts here in my trading view. They are geared towards this setup. I'm going to show you how to configure this in just a bit. Okay, let's do another example. Gold. Let's go to gold. Something that happened recently on the, I believe, the 50-minute time frame. I might be wrong. I didn't write this one down, but let's check it out. What did we see here on gold? All right. So, yeah, perfect. What do we see here? We were bearish, and this was a very good example why I am so patient with my trading. Let's see what happened here just recently. I'm pointing to this area here. What did we see here? And that's very important. So, easiest thing to figure out is the trend. We're bearish. Okay, we see this label here. Gold is bearish. We came up from below to this red line here. That's a former support level now acting as resistance. That's fine. We're coming from below towards the key level. That's a resistance level to us. Should I short this trade here? Do all the ingredients are coming together? And the answer is no, they are not. Why? because one piece is missing. What's missing? Our liquidity capture event. And see what happened? We actually broke this level. We can be lucky and the level holds, but to me, I don't jump into the setups. I patiently wait for everything coming together. Trend, we're approaching resistance if we're bearish, and we have this liquidity capture event. This is what I want to trade. I'm waiting for this particular event. So you can see I'm skipping a lot of trades. Now, sometimes you see a bounce here, but to me, it's not perfect. I'm waiting for the perfect setup. And trust me, you will find this setup many times a day, depending on how many symbols you're considering, but they happen many times a day. It's just a matter of being patient. And best of all, you don't have to stare at your charts all the time. You can be alerted. I'm going to just talk about this in a second, when these perfect setups are happening. I'm going to show you how this works in a second. So let me go back to my slides to summarize real quick what we've seen here. There we go. Okay, so we have seen our liquidity IQ indicator, the indicator which prints these key levels onto your price chart and is able to identify these shaded areas, these liquidity capture events. Ingredient number 1 and ingredient number 2 for our power bounce setups. These are given to you by this liquidity IQ indicator. And ingredient number 3 comes from this indicator here. It's called MA-Rush. The name is not important, but it's our trend indicator, which identifies the prevailing trend direction automatically for you. And as you know now, I always trade with the trend. I don't trade against it. This is my perfect filter. It helps me to avoid setups where not everything is coming together, where we don't have perfect confluence. All right. Now, I'm going to come back to the chart real quick, but I just want to reiterate one really quickly how important this is. These two indicators have completely transformed the way I trade. Believe me, because I was on a path, on a rabbit hole almost, towards this kind of trading. But I gave up on this. This was too complex to me. It was too expensive. It was not portable. This is not for me. This works perhaps for other traders. It does not work for me. The way I trade right now is just these two indicators on the chart and one laptop. That's all I need. This has simplified my trading by so much. And guess what? This allows me to trade from anywhere in the world, even from this beautiful beach location here in Brazil. This was a couple of months ago with my Starbucks or my coffee here on the right-hand side. This is how I trade now. And this is something you can easily reproduce on your end as well. I'm going to share in the last couple of minutes of this presentation how you can get hold of these two indicators. We have a really special offer for you. All right. Now, how do I trade in particular? Well, I set up my alerts in TradingView or whatever your platform of choice is. We also have these indicators for NinjaTrader and ModifWave and MT4 and MT5 and other ones too, Metastock as well. I get notified when something noteworthy happens. If it does, actually comes on my phone here, directly on my phone, I get notified. Guess what I do then? I open up the price chart, I check it out manually, just make sure I like what I'm seeing. And if I do, I execute my trade. This is how I trade. Okay, this is my process now. And this works for both swing trading and also for day trading. This is my market edge. So I talked about alerts. Let me show you how I set my alerts on TradingView. So I'm going to go back one more time to the chart here. And I was a bit excessive in preparation of this presentation here because I defined a whole bunch of alerts just so I have something to show. I was away before this presentation, so I create them on all kinds of symbols and time frames. But you can see them; they're all coming in here. And let me start with one here on oil. MCL has a support liquidity capture. Let's open this one up. So this is the 50-minute chart. Let's pick up this particular event. I'm going to explain all of this in our training course, how these work in particular. Let's check out oil. Support liquidity capture at 12:56. So that's about when? That's about 20 minutes ago. Look, it's not perfect. I probably wouldn't have taken this one. But look what happened. We came down. This is 12:56. This is around here. We came down to the support level from the top with this shaded area here, liquidity capture. And what did we see afterwards? A bounce off this level. This is tradable. But would I have taken it? Let's see what the trend direction is. Nah, it's bearish. Actually, oil has been bearish for a long time. I would have skipped this one. That's my last filter, my last checkbox which I want to check. I wouldn't have taken this trade. We have some traders in our group which are more aggressive than me. They take these kind of trades. For me, I patiently wait for the perfect setup, the perfect storm, so to say, where everything comes together. But this is how I trade now. We're going to look at some chart requests and some requests later on. I patiently wait for the perfect setup, and only if everything comes together, I execute my trade. All right. So I'm going to go back one more time to my slides because I want to show you how you can get hold of these indicators. So, oops. Oh my goodness. What happened here? 1 second. Where did my PowerPoint just crash? No, it's there. 1 second, guys. For some reason, my PowerPoint just decided to go to a different screen. No problem. There we go. Okay. First off, we offer these two indicators, which have become absolutely essential for my trading, for various platforms, for TradingView, for NinjaTrader, for ModifWave, for MT4 and MT5, and as of late, also for MetaStock. So for all these platforms, these indicators are available. I trade from TradingView. This fits perfectly my lifestyle. I like the online features. It's a cloud-based platform. I don't have to install anything. You can use it from anywhere, from any laptop equally. So I love TradingView, but if you're on any of the other platforms, no problem. We have these indicators available. Now, how can you get hold of it? Normally, and we have a special offer coming. Normally, we offer the Market Edge Super Package. That's how we call these two indicators together, for $197 a month. But today, this is not going to be the case. Today, you will get our liquidity IQ indicator, the ones who identifies the support, these key levels on your chart, and these liquidity capture events for you. You get this indicator in addition to 6 bonuses for a much better price. So you're going to get our key indicator, liquidity IQ. You will get our MA rush indicator, our trend indicator, which is responsible for this final ingredient, the condition number 3, finding the trend direction. You will get this one as well. You will be invited to our next live trading workshop. Today, our time was limited. On June 3rd, that's next Wednesday, at 10 a.m. Eastern Time, we will use these two indicators to live trade the market. You can follow along, you can watch over my shoulder, you can learn by observing how we trade our live money account with just these two indicators. You're going to be invited for this. Bonus number 3, you will also be invited to our exclusive live member sessions, which happen every single week on Tuesday at 12 p.m. Eastern Time. And by the way, these are all recorded. So should you miss it, no problem, you can watch the recording afterwards. In these member sessions, you can actually ask very detailed questions. We're always going to do a market review on these questions. We show you tips and tricks, some new tools that we've been developing, and you can ask questions. You will be invited to these as well. This is where our trading community is coming together as a team, asking questions, helping each other. You will be invited to those. And we also have an ebook, how to use our MA Rush indicator, and several video guides, and a boot camp, and so forth. You will get all of these. But I talked about the price. So normally, this is offered for $197 a month. But today, for the first 5 clients who want to come on board, we will slash down the price forever to only $47 a month. This is limited to only 5 orders because this is not something where we can benefit from really in the long term. But for 5 users, we will offer you these two indicators for just $47 a month in perpetuity. This will never go up. It's a really special offer, and I believe this gives you the opportunity for very low risk to try out our Market Edge Super Package. And trust me, these two indicators are on every single chart I open. No exception. They are so important to me. So thank you to Traders Corner and Anthony and Maria and all the organizers. We put a special offer together, but only for the first 5 users. But if you want to take advantage of this, all you need to do is to go to tradingindicators.com/corner. And Anthony, if you can, please put this link into the chat box as well. So it's tradingindicators.com/corner. You can also see it here at the bottom of my screen. And real quick, What's included? You will get our liquidity IQ indicator, the one which finds these key levels on the chart, and these liquidity capture events, which are so important. Ingredient number 1 and ingredient number 2 of our process, of our power bounce setups. You will get our MA rush indicator, the perfect companion to liquidity IQ, which finds this trend direction, which allows you to only trade with the trend and not against it. For me, it's the perfect filter. I discipline myself to only do this. I'm tempted very often to take trades when it doesn't align, but I've disciplined myself to only trade with the trend, and it has made a hell of a difference. So I encourage you to do the same. And of course, we have a lot of training material which comes with these two indicators. You will be invited to our next live trading workshop, 2 hours of futures live day trading. June 3rd, that's next Wednesday at 10 a.m. Eastern time. And once again, this is recorded, so should you miss it, no problem. You can watch the recording afterwards. You'll also be invited to our exclusive trading sessions, which happen every single Tuesday at 12 p.m. Eastern time. The perfect outlet for you to ask questions, to learn tips and tricks, to see how we look at the market. And by the way, we also have a Discord channel. I forgot to mention this before, where you can get instant answers, where our traders are posting setups every single day, where our community members are posting setups, where traders are helping other traders. You will be invited to this exclusive Discord channel as well. And all this is available at tradingindicators.com. And for the first 5 users, for just $47 a month in perpetuity. So it's a great offer, I believe. Take advantage of it. And yeah, hopefully we can welcome you in our community. And now it's time for your questions. Let me see if I can find or locate my questions box here. All right. What are the data costs for TradingView? Oh, they're very cheap. I don't know what I pay for the CME futures. $10 a month, maybe. It's very cheap. The TradingView data cost, probably the cheapest in the market. Yeah, that's not a big expense. Can this be used to day trade any asset class? Oh yes, absolutely. We have FX traders in our community. Same approach, same setups. We have crypto traders in our community. Same approach, same setups. We have swing traders and so forth. No problem. Yeah. What's the lowest time frame that you use for day trading? It's the 1 minute time frame, in fact. If you go back to my charts here real quick, you can see I have 3 time frames open typically. The 50-minute, that's my tap here on the left-hand side. 50-minute. The one here, this is my 5-minute. And the one here, that's my 1 minute time frame. So that's the lowest I typically use. My favorite one is the 50 minutes, to tell you the truth, because the levels are just more significant there. And on the 1 minute, you get really many alerts. So I'm trying to be a bit more selective. But this is as low as I go. But typically, it's either for me the 5-minute or the 50-minute. These are my main time frames. All right. Going back to the questions, if I can find them. Okay, lowest time frame we had. Data cost I answered. Intel had just had the biggest jump in a day. Okay, we can look at Intel in just a bit later. Okay. Ooh, there are lots of small questions here. I'm not sure if these actually were pertinent to me, but pattern day trader. Okay, I'm not sure. I think I'm problem with interpreting the questions when they came in. It doesn't matter, guys. If you have any symbol requests, I have 2 more minutes left. Please put them now into the into the chat. I'll be happy to look at them. If not, I'm going to quickly go back to the charts myself just to see if something of interest has popped up. Let me just open up this power bound or this bounce setup, just the bounce setup here on ZM on the 50-minute time frame. These are soybeans meal futures. Yeah, I don't discriminate. Let's see what happened here. Okay, so I get alert for all kinds of things. No, not something I would trade. We're bullish. I would not short this to the short side here from this trend. And there's ways to be more selective with your alerts. That's possible. But I just wanted to make sure I have enough alerts coming in here so that I can show you plenty of charts. Perhaps one more. This short bounce setup on M2K on the Russell futures. Let's check it out. Yeah, also not something I would trade. Short bounce here, but this would go against the, oh no, actually it worked out nicely. Look at this. I misspoke. Yeah, this was nice. bearish. We came up here, not directly to the level. Would I have shorted it? Once again, probably not, because there's one ingredient missing. Now, this is the liquidity capture event. We don't see it up here. I probably would have skipped it. But this is how I look at the markets. All these three things need to come together. All right. So with this, a quick reminder, here is the special offer at tradingindicators.com/corner. If you want to trade my market edge, now you can do so for a very special price, limited for the first 5 orders. And I believe this brings me towards the end of this presentation. Anthony, do you want to take over? And I thank you guys for your attention. If Anthony is there.
Thank you, Daniel.
There we go. Okay, perfect. Thanks, guys. Have
Yep.
a nice conference.
Excellent presentation and very valuable educational content. Daniel's promotional link is in the chat box now, so be sure to check it out. And thanks again, Daniel. We appreciate you being here.
Thank you. Bye-bye.
Thank you. And continuing on, next up is Anka Metcalf of Trade Out Loud. Anka, I have to make you the presenter. Anka has more than 25 years of market experience and has helped thousands of traders improve consistency and confidence through disciplined trading education. Today, she'll be presenting the Power Hour Income Blueprint. Anka will show how professional traders identify high probability futures setups during the most active part of the trading day using structured risk management and momentum analysis. So everyone, please welcome Anka Metcalf. Oh, Anka, I think you're on mute still. Anka, you are self-muted. Anka, can you hear us? Okay, Anka cannot hear us. Okay, sorry guys. Anka's having some issues with her mic, so it'll take us a couple more extra minutes here. I just put Anka's homepage in the chat right there in case anyone wants to check it out before she starts presenting. I always like to do a little bit of a background check and check out the home pages myself of different presenters and stuff like that. So I usually try to include that, as they're presenting. So we're just waiting for Anka to try to get back on. All right, everyone, we're still waiting for Anka Metcalf to log back in. She was having some issues with her microphone, so please just hold.
Okay, sound check. Just a quick sound check.
Hey, Anka, we can hear you.
Okay. All right. For some reason, I'm having a very hard time with the new go-to webinar.
That's okay.
Okay. All right. So I think I may be ready. Let me know if I can share the screen.
Yeah, you should be able to share. You only have like a half hour though.
Yes. Yes.
Or unless Greg Kappa's coming after you, unless he's late. You got until 2:15. All right.
All right. Let me start sharing.
Okay, we got you.
Okay. Let me know if you guys can see it.
Yeah.
All right, cool. I don't have the question box over here, so I don't know where to get it. Okay. Anyways, I'm ready to start.
Okay, you go ahead. I'll make you an organizer and then you can see the questions as well.
Oh, okay, cool. Thanks
Yeah.
so much.
You're welcome. Hey, Anka.
Yeah.
Oh, okay. Are you
Okay.
presenting right now?
Okay. Can I start now?
Oh, yeah. I'm sorry. It was all yours. I apologize.
Okay. Thank you so much. Okay, good afternoon, everyone, and thank you so much for your patience. A little bit of tech issues here, so I had to switch computers and put everything back up. In today's presentation, I will be talking about the importance of the power hour and trading the first hour of the day to generate income, and I will be sharing you my blueprint, what I do just to trade the first hour. And what I think is very important is that not only that you're able to identify really great, powerful day trades, whether you're trading futures or stocks, but you're able to identify in the first hour of the day some of the most important moves in the market. And especially when it comes to the stock market, you're going to be the first one. You're going to have a first row seat at sector rotations. So in today's presentation, I will be talking about the power hour advantage, about day trading and swing trading advantages when it comes to the power hour, how earnings season could literally present a massive edge for your trading because they are the powerhouse behind the moves. And I'm going to share with you my exact blueprint. So an exact plan for consistent execution and real results. All right. So for those of you that are new and do not know me, my name is Anka Metcalf, and I am the CEO and founder of TradeOutloud.com. I've been day trading for over 25 years. And prior to that, I come with 10 plus years in investment banking. So I do have 35 plus years in investing experience. So I come from the institutional side. I dove into day trading because just like you, I want to generate my own income. I want to work from home. I want to have the liberty to trade and to work when I want, wherever I want. Also, I'm the CEO and founder of TradeOutloud.com since 2010, and I specialize in high velocity moves. The high velocity moves is a specific move in the market that takes the trade from the initial breakout spot or the signal setting all the way to the target. And it's also having a fluent move into that direction. So it's not going to have a lot of hiccups along the way. I'm also the designer of an institutional proprietary trading system that is based on 8 layers of price support resistance, specific trigger times, specific price zones, and chart synchronicity and divergency. One of the most important things when you're trading, whether you're day trading or swing trading, there are certain factors that you need to take in consideration when you are taking the trade. So 5 of the most important pillars for a foundation, for a consistent foundation and successful trading are, first of all, establishing the market bias. And in order to be on the right side of the trade every single time, you have to determine the overall direction before the open, especially when you're day trading. Identify powerful and dominant trends. And trust me when I tell you this, but the trend is always going to be your friend. When you have a directional market, when the market is not sideways or choppy, and when the market is into a confirmed direction, it is very easy to trade. All you have to do is identify key inflection points on the chart that are going to give you the entries, the stops, and the targets, and you're ready to go. When you take a market against the trend, and don't get me wrong, sometimes I take trades against them against the trend. So for example, if you have a trend on the 5-minute and then you have a forced sell that is happening, and we're going to talk about that today in this presentation, that is basically a shift lower in the market that is produced by funds. It's produced by institutions because they want to get their hands on more contracts, on more shares in that specific index or stock, because they can literally not trade like us, let's say with 5 contracts or 20 contracts or 15 contracts. They need to get like a sizable, considerable, amount in order to get into a trade. So they're layering in. Always use higher time frames for structure in order to determine key levels, because the key levels that are determined by higher time frames are more likely to hold than the levels that are on a smaller time frame. And only take trades in alignment with the bias. It's so much easier. When you're taking trades against the trend, then your risk to reward ratio is going to be less, because typically the pullbacks are going to be very shallow. The most powerful moves go with the trend. The second pillar is the institutional level. These are key levels for the market, and you can identify them by looking at the prior day's high or low, looking at the overnight price action activity, including the high and the low, and also the opening range. And also, other than that, any kind of key support and resistance that are coming into the market. And then we have the power hour setups, whether we're looking for breakouts, whether we're looking for rejections, momentum continuations. We have to wait until the trade is setting up. Typically, in a very volatile market, you're going to see that we have a very fleecy action within the first 5 to 15 minutes. Sometimes the higher the volatility, the higher the fleece. So therefore, sometimes we have to wait until 10 o'clock or even 10:30 before we actually get a trade in. But that is on really high volatility. Right now, I'm noticing that the market has been reacting really well within the first 5 to 10 minutes of the fleece, of the volatility spikes, and then it's really compressing from that point. And I would say pillar number 4 is risk management. However, I would put risk management as pillar number 1. Because if you do not respect the proper risk management, you could have like the perfect bias, you could have your perfect institutional levels all traced out, you can identify the best moves in the power hour, but if you do not know how to risk, how to manage your money, even a great, fantastic trade could turn into a loser. So before actually deciding to trade, identify carefully your entry level, your stop level, and determine the size of your trade. I always use, when I'm day trading, 1% per trade, and I'm not going up and I'm not going down. I'm just using the 1% on each and every single trade, because one of the most important things is to keep your losers consistent. Because once your losers are consistent, and I know this is a little bit more, a little bit in opposition with a lot of what other traders are mentioning, because you have to have consistent wins. You cannot have consistent wins until you have consistent losses, and those consistent losses need to be at the same parameter. I allow myself 6 trades a day, so my risk per day is 6%. And you can imagine if I would apply more than 1%, let's say 2% or 5% a day, multiply that by 6 trades, that would increase my risk size exponentially, especially when day trading. So think in R units instead of percentages or instead of points when it comes to trading. And pillar number 5, you're actually getting to the execution phase. After a lot of patience and planning, you are into the execution phase. And here you got to follow your plan. So again, you have to have the market bias. You have to have your institutional levels. You have to have the setup already set. You have to have your risk management. And now you're ready to apply your plan. Manage the trade. Don't predict it. I always do limit orders when I buy an asset, whether it's a stock or an index. And I don't predict. I just have a calculated move for that. And one good trade can make up your day. So quality, not quantity. Because if I tell you that I would like to take 5 trades in a 5 trades, 7 trades, or 10 trades in a day, and the bottom line is that if you take so many trades in a day, you rack up a lot of commissions. So would you rather take like 10 trades in a day, or one trade that would deliver those 2 hours or 3 hours or 4 hours? I don't know about you, but I would go for that one perfect trade in a day. All right, now this is a seasonal chart of the S&P futures. Seasonality is very important when it comes to trading because it gives us like a bit of an insight into price history. And we know that April and May in general are very bullish months. And then the reason why I have it here is because we are running a little bit thin on that May. So we are just approaching here. You can see that we also have a little bit of a pullback here. And I'm going to share this chart very briefly with you that coincides with this pullback right here if you see the NASDAQ chart. Okay. So bottom line is that we have been in this pullback, and now we are trading all the way here. We are literally trading in the last 2 trading days of May, which is very powerful. And usually, oops, sorry, we're here. So this is the pullback. Sorry about that. So this is the pullback right here. We are just about into the end of May. And notice that June is a little bit choppier. And if you're wondering why June is choppier, why March is difficult, why September is difficult, well, the reason for that is that these are quadruple witching expiration months. And usually when you have the quadruple witch expiration months, you have the contract that are rolling, you have FOMC meetings, you have a lot of things that are happening through these months that are producing a lot of gyration and a lot of volatility and a lot of stagnant price action. So therefore, all you have to do is be very careful and trade less within these months rather than push the pedal to the metal. Now, how many of you guys would like to take control of your financial future for you and your family? I did this 25 years ago and I don't regret it. The only thing that I regret is not starting actually sooner. So whether you want to generate income or supplementary income, the power hour for me was the best choice because I specialized in the power hour, and it wasn't like this. Before, I would be in front of the computer almost all day long. And not only that, but I would start a couple hours before the market opened and a few good hours after the market has closed. And I would spend all day in front of the computer, and that is tiring. You literally burn out. So let me share with you what the power hour is. And basically, the power hour refers to the New York trading session open, where there's typically a surge in trading activity and volatility. Now, this period is characterized by high trading volume. So that means that we're getting a lot of participation into the market and more significant price movements, which can create opportunities for traders to capitalize on short-term market fluctuations. You're going to see the most dynamic moves like we had it today. Today, I would say this is where skill means luck, because I'm going to share a trade that we've done today in the trading room. We took it before the news came out. There was some news about Iran. agreeing to some terms of the peace deal, and that produced a pop into the market. And we took the setup before that happened. Obviously, we don't know when these events are happening, but we didn't go short. And we found a setup that was set for long, and we took the trade. And we were in the trade just a couple of minutes before the big pop-up. We had the big pop-up. We had some beautiful gains, and then we trailed out of the trade. So the best trading time is basically from 9:30 to 11 o'clock. My favorite time is from 9:35 to 10:35. This is my own personal power hour. It's a little bit difficult. It's not from 9:30 because for me, the actionable timing becomes 9:35. So why is this? Because we have the most volume, the high volatility, and news momentum reaction. Today, we had a plethora of economic data that came in before the market opened, and the market was already ready for some action. Now, the first 15 minutes are very important for the market because they set the tone. A lot of times, because of volatility, like I said before, there's a lot of fleecing action. So the opening bell creates the surge of volume and liquidity, and large institutions create orders accumulated overnight, creating the directional clear. This is where it's time to look at the pre-market activity. And once you identify the pre-market activity, the support, the resistance level, prior days high, prior days low, and the directional powerful movement from the market, the dominant trend, then you could take a decision. So watch for the opening range in the first 5 to 15 minutes, whether price accepts above or below the overnight range. Strong volume needs to be present into the market. So look at those volume bars. This is regular volume, and market internals needs to confirm the direction. So a market that breaks and holds above the opening range often attracts trend following money through the morning. So this is a trade that we've done today. As you can see here, we have the low, we have a higher low, and at this point in time when the market opened, it pulled back. This is the chart of NASDAQ. This is what we traded. And we basically traded this rotation that was in sync with the dominant trend. So it was trending higher because this low is basically higher than the prior low. This is where we initiated the first trade. We trailed out of the trade right here. And then we, pretty much we're waiting for the next move in the market if there was one. And we noticed that towards the end of the power hour and the end of the London session, we were noticing a lot of price compression, producing a base above a major moving average. We're using the 10 exponential moving average here, which shows a price dynamic, and the price actually broke out. So this is the second trade that you could have initiated in here, and we called it in the room. That followed through higher, and you could see here that we had a beautiful breakout momentum. So the first 15 minutes is very important because it sets the tone, and then you just have to continue higher. Failed breakouts are often better than successful ones. So many traders chase the breakouts, and professional traders watch for breakout failures because a lot of time I don't particularly like to be the first one that is participating in a breakout. I like to see the market break out, and then I want to see it pull back again to retest. I love to see the retest because oftentimes we're getting the periscope high, the peekaboo highs, and then the market just pulls back drastically. So it's just wanting to see if there are any traders at that level, and then they actually pull the rug out and the shorting starts. So for example, the E-mini S&P breaks yesterday's high. Buyers are rushing in, price immediately falls back below the level, and sellers take control. This is what I'm talking about. So here it is. Here's an example. So we have the market rotation pushing the price higher. Here we have a hefty level of resistance. We have the peekaboo high, and then the market trades below. And again, setting the tone for the short, not for the long. Overnight inventory matters. So before the cash session opens, determine if the market is significantly above the prior day's high, or it's below the day's low, or is it balanced? Is it balanced? Is it trading within the parameters of the prior day's trading, or is it basing? If the overnight traders are heavily long in the market, and the market cannot rally after the open, the liquidity can accelerate the downward motion. So therefore, pay very close attention to the volume that is coming into the market. So for example, in this case, in here in NASDAQ, the price action is going to be bullish above this level, and it's going to be a pullback, prone for a pullback below this level. Not necessarily bearish, but prone for a pullback, or a fleece down and rip your face rally once it hits this 20 SMA. Now, trade away from value. Markets spend most of their time balancing and less time trending. So the best power hour opportunities often occur when the price escapes a well-defined range, leaves a value area, and attracts new participation. So when markets are balanced, patience usually outperforms activity. Remember, 90% of the time is watching the market, watching the stock, watching the futures index, watching the commodity. It's only 10% execution. So here is an example with a high, with a lower high that determines resistance that actually sets the tone for a bullish above or a bearish below. Relative strength and weakness lead direction. So always, what I always do is I have the 4 indices on my screen side by side on the same time frame. So I have NASDAQ, the S&P, Russell, and Dow, and I compare the indices. So for example, today, we saw like some really crazy action happen into the market. For example, we had a big rush down with heavy volume in NASDAQ. And then this is the power bar that took the price higher on that news that came out at 10:12. Here is the setup in NASDAQ. So you can see the same type of sell action that we had, gradual sell. So for the price action to rotate immediately. The S&P had pretty much the same price action. So you can see that we had 1, 2, 3 bars. We had a lot of price congestion into the 200 simple moving average. And here we had a buy signal as well over this 30 that took the price higher. And again, remember these setups, this is basically when, and this actually delivered over 2 or 3 hours in this trade. These trades are well when skill meets luck, because this is luck, this is news. This very well could have went to the other side, but it went higher. So volume is more important than all the other indicators because it shows you market participation. So many traders overload charts with indicators. They barely see the candles. They barely see what is going on the chart. So the first hour is often best trading using just pure price action. So where you see the candles, where you see the fluctuation of price, where you see the psychology happen, the volume, key support resistance levels. And remember, the overnight data is very important. The prior day and not only day, but days before to set up some key levels for the market. And of course, the open range, and volume just confirms whether institutions will be participating or not. So that is very important. All right, so here's this example that we had earlier in NASDAQ where we had the high and the lower high with the field breakout and actually setting up a short. You can see that the volume is decreasing in here. Also, the best trades usually come after an initial shakeout. So the open often produced stop runs. And remember, it's so legal for the platforms to have these stop runs because brokers sell our data. Any broker that we trade on, whether it's, I don't know, Thinkorswim or Tasty Trade or you name it, all these platforms are selling data to hedge funds like Citadel, for example. And what they do is they often see specific areas and they run the stops. They don't run the stop just specifically to kill you or to kill your trade. No, it's just because they want to have more accumulation. So they're the ones that are triggering the short. So they're the ones that are shorting, and then they're covering the short and pushing the price higher because they want more size. So that's how they get it. False breakouts, emotional reactions, and many professional traders wait at least 10 to 20 minutes, especially in volatile markets. It's great to wait a little bit, let the open volatility settle, and then trade the first clean setup, because patience often improves the win rate dramatically. So here's an example of a forced sell. This is the Dow, and it was last week where we had the price action dip lower. You could see here that it violated the prior low just by a little bit. I wouldn't say violated, but it tested the low, and then it went higher. And we all know how it closed, because it closed way higher, right? We're trading right now into new higher territory. And this is also the support that we have, the overnight support. And you could see here the institutional forced sell action that were doing the stop run over here, and then pushing the price higher. And we all know that on that day, and basically this happened last week, the price action started to move higher. All right, so location is everything. A mediocre setup at major support can outperform a perfect setup in the middle of nowhere. So remember, whenever you are looking at a chart, especially if the price action is ranging, let's say on a 1 hour or 30 minute or a 15 minute, a lot of traders get confused and they're trying to read setups that are happening on 15 minute or 5 minute that are happening inside that range. The price action is not going to go anywhere until you break above the range or you break below the range. It's just a trap. So be very aware of that. All right, this is also a chart of the mini S&P. This, I took it from today. You could see the range bound action. You could see the peakable low. This is the forced sell action, right? Taking the price action below the support. This is a lot of, these are the traders that actually not only wanted to accumulate more size like institutions, but these were the traders that had their stops around these areas. And this was the stop run that created the peakable low, and then the price action ran higher. This is very, very common in the market. The market often reveals its intent very quickly. So ask yourself this: are the pullbacks shallow? Are the buyers defending the dips? Is volume increasing on rallies? Are sellers able to push price lower? Because strong markets usually advertise their strength very early. And remember, I often go by momentum on charts into the first 5 to 15 minutes. And if I see strong momentum and in the market, even if we have a sideways type of choppy market, I'm expecting for that 10 a.m. low or 10:30 low to hold if it's going to rotate and if it's going to try to pin a low, for example, into that specific time. One great trade definitely is going to beat 5 average trades. So look for quality. Do not look for those A quality setups. Okay. Don't look for the messy type of trades. Don't waste your time. Don't waste your money. So a simple, powerful power hour checklist would be: what's your overnight high? Where are the yesterday's highs and lows, and mark them? What is the opening range? What is stronger and who's stronger, the buyers or the sellers? Who's in control? Also, what is the volume confirming? Is the volume downtrending? Is the volume consistent? Is the volume rising? Am I trading at a key level? Where's the key level? Because if you're trading in the middle of a range, like I said, they can produce that forced sell action to drag the price action into that support or below the support and then lift it from that point. So be very ready to see this in the market, especially through the month of June. And is the reward at least 2 or 3 times the risk? Because oftentimes we get these beautiful setups and you have to make sure that they have plenty of room to run. A lot of times you're going to see that in the power hour, they may not achieve the 3 hours, but they may go for 1 hour or 2 hours, which is okay. The biggest edge in the power hour is not predicting the market. It's recognizing where institutional participants are committing the capital, and when aligning your trade with that flow, and then aligning the trade with that flow while keeping your risk small and predefined. Remember that risk level, my risk level is always has been 1%. I have a special offer for you guys. So here's what you get. I have an offer for the Power Hour Trading Room. We did have a big promotion on it last week, and I'm just bringing back the special offer for you guys. For just for today. It's going to closed at midnight today, so it's not going to be available for tomorrow. So what you're getting in here, you're getting access to the power hour. You're going to be trading alongside with me. And not only that, but I'm doing the market analysis, I'm delivering the trades, I'm sharing all my trades, the trades that I do, and I do have a track performance for it, have 10 plus years of tracked trading. So you could go into the portfolio and check it out. You get real-time market execution, in-depth coaching, and skill drills. It's Monday through Friday. It's full coverage because consistency requires consistent execution. You get pro-level strategy and a structured system built on institutional principles and simplified for retail traders. So few traders know that if you need literally to reach consistency, you have to have great education and a great support system, and this is what we're offering. So ask yourself this: what kind of trader are you? Are you a welfare trader, not successful, the eternal student, never committing, or are you the millionaire mindset trader where you're successful? And a minimum investment is required in yourself to start producing results. So don't procrastinate, because procrastination is the assassination of the motivation that will stop you from reaching your destination. This is our performance year to date. So we made almost 34 R's. I'm up $157,000 on this account alone. And results are not random. And it is about hard work and passion. Traders fail because it requires thousands of hours spent in the market, thousands of chart analyzed. So you get a feel of how the markets trade, and it's the only way to do it. No AI, no mentor can help you if you're not going to put in the effort. So stop with the excuses. I'm busy now, and I'm going to start next month. I'm going to start next month. I'm going to wait until later. You're never going to do it if you do that. So your success is an optional. Your success is engineered. So the futures trading room is for you if you want to stop the losing streak and you want to start making money in the market. So the special offer for you guys, I don't know, Anthony, I don't know if you have the link. If not, I can share it in the chat box, but I don't see the chat box. But if
I don't have the link. I don't have the link.
Okay, here it is. I have the link in here, but I don't know how to share it. Anyways.
At the top there, next to people, there's a thing called chat. If you click on that.
Yeah, I don't have that. That's the thing. And I'm scared to click on anything. Yeah. But anyways, guys, go here, tradeoutloud.com/future trading room. And it's going to take you here, and scroll down here. You're going to have plenty of information and a lot of information about the trading room. When you want to sign up, you just click this link and you apply the promo code START100. This is going to take $100 off your membership for the first month. And here it is. It's going to pop out at $199 instead of $299. And you're going to be able, here it is. It's $199 for the first month, $299. And again, it is a membership, so you're going to have that recurring fee. And again, the coupon code is START100, and the link is right here. Okay, so thanks so much, Anthony, for having me.
Oh, thank you. And thanks for being here today.
Thank you.
Another outstanding presentation and extremely practical information. Check out Inca's homepage. I put that in the chat there. Unfortunately, I don't have the link, but her coupon code is START100. And if you're still confused, email Anka at info@tradeoutloud.com. Thank you, Anka.
Thank you so much, Anthony.
Thank you.
Thanks so much. Have a great one, guys.
You too. Next up is Greg Capra of Master Trader. Greg is widely respected for his technical market expertise and disciplined approach to trading. His presentation today is Understanding the Art of Multiple Time Frame Analysis. Greg will explain how traders use multiple time frame alignment to improve probability, identify stronger setups, and recognize when it's best to avoid lower quality trades. Everyone, please welcome Greg Capra.
All right. Am I coming through? I'm make sure this is on. Yeah, cool.
We can hear you.
for the screens. And there we go. All right. So thank you for that great presentation, intro, I should say. And let's get to it. We got 45 minutes, and my presentation is all about teaching you how to do something, trading multiple time frames, and you can start utilizing it before the end of today. So a little bit about myself. I started out probably knowing less than any of you in this room do. How do you trade stocks? What's a bond? I don't even know if there were ETFs back then. In any event, it was a long learning curve. There was no internet, and it was trial and error, trying to figure it out, getting things in the mail, the snail mail, and being able to kind of figure it out. Even to a point where now I'm really going back to my first brokerage account at a retail trading firm, and some of you might be familiar with his name, Ralph Acampora. He's a technical analyst. He worked for Prudential at the time as an analyst. And so the broker that had cold called me, I said, hey, his name was Richard. I said, Richard, can you send me your analysis that you're given to the brokers, what had all the charts? And that was one of the ways way back when to start learning. And Ralph is still around. But I wasn't working for any brokerage firms. But in any event, you just back then was all about trying to get any information, which was extremely difficult. Whereas today, you have to work your way through so much information that it's just overwhelming. So back in 1994, I'd been doing this for years and met another individual at a traders group where there were hedge fund managers and specialists, and I thought these were the gods of the market. And I learned that they're not. They work off of order flow and knew very little about technical analysis. In any event, back in 1994, we started a firm at the time, which was, super hot because we're on the cusp of the internet and educating those through a fax letter, right? There was no email as that I knew of it anyway. Let's see if I can do this. Yeah, we go. So yeah, we had fax letters, 800 lines, chats, and so on. And look, this was a way trading back in those early years was expensive. You needed your own satellite feed and getting things set up. It wasn't like it is today, where open up an account, you can be up and running in a day. So that old firm, I sold it off, and the brokerage firm, Master Trader used to be a brokerage firm. I sold it all in 2015. I used to do a lot of trading challenges. As I said, and educated those people that I was met in that group, trading group, Alexander Elder's Trading for a Living group. Some of those people became students. And then, of course, prop traders and, many people within the industry. You can go check out names on my website, past students that are there, and some very well-known companies. Right. Stop drawing. All right, this is me, 1999, first Day Traders Expo. It's me in the middle. This was the theme, training, trading, and technology. That was over 25 years ago and created the concept of the T3. You can see on the bottom, this was the old company, the Pristine Day Trader. Master Trader was a brokerage firm, and eventually back to educating individuals, investors, and traders today. So how do we do that? What has changed over all of these years? Well, the foundational information hasn't changed. I can tell you that. I just pressed the wrong button. I'm not used to this platform, as you can see. Give me a second. I can get this back up. Okay. All right. So foundational information never changes. And it's all about how you approach foundational information. Some do it through indicators and Elliott waves and GANs and very complicated things, which I looked at in my early days. And then I came to the conclusion that it was too inconsistent, it was too subjective, and everything is based on price. And so if everything's based on price, why am I going to look at things other than price? Price is king. I look at it in a candlestick format. Creates pictures that are easier to see, and I use bar by bar analysis. I'll explain that. Now, all of these things have to be defined to make it as black and white as you possibly can. There's too much subjectivity. It creates confusion. You need to limit the amount of information, but you don't want to give up valuable information. I'll explain to you how we could do that without looking at too much and looking at multiple time frames, which is our focus here in this presentation. Of course, support, resistance, relative strength and weakness. And some of these I can't cover all today, but you're going to get what you need to start utilizing this information when I'm done. You chose to. So internals and intermarket analysis, that's a big thing right now. Everybody's focused on oil and interest rates and how they're affecting the markets and currencies. So this is a pretty broad subject. And position money management, I'll touch on that near the end of the presentation. But this is without this, you cannot be successful with this. You can be in moment in time, but sooner or later you're going to blow up if you don't understand position and money management and from an advanced point of view and how to add to positions. That's truly the key. If you're a directional trader, it's about how to add to positions. And all of that is connected to your trading psychology. If there's any doubt on that, just put your whole account in something and watch yourself start sweating and worrying, and you'll see. And then go and buy yourself, if you're learning, take some information, basic information, it doesn't matter what it is, and buy 5 shares, whatever, 2 shares, and watch how calm you are. And then as you start to implement what you learn, you start getting confidence in what you're doing. And so putting this all together, right, that's what creates strategies. Let's continue. So what's the problem? Why are so many losing money? Well, it's not because of the lack of indicators, because there's hundreds, maybe thousands. And when you start changing settings, it's endless. And so this is how all of us are at some point. We're looking at that as like, you know what? If you're looking at your screen right now and saying, I can't see the bars through the Ichikumi cloud, you're on the wrong side. Right? It's about the price action. And they're often losing because they're making decisions possibly from the wrong time frame. Maybe a time frame where they shouldn't really have no business. Meaning they're a swing trader and they're looking at a 2-minute chart. What are you doing there? And you know, if you're a day trader, what are you doing on a monthly chart? You got to put these things into alignment with what your bias is and what you're looking to do. So mixing time frames that don't match your goal and taking trades where the larger picture and entry of the chart are not aligned. This is big, multiple time frame alignment, which is what we're talking about here today. And you're going to understand this from the point of view how traders are on the same page, so to speak. As we look at this foundation, we have to boil things down to foundational information that is simple. Everything about simplification. Complicated could sound impressive initially. If you think this has to be complicated, it's not complicated. Right? It's how complicated, if you want it to be, it will be. But if you limit information, as I'm going to explain it to you, things become clearer. So for longs, a larger time frame in an uptrend, and entry points at support. Pullbacks. Right? There's either going to be a pullback or there's going to be a consolidation. In other words, how do we get on board a trade? If we have a bias from a higher time frame, I want to enter near support, meaning that pullback to support, and I'll show you it could create support, meaning on the right side of your chart, there's no information. but over a period of time, daily chart, several days, or in a 5-minute chart over the course of a half hour or an hour, it's going to create bars there that are going to be meaningful. So again, our entry points near support, stop under a pattern. For shorts, it's just the opposite, of course. Right? We got a bigger time frame, big picture bias, moves toward resistance. Resistance is interchangeable with the word supply. That's where resistance is where there's sellers or supply. I get a smaller time frame that's rolling over in alignment with a bigger time frame. Look for my entry point, and of course, I'm going to have a stop loss. Oh. So there's multiple time frame alignment. Right? Are they aligned or not? Or are they going in opposite directions, which is displaying confusion? That's not what we're after. That's it. For longs, our larger time frame should be support our bullish bias with a smaller time frame. It gives us that entry point. It's very simple what we're doing here. We're looking at a higher time frame. I believe it's going up, going down, going sideways. And with that bias, and if it's sideways, I may decide to trade at support or resistance if the trend is wide, or I may just decide to what we call sit on our hands, do absolutely nothing. And then if the bias is up, I'm looking for pullbacks, I'm looking for breakouts, I'm looking for some pattern that's in alignment with my bias, and we're going to stay focused on that bigger picture. Right? We've got our marching orders, so to speak, and we're sitting there waiting for our setup to materialize. So here's a representation of exactly what I'm referring to. Create a bias, multiple time frames. It's not about looking at more charts. It's like, where are prices going? How do I determine that? Is it making higher highs and higher lows? I assume it's going to keep doing that until it stops. Where are the buyers and where are the sellers? Well, we know there were sellers at the prior high because it pulled back. And we know there were buyers down here because it went up. It pulled back from here, went down, went up, it went down. And between these reference points, highs and lows, as it moves up, usually somewhere in between there is where buyers are going to show up again. So I'm going to think I'm going to be a buyer as it pulls back into that area in alignment with the higher time frame. Pretty simple so far. Where support and resistance is what we call minor support. It was resistance. It exceeded it. And you'll see many will draw lines here and cross over the price and look for prices to pull back there. Some are looking to buy even cheaper down here. And usually it's somewhere in between these is where buyers are going to show up. And it's got nothing to do with Fibonacci retracements, but many will go ahead and connect dots from here to here, and they puts their fib lines on there, and they think mysteriously, somehow, some way, buyers are going to show up because of those mystical lines that were created by some Italian in Italy hundreds and hundreds of years ago. It's a ridiculous concept, but so it is. But that's what we're led to believe, that this is the kind of information that you need to draw trend lines and fib lines and so on and so forth. Right? So as a swing trader, weekly, daily time frame, we will look at a monthly to get a really big picture. And as a day trader, you have choices. What do you want to utilize? I'm going to use the 65, the 15, and the 5. If there really is strong momentum, I'll go down to a 2, but I've got a bias from these higher time frames. Bias, then move lower. So here's examples. Monthly time frame, pointing down. Where's support? I look to the left. You see all these little green dots down there? Those are called pivots. Some platforms call them fractals. Fancy name. It's just, you set this to 3 and it marks bars with 3 higher lows to the left and right, or 3 lower highs to the left and right. And then we see which way is it going. It's going down. Weekly time frame, it's going down. daily time frame, it's going down. So we have a bias and we're looking for setups that are actionable. For example, a pattern like this into a declining 50 MA where it breaks out and breaks down. Breakouts are supposed to fail. We don't trade breakouts if our higher time frames are pointing down. So it's 3 charts. They're going down. The daily chart shows a decline. The weekly confirms. The monthly is the same. And so the power of multiple time frame analysis is that this is going lower. And all of these charts create beliefs. And the belief here is that it'll go down somewhere into this area. And then we trade it accordingly. And you need your management to handle the trade once you're in. So as it says, all traders are working together. What does that mean? Well, it means that technical analysis comes down to being a self-fulfilling prophecy in the end. It's not about the indicators. It's about what other traders believe. And if multiple time frame is going down, traders are either looking to get out of longs or they're looking to short. Some are going to be caught on the long side. And so we're at areas of resistance, which could be a declining 50 MA because many are looking at that is where sellers are going to be. So as I look at my chart and I create a bias, I go back to that question. Where are the buyers and where are the sellers? Once I've got that bias, I'm waiting to see whether if the sellers materialize, they show up where I believe they're going to. And then I look at the candlestick patterns in that area to tell me it's time to act. Do the same thing as an intraday trader. So this daily time frame was up. The 65-minute time frame was up. I've got my bias. I'm done with these charts. As an intraday trader, I'm looking at my 5-minute chart, and you'll see the moving averages I have on here relate to what's happening in other time frames. So the 20 is just 20 MA, simple MA on a 5-minute chart. I can see that it's going up. The 60 MA is equal to, and you're going to see it on the next slide, is equal to the 20 MA on the 15-minute chart. And this is equal to roughly the 20 MA on the 65-minute chart. So this is my bias, right? They're all aligned. We call this stacked moving averages, up, up, up. That means buy pullbacks. Buy pullbacks. That's my bias. Over here, they're out of alignment. I'm not sure what it's going to do, so I stand aside. Rolling over. Right? This is just a moving average. We'd have to look, is it on support? We look to the left, and we wait to see, does this begin to base out and start to come back into alignment with the big picture? That's the discipline part, to wait for that. Again, all the traders are working together. The 5-minute traders, the 15-minute traders, the hourly traders all believe XYZ should go up. So as it pulls back to where the buyer should be, we then look for the candlesticks to form pictures that tell us when to act. So smart moving averages, I explained to you why they're smart, right? They're really just moving averages. It's a smart way to use them because I can see what's happening in multiple time frames by looking at one time frame. So for swing trading, right, you can see the little calculation down here. The 10 MA is equal to the 50 on the daily. On the monthly, the 10 MA is equal to the 200. That's how you figure it out. So I put those moving averages on my daily chart and I say, you know what? This stock is going up. Look for buy pullbacks. Look for consolidations. Look for continuation patterns. Over here, it broke down. So now it's out of alignment. I don't know what to do with that. And now it begins to recover and it's back above the moving averages. So the bias change, this is a way of you changing your bias or your belief. And we do the same thing on a 5-minute. I explained to you the different moving averages. The blue line I put on my 5-minute chart is the opening price, and this red line down here is the previous day's close. So one of the ways besides the moving averages to create my bias is that I know that something that is above the opening price and yesterday's close, the daily candle is green. And if you color them that way, the body, it's green. So on the daily time frame, I know based on these lines that traders are thinking long, essentially. I could go look at the daily chart, but on my 5-minute chart, there's enough alignment here for pullbacks, for consolidations. And of course, we have to look to see if this isn't an uptrend. At some point, where are the sellers going to show up? And so you look to the left on your chart, you see, is there prior highs or is it making new all-time highs? Provides us our bias. Again, if all traders are working together, I have a high level of confidence that they're going to show up. So as prices pull back, right, simple pullback pattern, it pulled back for a few days and it begins to stall the momentum and turns up. Odds are it's going to go up because there's multiple time frame alignment. Everything's about simplification, removing all the complicated indicators and settings and so on. Keep it simple, stupid. Pictures, which are charts, tell us what others believe. What are their expectations? And those are created with money. That's what price patterns are. Pictures of other people's beliefs that are created with money. Tells us how they've acted and what do they believe. We've already got everybody's bias because this is the daily chart. If the 20 is rising, the 50 is rising, the 200 is rising, we're turning up. The majority believe it's going up. And then we go to the smaller time frame and we look for a picture that communicates to me a turning point or a continuation within a picture bias. Expectations on an ongoing basis. So this idea of bar by bar analysis is something I created many, many years ago. It's become a very powerful concept, but it was based on just the unknown of being nervous, right? Oh, there's a red bar. It's going to go down. And then it continues to go up. Well, a red bar, we have a concept called a red bar ignored. That's what it's supposed to do when everything is pointing to longs. So we need to simplify candlesticks. As I said, there's simple patterns, pullback patterns, retest patterns, and larger bottoming patterns. And you don't have to know candlestick names. If you take individual bars, as prices are pulling back, this bar here is a range expansion bottoming tail bar. It's in an uptrend in an area of support. Buyers took control. Some days it takes a little bit more, whatever there's uncertainty. A few more days, could be another half hour on a 5-minute chart. Sometimes stocks that are bottoming out form bigger bottoms. And as we look at what's happening and we see breakdown failures and ranges tightening, all of this information communicates to me what's happening on an ongoing basis. And I don't have to cloud my mind with things like Ichikumi clouds and dark cloud covers and piercing patterns and all of that other nonsense. We've already touched on support and resistance. Where are the buyers and where are the sellers? That's why it says location matters. Buyers going to act at prior support. It happens every day on intraday charts. Every 5-minute low, there's going to be a buyers, and highs, there's going to be sellers. You need to determine trends. So once it forms support, once it forms a support area, you look for them to show up again. However, it's really, it's simple, but it's not that simple. That's why we need other concepts. Point being, once this turns up from there, I believe buyers would be there again. But if it retraces all the way back up here, something has changed. That's where the resistance is. So we have to understand depth of retracement. And then we look to buy pullbacks. And we just continue to repeat the same process. Right? There are going to be sellers up here. If the trend continues, I believe it's going to make higher highs. But if it can't and it breaks lower, well, then we look for sellers to reemerge. And now I'm looking for that transition as it starts to move down. So patterns, location, prior support, looking candlestick patterns, moving averages, visual aids, showing me multiple time frames are pointing up. I look for high probability patterns. Like I said, at the beginning, one concept is not a strategy. So this is putting it together. So patterns alone are not a reason to do anything. If I can put a pattern in alignment with a big picture bias in the right location, then it's about money management and managing the trade to continue in the direction of the prevailing trend. Okay. A few examples, I'm maybe running a little late here. I'll speed it up. And just a few examples of what we are talking here. Downtrend, 20, 60 down, below yesterday's close, below the open. It's bottoming out. That's that picture I just showed you. It's bottoming out, but it's not in alignment with all the trends. This is not what we're looking for. It may pop back up, but it may just come right back down again because there's a lot of traders that have been anticipating that this would go up and it hasn't done it. This little shakeout pattern here, little fail pattern, and then it resumes. Right? There were buyers on the dip, but still, I'm waiting for this to base out some more. Now, one of the things you could use, I mean, it's another conversation, but many stocks that now we can trade credit spreads that expire the same day or in a couple of days. This could be great for credit spreads. So don't trade against the trend. Professional trading, high odds trading, let's put it that way, is aligned with the trend. Here's another daily chart, another great setup over here. It was preceded by a power move. And rather than pull back, it made a base. And here's one of those little dip patterns, little 3-bar reversal, call it what you want. It says it's going up. What this communicates is that buyers kept stepping up, even though it got extended. Right? Oscillators become overbought, which is meaningless, but traders look to buy pullbacks. Bar by bar analysis tells you that it's not pulling back. And when you get a range expansion reversal like that, that's enough. You go long. Stop below the base. Right? This is not a great setup. It's broken down. Even though it's at the 50 MA, that's not what we're looking for. So a big part of successful trading, whether it's swing trading or day trading, is the alignment of what your bias, multiple time frames, and the picture, the candle setting up in alignment with that. So here's a sell setup, just reversed. You can see this candle right here, this big, ugly red candle right in the area of this high, and the sell setup with multiple time frame alignment. And let's get rid of this. And here's an intraday setup, folks. Right, 65-minute chart. 215, which is when I started talking, where these moving averages come together like that, it's often when traders come back to lunch and the trend resumes and it's in alignment, everything pointing down. So after 2 o'clock, you have to start paying attention again for the trend to continue. So we built that thought process. right? And it's not about indicators and settings and oversold. Right? I removed the indicators from my charts decades ago. It's about putting together, I call it a thought process. And I gave you the thought process, the big picture of the thought process there. And your job is to follow it. Come into the Master Trader Green Room where we trade these concepts live every day. Swing trades, credit spreads, day trades, and the time frames that we're utilizing. I told you I would touch on money management. This is a very simple way of breaking up your trades. Just these are the numbers here. Taking a calculated risk, the same amount calculated into every trade where you're going to risk $300. All of our trades are tracked on a spreadsheet when you log into the member area, and they're all based on $300 risk. So you see the share sizing and how they were managed. Again, I'm running late, but this is an overview of what we talked about. And the special that we have site-wide, you could join the green room, join a letter, an advisory letter, the credit spread letter, ETF letter, or any of the courses. If you use that Memorial 26 code at checkout, you will see a 40% discount on whatever you want to purchase. And if you have questions on any of that, email me, Greg at Master Trader. I still have time? I think I do, right? I rushed it. I thought you guys were only giving us a half hour. But if anybody got questions, I can go back. I did cover that kind of quick. And we have a moderator here. All right. I don't know if you folks can type in there if you have questions. I'll just go over a few more of these setups here just to explain. All right. So again, these dots that are on the chart, any platform can do this that I'm aware of. I can see that they're there, and you just set this to 3. And this is our way of following the trend. Is it making higher highs and higher lows? This is resistance. In an uptrend, we assume that it will move above that pivot area. Just uptrends make higher highs and higher lows. Why they failed? Sometimes it's based on the broader markets. It could be the sector that the stock is in. But as I said, primarily what we're looking for is multiple time frame alignment. Once it violates that swing low, it's not about the moving average, and it is just a visual aid, but once it's making a higher high and it violates that prior swing low, it's no longer in an uptrend. And that's the main reason why I said, while this is stabilizing on a rising 50 MA, I'm not interested in this setup for a swing trade. Whereas over here, it just got started and it was preceded by a strong momentum move. And I just made a video on a discussion that we had in the green room about Cisco, and I can find that for you. I can share it. And the question was in Cisco was, it had this big gap up. I'm going to find it for you. It had this big gap up. How do we trade that? And we're looking for pullbacks. Videos. Hold on. We're looking for pullbacks in Cisco, and it's extended. So let me just bring something over here since we have some time. Chart. I can just explain it to you. All right, you should see those charts there. And all I'm interested in here is 2 charts. So the discussion was, I was asked, Greg, what are you thinking about Cisco? And so you have what I call a thought process. It's in an uptrend, clear uptrend. What I explained to you, higher highs, higher lows, moving averages aligned. It gaps up. It gaps up about 10% on the earnings, 13% on earnings. The thought becomes it's going to pull back. It's moved too far in a short amount of time. It was trending up, and possibly that's an exhaustion gap. Okay. And from that point, it's like, okay, it starts to pull back. Where's it going to pull back to? There's no support. Will it pull back to the rising 20? Maybe. Sometimes it'll pull back to a whole number, but that's too far. It would be giving back too much. So I'm not sure what to do. I'm not going to do anything. Some traders, when this gapped up at that time, I don't know if they did it, but they were selling a call spread up above prices to see maybe they could collect some premium over a very short amount of time. So now it's not going down, and it forms another pivot, and it's going sideways here. So it's created enough support there for me to now think, could I buy a breakout? I could do anything I want to do. Point is, can I manage it intelligently? I mean, can I put a stop in an intelligent place? Yes, I can. The share sizing slide that I showed you, I just need to share size it accordingly, because even though this communicates to me that it's shaping up, and if it breaks out, it's going to go higher, I have to have a stop loss that's in alignment with, hey, something went wrong. Right? Market fell apart, whatever. I don't know what it is, but I know I'm going to limit my losses. Now, as an intraday trader, I have no interest in this today. I've got the 200 pointing up. I've got these pointing down. It's chopping sideways. It gapped up this morning. And this momentum move to the downside is somewhat ominous looking on a 5-minute chart. But on a daily chart, it's meaningless. It's just a consolidation day within a strong pattern. So the question is, can it take out these highs? So I don't know. All I do is I do this. Right? And I set an alert to see if it'll do that, and wait to see if the alert goes off tomorrow morning, depending on where it's trading. Rather than the alert, I just may put in a buy stop. Meaning, if it gaps up a little bit and it's going sideways here, I just put in a buy stop, because by the time the alert goes off, it may be up and away based on that pattern. Everybody's focused on, well, pretty much interest rates. So this presentation is about multiple timeframes, that we can apply the multiple timeframe analysis to any instrument. So here's TBT. This is interest rates. It's pulled back to a rising 50 MA. The depth of retracement's a little deep, but there are buyers down here. And if this makes a turn, think about what's been moving this lately. It's been about inflation and the Middle East and oil going up. But just looking at this chart alone, I can see it's in an area of price support. This is where the buyers are. Remember, our beginning slides were, where are the buyers? The buyers are down here. What price pattern would I need for me to think about participating? Well, this isn't it. What I want to see is this make a turn. Some kind of bar by bar analysis where maybe a wide range bar up, maybe it gaps down tomorrow and I got a big green bar up. It could go sideways for a couple of days, but this is where the buyers are and the trend is up for interest rates. Forget about this 5-minute chart. Okay? Right now we're talking about daily chart swing trading perspective. So no turn there yet. This is where potential risk is in the market if interest rates start pushing up, because the markets haven't liked that, right? Risk. Oil has just been in a trading range, been whipping back and forth. Deep retracement. It's in an area of support. No interest. First of all, coming back down to what we call major swing low prior to a higher high. If it was truly strong, it wouldn't have gotten there. That being said, buyers are in this area. If this turns up tomorrow, I don't know if it will. If it was to turn up tomorrow in a meaningful way, not just a little green bar, and interest rates turn up, odds are these spiders that are at new all-time highs, one of the things that you could utilize with bar by bar analysis, right, is think about what this chart communicates. It should be one thing. It's going higher. It consolidated for 2 days. So far, it's holding on to its gain today. It's going sideways near the high of the day. It's a 5-minute chart, but it's going sideways up there. So no one's looking for cover. They believe it's going to go higher. Well, this is how you can shift your bias with bar by bar analysis. Now, what if those interest rates in oil go up tomorrow? Right? Trump comes out and says, whatever, no more deal. I don't like it. Go bomb the hell out of them. And interest rates in oil go up. Prices gap down below that bar is low. It's a giant shock. That reinforces how these patterns are a picture of what others believe. Right now, the belief is everything's going up. It's sideways for 2 days. It's breaking out, and that suggests it's going to go higher. And as long as it stays above this little consolidation there, buyers are in control. Oh, now I've really used up my time. I mistakenly went too fast there. I hope that was helpful. But going to the site, you could use that code, whether it's a letter subscription, the green room with us, or any of the courses. And if you have questions, email me, Greg at Master Trader.
All right. Thank you, Greg. That was pretty great. Be sure to check his website out, mastertrader.com, and use the coupon code Memorial26. So you can use that coupon code for any of them to get your discount.
Yep.
Thank you, Greg. Appreciate it. And now, moving on to our next guest, we have Larry McMillan of McMillan Analysis Corporation. Larry, I'm making you presenter right now. And I think you also might be on mute. Larry.
Okay, I hear it. That's the wrong one. Hold on.
Oh, it's okay. Larry is one of the most respected options analysts in the industry and is known worldwide for his market indicator and volatility analysis. Today's presentation is McMillan's Market Outlook, what option indicators are saying now. Larry will discuss the current market environment, internal market indicators, volatility trends, breadth analysis, and what options data may be signaling about future market direction. So everyone, please welcome Lawrence McMillan.
Okay, it's not showing. It's asking me to share, but it's not showing me the actual.
You had it up for a second.
Yeah. Okay, there it is.
Yeah.
Well, what I had up was that other, the other screen that shows like your next slide at the same time the first slide's up there. All right. I think we're good to go. Or is that still not quite right? Do I need to like be on the screen itself? Here, let's
No,
see.
I think you're good. Your camera was on earlier. Did you want your camera on?
I don't care. So what do you see now? Can you see a line I'm drawing on the screen there?
Yeah, I could see that.
Okay, good. All right. So we're going to talk about some of the option indicators. It's a pretty overbought market, but we'll just see how things sort out. Just a quick background. We started as a derivatives research firm and moved into money management about 20 years ago. And then we also do a certain amount of option education, including mentoring. We will be sending you the PDFs of this presentation, both grayscale and color, and I'll come back to this offer later on. So we're going to go over a few indicators. The most important one being the chart of the S&P 500 itself. We've had a few times, I'd say, in the last year, really since April 2025, when we bottomed out there. There are a few times you got some sell signals, but the chart of the S&P was positive. Obviously, that was the dominant feature, and so it's still positive and it's still the dominant feature. We'll take a look at put call ratios both on the broad market and on some individual stocks and futures. We'll look at market breadth, things that we use there for predicting the market, and then we'll finish up by going over VIX and volatility futures and a few of the things they might be able to tell us in this market. So oversold does not mean buy is an important rule that I have. Nothing is really oversold right now. But the corollary to that is overbought does not mean sell. And we certainly have a lot of overbought things, and we've had them for some time, certainly the last few weeks. But when this market bottomed right at the end of March and took off, it really got overbought pretty quickly, I might say within maybe 10 to 15 days. But it's kept on going. So, you really can't act on an overbought condition until you get an actual sell, so you can't act negatively on it. In fact, some people think overbought means buy. I don't know about that, but it certainly does not mean sell. So here's a long-term chart, a 2-year chart. You can see that this bottom we had last April was a very strong one after we sold off very sharply and then bounced back. We had the 10% correction of this year almost seems forgotten, but we did. We went sideways in January, February, March even, and then started down, and in April had that 10% correction. But now we bounced off of there 1,200 points in really just about 5 weeks, 6 weeks. Amazing amount of territory gained. I guess the big feature on this chart that is most important is where the support level is. That's this level right here, the 7,000 level. That was the old highs. Once we broke through there, that became support. It's falling by the wayside quite a bit now, but still that should provide support if there was any kind of a pullback. You can see like a year ago we had a similar topping area, then we fell below that and then took off again after. So it's similar to last year, except the correction wasn't as big, and the rally right now is as strong as the one was last year, really. If we zoom in a little bit on a 1-year chart, you can see there are a couple of other support areas that are evident here. This top one here right at 73.30, that's where we bottomed out a couple of days this month. And then these circles are gaps on the chart. The only one that was filled in was the one that's solid pink there, this one. The rest have not been filled. And if we look way back last year, you'll see there were gaps on the way up as well that were never filled. So gaps are really, the gaps act as support if you fall into the area. That's what happened with the one that was filled there. But they don't necessarily have to be filled. I know some people think they do, but you can see from this chart that's not true for SPX anyways. So just to summarize the market itself, the breakout to over 7,000 was positive. We haven't done anything to dissuade that notion. There's the first report is at 73.30, and so bottom line, this is a positive chart with bullish momentum. Another thing we look at as far as the S&P chart is is these modified Bollinger Bands. And by that I mean we draw Bollinger Bands, but using the Bollinger Band logic, but we change the definition of realized volatility slightly to stay in line with Black-Scholes. So we use the standard deviation of daily percentage price changes. So we get a chart that looks like this. So the top line up here that's plus 4 sigma. The line just below that is plus 3 sigma. So if we come outside of 4 sigma and go back inside of 3 sigma, that gives us a sell signal. So we did that just a couple of weeks ago, and it quickly bottomed out there on that support area that I showed you before, 73.30, and now it's rallying. So if it rises back above the 4 sigma line, which is getting close to doing, that would stop out that sell signal. The red letters are successful signals, the blue ones are not. Over time, this has been an excellent indicator. The losses are generally small, and sometimes the wins are pretty big. So, like we had that last buy signal right there at the end of March, and we exited that about about 700 points higher on the S&P, or 70 points on SPY. So this sell signal that's in place right now is probably living on borrowed time. But again, I'm not in the business of ignoring signals, because as soon as you do that, that's when it works. So, we have our basic position, and we trade other things around it if they disagree with it. We also can apply the same logic to individual stock charts, and that runs on TradingView. This is the one we just looked at. That's how it looks on TradingView. It puts a little red arrows, and that's a sell, and there's the buy from earlier this year. Those are the signals. I put the pink circle around there that TradingView chart does not. But here's an interesting one. This is crude oil. Crude oil got so volatile that the bands spread very far apart. That is based on realized volatility. So realized volatility was so high, those bands spread so far apart that that are not giving a signal at all. In fact, that says new sell signal today. That's not correct. That was, I don't know, that was from some other charts. But it stayed inside the bands here for about 2 months, just because they're so far apart. A more meaningful one might be Micron, which we know has had this huge run, and you can see it gave a buy signal down here. So the deal with these signals is if they reach the upper band, then you exit, or you run a trailing stop. So here, running the trailing stop would have been the better choice, obviously. And eventually, this will settle down and probably give a sell signal, but it hasn't done so yet. So let's move on to put-call ratios. Put-call ratios were invented by Marty Zweig as a contra indicator back in the 1950s. For the broad market, we use the equity-only put-call ratio. That's all stock options that trade. And for anything else, and for that as well, we try to determine what it means to have too much put buying, because that would be bullish for the market, or to have too much call buying, because that would be bearish for the market. Again, it's a contrary indicator. So if we look at a chart of the stock, and let's say the stock is falling like this, as the stock is falling, people are buying puts, and so the put call ratio goes higher and higher and higher. Eventually, it tops out with a local maximum. So a local maximum on the put call ratio chart is a buy signal for the stock. So now the stock starts to go up. We go over to the left side. Stock's still going up. Put call ratio is falling because people are buying calls. That makes the ratio go lower. Eventually, you get to a local minimum on the chart, and that's a sell signal for the stock. So we publish over 1,600 put call ratio charts every day, and on all of those we show the stock chart and the put call ratio chart, so you can look for this inverse symmetry. It should exist whenever you're getting a signal. If it doesn't, then perhaps something like arbitrage is distorting the signals. Now, this is not a current chart, but on the top is the S&P 500 index. And on the bottom is the equity only put call ratio. Again, all stock options that trade. And you can see the inverse symmetry, and that's why we use the equity only put call ratio to predict the broad market. So here's the current chart. We had a local maximum back here in April and a local minimum back here in February. So it's a good sell signal, a good buy signal. We came down here last week and wobbled higher, and it looked like that was going to be a sell signal, but we've quickly reversed it back down. So we're back on a buy signal here for this ratio. In other words, this will stay in a buy signal until it bottoms out and begins to trend higher, which I thought was happening, last week, and it didn't happen. So we have a put call, we have a computer analysis program that analyzes these put call ratio charts and helps us determine, so we don't have to just look at it with the naked eye and guess whether that's going to be a low local maximum or not. It turned out the computer was fooled there too. We got some very low readings in the last few days because there's been such heavy call buying. Now, as time progressed, we got computers involved in calculating these things that it became a little more sophisticated. We calculate what's called a weighted put call ratio, where we measure the dollars being spent on puts versus the dollars being spent on calls. But again, local maximum buy signal right down there, near the lows. And this one had rolled over to a sell signal last week, as I would say, barely hanging on to that. If it were to fall back below here, back below that low, that would cancel out the sell signal, just like we saw on the previous chart. By the way, this is the lowest this ratio has been since 2024, and the previous one is going to back up one. That one last summer had been as low as it was since 2021. We're not quite back down to that level yet. We're here, and then last summer it was down here. In any case, so that those two are split right now, but it looks like it's not going to take much to push that weighted ratio over back to a buy signal. The thing is, they're very overbought, meaning they're very low on their chart. So there's been a lot of call buying that's gone on in the last 6 weeks, 5 weeks, whatever it is. And so that pushes the ratios lower. Eventually, they will turn and start to trend higher, and that will be the sell signal. So we watch for these things every day in our newsletters, and keep our subscribers up to date on them. What do we trade when we have these signals, whether it's a modified Bollinger Band signal or put call ratio signal here on the broad market? We trade SPY options, typically 1 or 2 points in the money, so that they have a modestly high delta, in this case, delta of 70 or higher, meaning that it captures 70% of the move in the underlying. So if I'm right about the market going up and SPY going up, then I'm going to win with a delta, with an option that has a high delta. If I buy something that's too far out of the money and has a very low delta, it's possible that I could be right about where S&P is going and wrong on the option that I bought, and I don't like that. So we typically buy in the money options, or maybe at the money options if we're talking something a little bit longer term, like a put call ratio trade. Excuse me. So on TV, if you'll notice, a lot of times when even though they're bullish on a stock or something, they'll have a spread in place. And by a spread, I mean they buy a call at a lower strike, and then they sell a call at a higher strike. So in between the two strikes, it's bullish. Your long call is making money. But once you get up to the higher strike, that's it. That you've capped off your profit potential, and basically you cut off any further gains. I don't really like doing that. That's not, typically what you like to do is let your profits run, and that's certainly not doing that. But it does, it is viable, and it can be proven mathematically that it's viable if the options are expensive. So when VIX was up in the 20s, definitely we were spreading. Now it depends. We're not spreading every SPY trade that's going on right now. So if you don't spread, your profits lie along this red line. And the proponents of spreading say, well, you're risking less. Well, you're not risking less. You're risking 100% because your broker is going to ask you to pay for the spread in full or to pay for the call in full. And in which case, if you lose everything, you lose 100%. So what you are risking is slightly different dollars, but that can easily be adjusted by, let's say, buying 4 calls instead of 5 spreads. So to do it just because you think you're risking less, the less dollars, let's say, is that's a falsehood. So if you do spread, and we have been spreading some in SPY, how do you mitigate the negative aspects of spreading? Well, there's 2 ways. One is to widen the difference in the strikes, and 2 is to roll if the stock rallies up to the short strike. So let's talk about number 1. Currently, I wouldn't spread any options expiring before June 18th. But once you get out past June 18th, the implied volatilities are pretty high, and you're probably struggling to keep your risk parameters in levels that you normally would trade at that price on SPY. There are cheaper ETFs that have lower costs. You might want to trade one of those, but SPY is the king. It's very liquid. So if we're going to spread calls, I would spread them 20 to 25 points wide. Give plenty of room between the 2 calls so that you can build up some profits if you get a rally going. And if you're trading puts, I would spread those even wider, 40 to 50 points wide, because out of the money puts sell for a much higher implied volatility than out of the money calls do. So that's number 1. Number 2, roll if the short strike is hit. So here's an example. Let's say SPY was at 740, and we want to put on the June spread. So we buy the 740 call, sell the 765 call, 25 points apart, and that's our position. So let's say we're fortunate enough to have SPY rally up to 765, but now you're pretty much out of gas. Remember, the spread looked like this, and your profit potential is now starting to flatten out up here. So sell that spread that you already bought, take a profit on it, and buy a new spread, again, 25 points wide, and reset it to the highest. What was your highest strike is now your lowest strike. And so that gives you another gain to the upside, potential gain to the upside, and some room to the upside. So if you look at this graphically, the original spread was in black there, and then we roll up to the one that's in red, and you can keep doing this. So it's not as, you won't make as much money as if you just bought a call and held it, but you will keep making more money as the stock SPY in this case keeps rallying. So and not only that, every time you roll up in this spread, you're putting money in your pocket. You're taking a credit out of the position. There's when the way the market works with calls priced according to a law of normal distribution, it turns out that call spreads are actually inferior to put spreads in terms of potential, percentage potential, although obviously if you have buy signals, they're much better than put spreads. But in any case, in this particular example, the options were, if we're buying a call at 12.20 and selling a call at 2.40, that means we're paying $9.80 for the spread, and it could widen out to as much as 25 points. And for an option trade, that's okay, but not great. I mean, there's a lot of leverage there, almost 2.5 times, a little more than that, but still, it could be better. And in fact, if we looked at a put spread, so again with S&P at 740, the put spread we would put on would be this. If we were bearish, we would buy the 740 put and sell the 700 put. And now those prices we would buy at 1260 and sell at 380. And so we're paying $8.80, the difference in those two prices, for a potential to widen out to 40. Now that's much better. That's some really high leverage there. So in this case, then you would roll down if you got down to 700. So in any case, that's how we handle spreads. That's how we do it in our newsletter, across our newsletters, and it's worked out very well for us over the years. So let's look at some individual put call charts. On an individual stock or futures, we only trade the extremes. So any little wiggle in the middle, like there's a local maximum here, a local minimum here, I wouldn't trade those. We're looking for the extreme. So this particular one is Hershey, and we just had an extreme buy signal. In other words, a local maximum on the chart right here, and that's a buy signal. But there was a little resistance on Hershey at around 197, and it just broke out over that yesterday or maybe the day before. And so we're long Hershey calls based on that. You can see the only other previous extremely high local maximum on the chart was a buy signal about a year ago, and that worked out pretty well. There was a good sell signal, local minimum here last March, and then the other sell signal was not so good. But in any case, you can see the inverse symmetry here that exists, not perfectly, but certainly at the extremes. Another one that we're looking at right now is RTX Corp. A year ago, it gave a local maximum buy signal, pretty good buy signal. Now it's given another one, but there is some resistance right in here. So we'd like to see it break out over that resistance right there. And then if it did, we'll buy the calls. If not, then this is one we just pass on. Air Products, this is actually APD, not APR, sorry. That was a sell signal earlier in the month, and it's already down substantially since then. Again, when we put this on, when we recommended it, we wanted to see it break this support level, which it did. And so it hasn't moved too far. You could probably still buy puts on this one and still have a reasonable profit expectation. In futures, there's two things we can do with futures. So this is a fairly new buy signal here in the 10-year note futures. You can see they had decline on top. There's the 10-year notes don't change their price a lot, so it's a small movement chart, but it did give a buy signal just recently. And so if you want to trade this, you could trade the 10-year note options that trade on the board of trade, but you can also trade an ETF based on 10-year notes, and that's this IEF. So you could trade options on that over on the SIBO or in your regular stock account. So sometimes when there's a futures put call ratio, and by that I mean this blue line here, the futures put call ratio, is drawn according to the 10-year note futures options that trade on the board of trade, not the IEF options. That put call ratio might look different. So we use the futures options to draw the ratio, but you don't have to trade the futures options in this case. However, in this case, which is cotton, you do, because there's no corresponding ETF, at least not anymore, that simulates cotton. So you can see there was a sell signal there in early May, and it's worked out pretty well. But if you want to trade this, you have to actually trade the cotton options that exist and I guess the COMEX. Oh, ICE, anyways, one of the ICE exchanges. All right, let's move on. Market breadth. So breadth is just a simple advances minus declines every day. We calculate that. You can keep a running total, or you can keep an oscillator. We do both. The oscillator that we keep, we define it as being today's oscillator value is 90% of yesterday's, plus 10% of today's difference between advances and declines. Now, the thing about breadth is, the most common thing is to use New York Stock Exchange data because that's readily available, it's free, you find it all over the internet. The problem with it is that not everything in the New York Stock Exchange is a stock. And so we also like to have a stocks only breadth indicator. And in our case, we use all stocks that have listed options, over 6,000 of them now. So that's a good data set for that. And we keep both the cumulative totals going as well as the oscillator. So here's the oscillator dating back a few years. I think this goes back to about 2018 here at the beginning. And since that time, mostly we've been in a bull market. We were in a bear market in 2022, so you can see a lot more oversold conditions at that time than at the other times. Now, most recently, we got pretty oversold there at the end of March and that 10% decline. But remember, oversold does not mean buy. So we didn't actually buy until it stopped being oversold right there. But that was early April, and that signal worked out pretty well. It came back and gave us a sell signal right in here, but that was followed quickly by a buy signal on, that should be May 13th, not May 31st. Sorry. So on May 13th, that was a buy signal, and we're still long off that one. We've kind of toyed with going back into overbought territory, but as long as overbought does not mean sell, so we'd still be in that buy signal, even if we moved up here into overbought territory. So the breadth oscillators are positive. Okay, I said it should have been May 21, not 31. I'll fix that before we post the PDFs. So this is our shortest term indicator. It can swing back and forth. We had a sell signal, worked out for a few days, and quickly swung back to a buy signal. So that's the one disadvantage, I guess you would think, to this indicator. Now on the cumulative totals, what we look for here when S&P is making a new all-time high are the cumulative totals making new all-time highs as well. And so recently, there's two cumulative totals. One is just the regular issues, advances minus declines. The other is cumulative volume breadth, which is the volume on advancing issues every day minus the volume on declining issues that day. So you subtract those two and keep a running total of that as well. So the cumulative volume breadth did make a new all-time high on both of the last 2 days in terms of both our data sets, New York Stock Exchange data as well as stocks only data. The regular cumulative, just issues, did not, but it's close, and that today the market's up a lot, so it's going to be a positive breadth day. So those are probably going to join along as well. So all these positive readings from these cumulative totals are supportive of the new highs being made by S&P. Sometimes they'll diverge, and when they get that was called a negative divergence. That's certainly not the case now. And typically you get that negative divergence before a bear market starts. We did in 2022, but not every bear market has that divergence. But if one does arise, we'll certainly be looking for it. But right now, that's not the case. Another thing we follow is new highs versus new lows. This table shows them in terms of New York Stock Exchange data, stocks only data, and also NASDAQ. The one we follow is the New York Stock Exchange data, and it just gave a buy signal yesterday. At yesterday's close, we had 100 or more new highs 2 days in a row, and they were greater than the number of new lows. So that's a new buy signal for this indicator. On the right-hand side here, you can see the previous signals. It doesn't trade that often. That's like 2 years worth of, well, not 2, 1.5 years worth of signals there. And the most recent one is yesterday. But we had a really nice one right before that. We bought on April 9th and sold on May 13th. That was about 600 S&P points or 60 SPY points. So we just got this new buy signal right there yesterday. Yesterday's close, in fact. So let's finish up by taking a look at VIX and what various volatility components are saying here. There are two things we can look at on the VIX chart. First, we can look for spike peaks. Those are buy signals for the stock market. And then we can look, I'm sorry. And then we can look for the trend of VIX. The VIX should be trending opposite to stocks. So this is the chart over the last year. The spike peaks are marked there with B's for buy. And we have a system that we've designed based on these spike peaks. The red letters are positive trades. The blue letters are not. And the orange letters we don't take. Once the trade's in place, it's there for 30 days, roughly a month, until it's stopped out. And so we don't take multiple trades within the same 30-day period. There hasn't been a spike peak here for quite a while, really since last March. We started when we ended the decline that was going on, but we'll get some coming up, I'm sure. In any case, what we do have, though, this pink B is a trend of VIX buy signal. And that's the VIX has just now started trending down by our definition. I mean, obviously, it's been trending lower for a while, but it's a trend when it crosses below the 200-day moving average and the 20-day crosses below. So those both happen right there. And we've moved now significantly below the 200-day, which is this line right here. It's at about 1840. And so this is a buy signal for the stock market. It's going to be in effect until the VIX climbs back above its 200-day moving average, which, could happen quickly, but you never know. So sometimes VIX, typically when S&P is making a new high like it is now, VIX trades down around 15, 14. The fact that it stayed this high for this long indicates that some people are still nervous and are still buying S&P puts and paying up for them, and that keeps VIX somewhat elevated. So, we're riding this new trend of VIX buy signal. I said new because it really was only confirmed a couple of days ago, and there is no spike peak buy signal in effect at the current time. So you can't trade VIX itself, but you can trade VIX futures and options. And VIX options, even though they settle to the price of VIX, they really are options on the futures during their life. So one thing we can watch for is the prices of the futures. So when the futures are aligned like this, the near-term future is the cheapest, and the next is more expensive, et cetera, and they price upwards over time. That's an upward sloping term structure, and that's bullish for stocks. So that's the way things are most of the time. That's the way they are right now, and that is bullish. But occasionally this happens. And when this happens, it's a huge warning sign. The term structure slopes downwards, and that's very often bad news for the stock market. April of 2020 was bad this way, and then April of 2025 also. I'm sorry, it was February of 2020, pandemic. April of last year was similar, and many other times in the past when we've had bear markets. So when the term structure inverts, you need to step aside, do something aggressively bearish until it reverts back to a positive term structure, the previous slide. So here's where we stand right now. These are prices from last night. VIX closed at 1676. Again, just below 17. It's been hovering around 18 for a while now. It's finally starting to fall below 17. And it could well be on its way towards 15 or so because, as I said, if the market keeps going higher, VIX really should be lower. Anyways, if we said, so the front month future right now is June, and June futures are based on the price of SPX options that expire in July. I'm not going to get into how that's all calculated, but if we subtract out the price of VIX from the future, we get $1.59 premium. And so these futures are trading at $1.59 premium to VIX. You can see each futures contract is priced slightly higher than its predecessor until we get out to here. And that means each one has a big fat premium on it. Those are all bullish things for the stock market. Upward sloping term structure, big premiums on the VIX futures. Those are all positive things. By the way, it also warns you against buying long-term VIX futures as a hedge because you give away that premium if nothing happens, and so that's not good. So if you want to speculate in VIX, you trade near-term calls or futures. And the futures prices are displayed on a slightly delayed basis on the CBOE futures website, cfv.com, or you can follow the CBOE volatility indices that it publishes every day. So there's a 1 day, which is typically used by traders trading 0-day expiration options, but there's a 9-day, there's VIX, which is a 30-day volatility estimate. There's a 3-month, a 6-month, and a 1 year. Again, these are the prices where they closed last night. You can see each one is higher than the predecessor. So the term structure slopes nicely upwards. And again, that's bullish for stocks. So the term structure is bullish as well. Now, so overall, the conclusion here from the, I call it the construct, with the premiums and the term structure all together, all that rolled into one. We call it the construct, and that's bullish. And so what we want to watch, the typical first warning sign comes in the front months of the future. So the front month is June, and it's trading right now at 1839. And the second month is July, it's trading at 2045. As long as June is trading below July, no problem. Term structure slopes upwards and everything is good. If it starts to invert though, especially if it inverts by more than just a few cents, then you could have some trouble, and that would be the first warning sign that we want to start taking some defensive action, perhaps buying some VIX calls out of the money to put on as a hedge. You can do a calendar spread in the VIX futures if you want, or you can just outright buy some, SPX or spider puts, because when the term structure inverts, that is a dangerous warning sign. Now, this March, when we were down or trending down 10%, we did get the warning sign, and there was a slight inversion in the term structure. So we put on some modest hedges. They lost money, but it was okay because we have other things in place. But right now I'm not hedging just because the term structures are so steeply sloping upwards. But if they start to flatten out or invert, then we would put our hedges back on in place. So where do we stand on all this? So we look at all this. The chart of S&P is about as bullish as you're going to get. So that's all the way over to the left here. That's as bullish as it can be. New highs versus new lows, I said that just gave a buy signal yesterday, so that's bullish. Realized volatility, we didn't talk about that, but the historical volatility of the S&P 500, we call that HV20. That's very subdued. It's trading around 10%. And so that's bullish as well. Maybe not max bullish, so I didn't put it all the way over to the side, but it's still bullish. The breadth oscillators are on buy signals. We looked at that long-term chart of the breadth oscillators. The trend of VIX, we looked at that. That was that pink circle on the chart just a few charts ago. The VIX is trending down, so that's bullish for stocks. And finally, the construct, the thing we just looked at, the construct, that's bullish as well. So these are all bullish indicators. VIX spike peak, that we don't have a spike peak signal in place at the time, so that's neutral. And then what do we have that's bearish? Well, we had that McMillan volatility band sell signal based on went above the 4 sigma band and back inside the 3 sigma, but that could be stopped out pretty soon. But right now it's still in place. It's still bearish, and the equity only put call ratios were clinging to that local, that most recent local minimum. But if the weighted ratio falls back below, remember it looked kind of like that. If it falls back below, that would cancel out that sell signal. So obviously here the weight of the evidence is bullish, and so we're bullish. And so what we do is, we're long various market spreads. We have had recently some sell signals. We did act on them, but they get stopped out quickly. All of our systems have stops associated with them. So even if you get a simultaneous buy and a sell, one side is going to get stopped out pretty quickly, and hopefully the other side can run on and make a profit. And as I said in the very beginning, if there's a disagreement between the SPX chart and the indicators, in other words, currently the SPX chart is positive, we had a couple of sell signals that appeared there, the SPX chart usually wins out. And it has again this time. And then finally, what we do is that whenever any position gets deeply in the money, we roll it. So I showed you how to roll that spread up, but also just plain old long calls. If we're long SPY calls and they get 10 points or 8 points in the money, that means their delta is pretty high, and we'll roll them up at that point. So sell that call and buy another one at a higher strike, and keep doing that. And so as long as you keep doing that, you retain your profit potential on the upside, but you keep putting money in your pocket every time you make one of those call rolls. So let me return to the offer we talked about for just a minute. It's here at optionstrategist.com/Traders Corner, and it's our top 3 newsletters, 1 month of each for a total of $99. That's typically a $642 value. The daily volume alerts, which comes out every morning, I write that. It has an extensive market comment usually, and it covers all of these indicators we've talked about here, plus any viable takeovers. I think the last significant takeover that we were able to profit from was the Warner Brothers Discover. We have the Daily Strategist newsletter, which comes out twice a day and basically just covers about everything we do. That's our highest end newsletter. And then there's the Option Strategist, which comes out once a week. Now, you don't have to take these all at once. That would be overwhelming. So take, a month of one, then a month of the other, and a month of the other one, and see which one you like. The options, there are track records in all these on our website and in the newsletters. The option strategies were in our 34th year of publication. We trade earnings straddles in there. That's been very profitable. We trade just regular volatility based straddles. We have a strategy we call hard to borrow. We look at stocks that are hard to borrow. It distorts the put call ratio parity. And we do pretty well with all of these. Obviously, past performance, no guarantee of future results. Visit our website. Also, take a look around. We have a lot of stuff on there. I mentioned the area where we publish put call ratio charts. That's called the strategy zone. And we have a YouTube channel that I update a video the first business day of every week. And we also have a put writer newsletter, if that interests you, and a special situation newsletter. Just one last chart before we finish. I mentioned longer term put call ratio. So this little box on the right here, the square, that's pretty much where we're the chart we looked at earlier of the weighted ratio. This is a weighted ratio, and we're down here. I said at lows last seen in 2024. That would be here at point A. But you can see that this general level, the market has bottomed at that level several times over the years. Sometimes we get a big market correction and sometimes we don't, but you can't afford to skip it. So again, this is probing lower now, but it's going to roll over and give us a sell signal one of these days. And even though the market's probably going to look really good when that happens, you still need to take that trade. So just to summarize this, our contact information, if you're interested in our money management, the website is at the bottom of the screen there. And that is, I guess I just want to say there that our minimum account size for option accounts is $100,000. So I'm going to flip it back to you. I think we're pretty much done there.
All right. Thank you, Larry.
Okay, you're welcome.
Yeah. Oh, let me put that coupon code in there.
Okay. Hopefully you won't need that. But
Oh, okay. I put the link in the chat as well. So go to https // optionstrategist.com Traders Corner and check out Larry's offer. So thank you, Larry. Exceptional market insight as always. Really appreciate everything you do with the volatility index. You are one of one. Thank you so much.
Okay, thanks. See you.
Thank you. And be sure to check out his YouTube page as well. I put that in the chat as well. Next up is AJ Brown of Trading Trainer. AJ is widely recognized as one of the most disciplined options traders in the industry and has been actively trading options for more than 23 years. Today, he'll be presenting the Magic VIX trade when fear pays. AJ will explain how the VIX behaves differently from stocks, how he structures volatility spread trades, and how traders can potentially benefit during periods of heightened market fear and volatility. Everyone, please welcome AJ Brown.
By the way, guys, if you don't take advantage of Larry's offer, Larry is like the OG. And so I subscribe to all of those newsletters. And so, take it from somebody who's been doing this also a long time, but not as long as Larry, that those are some very valuable things to take advantage of. So let's talk about turning market fear into predictable income. And this is going to be a dual vertical spread VIX play. Before I get started, I just want to make sure people can see my screen okay. Can they see my screen okay? Can you see my screen okay? I'm going to assume yes. I see a big green rectangle around my screen, so I'm going to think yes, you can. All right. So I have a couple slides here, but mostly what I'm going to be showing you is some live charts and such. I wanted to start off, I've been doing this now close to 25 years, teaching people how to take advantage of different option trading strategies. And, when I talk to a group of folks that aren't part of my program, I kind of hear the same thing. And I'm not going to go over all of this because I just wanted to show some of the things that I've been hearing. Like, man, I don't know how to pick candidates. I'm basically guessing. AJ, I keep breaking my rules. I never really had rules, or maybe I never had rules to begin with. These are things that maybe you've heard, or perhaps you even said yourself. And one of the things that I want to get through to you, especially with some of the interesting ups and downs we've had in the last, look at some of these. I jump from one program to the next trying to fix mistakes I don't even understand. I don't understand risk. I think I'm managing it, but I'm probably not. Um, I'm terrified I'm going to blow up my portfolio again. Maybe I don't have the discipline successful traders have. Maybe I never will. What if I'm a dreamer pretending to be a doer? Maybe I'm too old to finally get it. What else? I feel like everyone else gets it and I'm the only imposter. I'm scared I'll always be chasing someone else's system because I don't trust myself. Look at this. What if I can't fix what's broken in my trading? What if I never build actual financial freedom, just more courses and more disappointment? So the scoop is I've been hearing a lot of doubt, and a lot of it is coming because of just the fact that folks aren't, especially if you've been a technical trader for a while, investors are paying less and less attention to, traditional signs of support and resistance, which is what all of our indicators are trying to identify, and paying more attention to things like Truth Social and paying attention to the talking heads out there and, those few individual investors. But here's some of the things you've got to keep in mind. Number one, there's a lot of uncertainty with what's happening in the world right now, whether you're thinking, here in the States, or whether you're thinking in some of these places where there's lots of conflict, if you're thinking of the Middle East, if you're thinking about elections coming up. But you got to remember, when you break it down to what's happening in the markets, if you play that right, what can happen in the markets can set you up for months, if not years to come. And I'm a perfect example of that. I made my initial big fortune during the .com bust, and then it's only parlayed since then. And you just have to remember, money is not created or destroyed the markets, despite the talking heads coming on the news and saying, hey, during this Iran conflict, or during this tariff war, there has been this many trillions of dollars that have evaporated from the market. That's not absolutely true at all. The markets are only a place where money goes from one person to another, from one hand to another. And so the key is understanding and putting yourself on the correct side of those transactions, right? And that's why in the late 90s, when I started to delve into my journey with being a trader, and being specifically an end of day trader who trades options, that's what fit with my particular lifestyle back then. I was a full-time employee at Hewlett Packard, one of the top end folks there in their marketing department. And I really was committed to that career. And so I couldn't be day trading. I couldn't be in there during the day trading these markets. So I always had to do stuff at the end of the day. And I was attracted to equity options just because there's so many different possibilities with them. And so being able to put yourself on the correct side of the transaction with so many different strategies in my investor tool chest really made a lot of sense. So let's get right into it. First of all, I do want to give you a disclaimer. If you go to my website at tradingtrainer.com, you can read all the legalese. Basically, historical profits aren't representative of what future profits could be. And there's always risk when you're talking about trading or investing. But the real thing I want to tell you is people follow me all the time, but you're not going to do as good as me or even some of my longtime program participants doing the type of trades I do until you've been doing them as long as me. You just got to remember that, because people call me the goat when it comes to disciplined options trader. Again, that whole discipline thing has a lot to do with the fact that I don't go in during the days, right? I wait till the market's closed, and then I'm very structured. I have a checklist that I give all my program participants about what you do in the evening, right? And then you set yourself up, and I'm using conditional orders now. I program in whatever orders I want, or I think I want to fill the next trading session, and then my laptop is closed until the next evening. And now, even though I'm 53 years old, I have myself a 4-year-old that's in my life, and I just want to spend all my days with her. So when she goes to bed at 8 o'clock in the night, that's when I open up my laptop and spend 20, 30, 40 minutes doing what I have to do, evaluating my open positions, evaluating positions I tried to fill but didn't get filled, evaluating new positions, setting up my orders for the next trading session, and then close that down. Okay, so let's talk about this VIX trade, and I'm going to break this up into 3 different discussions. The first one is we're going to talk about the VIX, and Larry was really talking some good stuff about it, but I want to break it down to those of you that don't eat and breathe the VIX on a day-to-day basis. Then I'm going to talk to you about my vertical spread strategy, and then I'm going to talk about how you apply one to the other, the timing signals. So you got to remember that this VIX thing is a measure of implied volatility, the S&P 500 market. Okay, that's a lot of word salad. Basically, it is the expectation, or the vision of investors as a tribe mind, right, as to what could come up next, right? Implied volatility means it's what we think is going to come up next. It may not have to come up next, but this is what we're forecasting, right? And they often refer to this guy as the fear index because it goes up when anxiety in the market grows. It doesn't go up necessarily when there's something tangible making it goes up. It's the anxiety. Anxiety is future framing what might be happening, right? Let me actually switch gears here from my charts to let's see if I can pull it up here. There we go. So this is the VIX, right? And the VIX is still trading today. It's getting lower and lower. The VIX is a measurement of it's a measurement of the buying and selling pressure on options. And options are used by a lot of the big money investors as hedges against their long and short positions. So if they're buying options, they're worried about what their positions might do in the future, meaning they think their positions may have a chance of going against them, right? So they buy these options. It's almost like a form of insurance. I'm starting to sit on the edge of my seat here. It's a form of insurance. And so when they think that they need this insurance, they start buying it, and that actually causes the price to go up, and that's why the VIX starts to go up, right? And when people are confident and they don't feel like they need to insure their long and short positions, then they'll sell these options off and the VIX will drop, right? And so take a look at this. When I go and show you the VIX from the beginning of when I have data, which is 1986, let me show you all of that. Now, when we look at this, you can see that each one of these bars actually represents a whole month of price action. But you can see exactly, here's 1987. This is when we changed the tax code, and all the investors at that time, right at the end of the Reagan administration, lost a lot of their write-offs, right? It changed the whole, we call that, Black Friday and all that good stuff. That was the VIX jumping up there. We've got the S&L crisis here in the early 90s. We've got the dot-com boom in the late 90s, and then the dot-com bust. You can see that there was increased fear at that point. Here's the 2008 financial crisis. You can see my cursor there. And then we've got some of the growing pains after that, going all the way till 2011. Then we've got here's COVID. Here's the pandemic shutting down the world economies for a couple months there, a little bit longer than that. And now we're, as Larry pointed out, now we're in the whole tariff and Iran uh, trade wars and real wars, right? And so what you'll notice here is, and this is actually, psychologists get more excited over this than even traders. But what you're actually seeing is, as a actual measure, humans don't really get that confident, right? We're always on the verge of fight or flight, right? And I don't know if this is wired into our brains or what, like we're sitting behind the rock waiting for that woolly mammoth to run by, and we could club it on the head and have dinner. But you can see that, we spend a lot of time in the lower half under this dotted line, but we never spike to the downside. We never get this over exuberance of confidence, like we trust everybody. We feel everybody is loyal to us. We don't get that. We get, we slowly get down to that level, and we kind of just hover. In my life, my 25 years of really looking at this, close to 30 years of watching the markets, I've only seen the VIX go into single digits a couple times in my life, right? It just doesn't. But when the proverbial poop hits the fan, we're ready to, go after. That's why you see these huge spikes in volatility. It's because when there's fear, when there's anxiety, it tends to snowball, and there's this, huge thing that happens, and we all follow each other off the cliff, right? So fear can be like almost, you know, uh, without topping, whereas confidence is slow to come by, and we never really spike to the bottom. And so this is the pattern I'm setting up for you that we need to figure out how to profit off of, or at least how to hedge off of it. I'm sharing this trade. I've been doing this trade for about 10 years. I put it on whenever the signs are there. I actually put on a portion of my portfolio into this trade every time it presents itself, because when this trade, shoots through the roof, a lot of my the rest of my portfolio tends to be a little bit under stress. So this trade, the market's just closed. This trade totally compensates for all the other trades that go under stress, because this tends to go through the roof and profit through the roof whenever the market is under stress, right? Whenever the rest of your portfolio might be under stress. So we call this the VIX hedging trade, and we put it on every time it presents itself. And many times it just winds up breaking even, which is fine. Usually I put somewhere between 5 and 10% of my portfolio on this position every time it presents itself. Lately, like in the last 18 months, I've been putting closer to 20% of my portfolio into my position, just because this particular trade has been working in our benefit every time it cycles. And it's about to cycle again. Let me bring us back current, so we can talk a little bit more about it. But you get the idea of what the VIX really is. It's a measurement of fear versus confidence, and it's perception. It's not necessary. You can actually see I have these numbers. Now, this dotted line you see here at roughly $19 is not just a horizontal line that I drew on this chart. This is a best fit trend line, or a linear regression line from the beginning of time of the VIX, of all the data. And you can see it comes out horizontal. So, the amount of weighted confidence versus weighted fear balances each other's out at this line. And then you'll see I've got a line here at $26. That's where we go from being just anxious to being over anxious. We also have dubbed this line the founded unfounded fear threshold. When we're below $26 on the VIX, it's usually our anxiety that's causing us, the fear of being in trouble without insurance that causes us to buy those options to protect ourselves. A lot of times when you're above $26 on the VIX, you can actually point at something. It's almost like if you think of the insurance markets for hurricanes in Florida and on the East Coast of the United States, It's almost like we all buy the hurricane insurance when we've got our beach houses because we know that there's a lot of hurricanes coming. And then there's the people who don't buy the insurance until they see the hurricane on the horizon, right? And then they're rushing to buy that insurance. And of course, they're going to pay top dollar for that insurance at that point because we know that it's going to hit. And that's often that 26 level on the VIX means there's actually something founded out there that is causing the anxiety. It's not unfounded fear. And then, of course, I've got this threshold down at $12 where we go to overconfidence, and you don't really see much trading down below $12. And it flattens out there. All right. So now that we have kind of the blueprint on the VIX, markets are driven by human emotion. Fear moves faster than confidence. Fearful markets cause investors to seek protection, driving up option prices and the VIX. Confidence builds slowly. So the VIX rarely drops as sharply as it spikes. This asymmetry creates opportunities. Volatility tends to rise faster than it falls. That's the summary, right? And so we're going to take advantage of this with options. You know, a lot of folks always come up to me at the end of my speeches and they're like, God, options, I've heard that they're just so risky. I had a friend who tried to go long on something and wound up losing his pants or whatever because options are used as leverage instruments. You know, you can, as fast as you can win, you can lose, right? But here's what I have to say about options. And the reason that attracted me to them 30 years ago, and that is, you know, if you're talking about Forex, you're talking about commodities, you're talking about just plain equities and ETF tradings, pretty much you can only make money when this goes up, right? That's called going long. You buy low, sell high. If you have the trading account and the permissions to do so, you can also short it. You can borrow from your broker, you know, sell to open, buy back lower to close, sell high, buy back low. You know, you have two strategies in your tool chest. So you have to identify things that are going up, or if you're lucky, you can also identify things going down. But with options, right, you can make money if things get stuck into sideways. You can make money on the fact that they're decaying assets and have an expiration date, time passing by. You can make money like we've been talking about on fear. You can make money on confidence. So it turns out there's about 27 different ways that you can combine options together. And then the options themselves, picking different strike prices, picking different expiration dates makes the options behave differently. There's about 27 different ways you can profit from every single pattern. And that's what attracted me to it. So yeah, there's a little bit of complexity on knowing how these tools work. But the beauty is now, no matter what pattern you identify, not only in the price charts, but in other variables that control price, whatever pattern you identify, there's a way to trade it, right? And that's what I love. I love that problem solving, being first doing pattern recognition and then pattern utilization. So identifying what you're seeing and then finding the right tool to trade it. And then the rest is history. I don't have to wait every single time for the right timing signal of this is the low and then this is the high. Just a quick little blurb, and I want to keep this short because I'm on a time limit here, but I founded a company called Trading Trainer. Again, world's most disciplined option trader. That was coined by some peers. I actually think they say behind my back I'm the laziest option trader. Again, I think I said it earlier. I feel like I'm the most efficient option trader because I like to use my time very wisely, such that I can get the biggest amount of return, but also the least amount of risk and least amount of stress. In doing this, I use a lot of conditional orders. Um, and so I'm very efficient, such that, you know, I'm getting the most with the least amount of time invested in the least amount of equity put up for risk. I started this in 1997. I started publishing my daily insights for my participants in 2003. There's an ebook that you'll find on pretty much every successful option trader's computer called The 7 Strategies Successful Option Traders. I wrote that in 2005. You'll see this on a lot of their bookshelves. This is my home study course that was put out in 2008. People are still buying it almost 20 years later. And just know that I'm a learner just like you, because well, I got all these engineering degrees. I actually never even used any of them when I went into the workforce. Like I was telling you at Hewlett Packard, I got into marketing right away. They liked me because I could talk to the engineers, because I can speak engineer speak. But I got right into the business. So I've got a strong background in commercial business and investing. And the last 20 years, I've been focusing on how to be a better teacher, especially for grown-ups, because we learn differently than kids do. So I've been learning about accelerated learning methods that work for adults, right? So I want to be the best teacher I can, not only for you guys, but also because I have a foundation that I started where I'm teaching teenagers how not to be, I'll talk about that in a second. When I started out, I lost really big in 1997, and it's a good thing. I was living in Silicon Valley with 4 other guys. We were sharing the rent. I was earning 6 figures at Hewlett Packard, and in 1997, that was a lot of money. And I didn't really have any expenses. I wasn't married, and I was sharing my living expenses with other guys. So that's the perfect time to learn, isn't it? When you're on top, because I spent $27,000 that first year on seminars. And back then it wasn't like this. It wasn't these, I just go from the comfort of my own home. You had to go on a Saturday to a hotel and spend 4 hours. And the next thing you know, you just wrote a check so you can come back on Sunday for the whole day. And then at the end of Sunday, you write an even bigger check and you find yourself on an airplane going to some location where you're spending 3 days. But in addition to the 27K I spent, I also spent $85,000 on really bad trades trying to follow what I was doing. In fact, I very quickly learned who was on the up and up and who was not, of who I was following. But I also learned a few other things, and I'd like you to take some notes here. How to crack the code, right? Number 1, stop chasing shiny objects, right? In other words, figure out what works for you, right? And for me, it was being an end of day trader, and it was focusing on equity options, those 2 things. I wasn't going to be a day trader, and I wanted more strategies in my tool chest. So that's what attracted me. But whatever works for your lifestyle, what you're living, not in your dream lifestyle, but what you're doing right now, as well as um, um, what's going to get you excited. Pick that and then learn it well, because I've seen successful forex traders in my history. I've seen everybody. There's successful people in every discipline. You just got to pick a discipline and then not get distracted by other people's stuff, right? Pick one and then learn it well. Number 2, hire a mentor who is not only currently doing what you want to be doing. So don't pick somebody who used to be a trader and now just teaches, and definitely don't pick somebody who isn't doing what you want to be doing and never has, and also knows how to teach. And my personal story, in 2002, I hired somebody that everybody knew was successful, and I could watch him trade in front of me, but I just couldn't figure out what he was thinking, and he couldn't communicate to me what he was thinking either, and it just wound up being a waste of my money and my time. So make sure you have somebody who you can follow, who's doing what you want to be doing right now and can teach, right? It's called, in the teaching world, we call that learning by guided discovery instead of trial and error. This is 3rd, join an investment group, right? You want to look over each other's shoulders. You want to leverage with pride. In fact, we did this at Hewlett Packard. When Canon or when Brother or when Epson would release a new printer, we would buy their printer, bring it into our lab, take it all apart, figure out all the bells and whistles, and then we would incrementally improve on one of them and release it as our own product. It's called leveraging with pride. I even heard one of my teachers in preschool telling my 4-year-old to not cheat. And I was thinking to myself, actually, that's how the world works. We leverage with pride. We take what somebody else did and we improve on it. And so I had to have a long talk with my 4-year-old, and I'll probably have more, that, sometimes some of the things we learn in school, like you actually, there's subtleties to that. It's not a black and white, because I don't want her saying, hey, I can't do this because that would be cheating, because you want to leverage with pride. So join an investment group. And if Marty over there is trading something and it's really successful, then trade what Marty is. And when you're having a successful trade, share it so that they can do it too, right? Leverage with pride, share your strategies, share it all. Make it a group adventure, because the last one is surround yourself with like-minded investors. So 3 and 4 can go together, because you're going to have losses, and we're not really programmed well to deal with losses. You're also going to have gains. So you want people who will celebrate your wins, but also talk with you about your losses, keep you on the up and up with your strategies. Make sure, you want to surround yourself with like-minded investors and not pay attention to the naysayers, because I'm perfect proof. I left the corporate world and never to have another job again in 2005, right? And so I've been doing this now, gosh, 21 years that I've been living off of my trading. So anyway, these are the 4 shortcuts I had to learn the hard way, but now you've got them in your notes so you can go forward. And I told you I started a foundation in 2003 where I take historically underserved inner city kids off the street, and I teach them how to invest. They basically go through the same program that I do for paid folks. I've partnered with the CBOE in the most recent years. They've got a lot of prime real estate in Chicago that is no longer being used by live traders. It's all electronic trading. So they have classrooms, and they bring in kids from the south side of Chicago, and they're all part of my foundation. I provide all the content and some of the teachers. And last year we graduated close to 160 folks from our program. So I'm very excited about that. That's what, when I have folks join my program, my paid for program, all the profits are going to running our foundation. It's kind of a cool little system. That's what I want to be known for when, God forbid, I pass away. I want my foundation to keep going. All right. If you want to learn more about me, you simply have to go to links.tt4.me, and you'll come to a website that has everything from getting my free indicators to following my YouTube. We have a podcast every Friday. We're coming up on 5 years of doing that podcast every Friday. So you can either tune in live or you can watch the replay. You just hit that like and follow. TikTok, Instagram, Facebook. We also have a free workshop we do, a pre-recorded workshop on premium selling that you might be interested in, coaching, all of that good stuff. So if you want to learn more about me, we're always changing those links. You can go to links.tt for me. Okay, back to our VIX hedging strategy. Here's the idea. So we know that confidence only builds, we approach our level of confidence, but we don't spike down there in confidence. So one of the things that we like to do is use these vertical spreads, right? We're going to use a debit and a credit so that they cancel out. And we're going to pick these vertical spreads on the VIX with a dollar spread between the strikes. And we're going to basically bracket where the VIX is trading when it forms a bottom. We usually put on the bottom trade. In fact, I've automated when I get the end of day signal that a bottom is being found towards the bottom of the VIX, and that's coming up. I will automate the bottom trade being filled the next trading session. And I aim to get, if it's a debit spread, I aim to spend somewhere between 70 and 90 cents out of that dollar to get that debit spread. And again, it's all in conditional orders. Once that trade is filled, I get notified on my smartphone, and I'll go in and I'll put the credit spread in place. So the credit spread, and I don't know if you guys use OptionStrat. I don't know who's behind OptionStrat.com, but it allows you to simulate the heck out of option strategies. So I'm not getting any sort of endorsement by letting you guys know about. Let me see if I can. I'm getting some funny. There we go. This is optionstrat.com. Here's a strategy that I've put together for this upcoming trade. So, you know, I'm intending to do a 14-15, and then I'm looking right now at the 2021. But as you can see, the idea is if you can, let's see, I've got drawing tools. That's awesome. Yep, perfect. So if you can imagine that the VIX is trading like this, right? And this is that line of confidence, right? And so I don't worry because I know that confidence does not spike, right? That does not happen. So that's kind of the beauty of using these spreads is I've got this lower spread. Most of the time, like I said, this trade breaks even, but when there is spikes of fear, this trade can pay, you know, infinite to 1 or 8 to 1, you know, depending on how you structure the trade to begin with. So now you're kind of getting the idea. So I put on the debit spread. You could also, if you've got a margin account, you could put the credit spread on first at the bottom, and then you offset with the debit spread afterwards. Once the bottom spread is established, match with a top spread of a similar price. Err to the side of a higher credit. That way you can cover your commissions. So if the debit, the last time I did this trade was in December, because that's the last time it's set up. We've been having some fearful times recently, so it hasn't bottomed out, but it's getting there, and that's why I'm doing this presentation. If you can set up that bottom spread, I got 81 cents. That's how much I paid for the debit. And when I set up the credit, I got paid 86 cents, right? So now I've got a 5 cent, and I'm tailored at the end of the trade towards the credit. So if everything winds up at the break even, you're going to wind up with that 5 cent credit that'll cover your commissions. Whatever extra money, I did quite a few contracts, so I got a few $100s, and I took my significant other out for date night, right? So most of the time you expect this trade, like I said, to just break even. And like I said, if you can error to the side of the credit, getting more for the credit than you did pay for the debit, then when this trade expires and it's all over, if it winds up breaking even, you at least are covering your commissions. We go typically 2 to 5 weeks out. That's why I was looking at the June 10th, June 11th VIX options. Offset costs between spreads favoring a slight net credit position, right? I have an image of the last trade I did. Let's see if I can pull that up. I copied this from my option strat. Do I have it up? Maybe not, but this is basically what it looks like, right? Okay, option strat. Again, I love that. I love that website. I got myself. There's a lot of free things you can do on that website. I wound up paying whatever little amount it was because it's really useful for option traders. Oh, here we go. This is the one. I put it into the slide. So you can see the exact one. I did a 14.5, 15.5, and a 2021. And I wound up getting just a slight bit more, a couple of pennies more on my credit than the debit. And what wound up happening, you know what happened at the beginning of the year. We wound up popping high, and I wound up closing the position for the max profit. So anytime that the fear hits and you get a pop up above your strike prices, you can close that position ahead of time if you want, or if it looks like it's going to stay up there, you wind up leaving it on until expiration. But boy, was I really stoked about that. Okay, so let's talk about timing. I've got just about 10 minutes left, so this should be a nice bit. We like channel support, and so right now we're targeting between $14 and $15 as being the bottom. And again, if we take a look at where the VIX is trading right now, 1574. So maybe a few more days, a few more calm days, we might get it down in that 1450, and boom, the minute we get a top signal, we're going to go ahead and place that that bottom trade. And then once the bottom trade's placed, we'll find a commensurate top trade. You pick the strike prices. based on the price that you can get. So look at that 70 to 90 cent mark. All right, bring me back to the slides. Perfect. At that channel support, we're going to look for signs of a market bottom. I'm using something called the fast MACD, nothing that I generated. This is the MACD that the Appel father and son team, you can go back and look on YouTube. You can search for fast MACD. The settings are 6 for the fast moving average, 19 for the slow moving average, and 3 for that MACD divergence line. So I'm looking for an up crossing on that with us at the bottom of the VIX. So again, right now we're telling all of our participants, wait till the VIX is trading $14 to $15 or lower, and then you get that bottom signal. The strategy activates when volatility appears poised for re-expansion after compression. By following this simple fast MACD signal at the bottom of the channel, you're going to avoid premature entry into ongoing sell-offs. Expected outcomes. Most of the times, this trade is going to result in a near break-even or maybe some tiny modest gains. But when the market panics, and you know how quickly the market can panic, when implied volatility spikes, this trade pays off significantly. Like I said, when the rest of your portfolio might be under stress, this trade is going to come on through for you. It acts as a hedge. The gains from the VIX position can offset losses elsewhere in the portfolio. It provides peace of mind and smoother portfolio performance during high stress events. Why it works? Volatility is inherently mean reverting, but spikes sharply in crisis. Fear reactions create short-term mispricings and option premiums. This structure that we just talked about captures those short-lived surges while minimizing cost exposure because we only get so confident. And this makes the trade an efficient portfolio hedge. This is not speculative. All right, so takeaway. VIX is a measure of market fear versus confidence. The VIX hedge trade, it uses dual vertical setup. It exploits that volatility behavior. We use the fast MACD at the channel bottom to enhance that edge and consistency. This provides a built-in safeguard for your premium sellers, your swing traders, your trend reversal traders, your trend followers during anxiety-driven markets. Come to one of our workshops. In other words, be part of our program. Get the specific strike prices. We talk about this every Thursday at our workshops. We're talking about it this evening. Get the specific strike prices that we're looking at. Get the specific timing signals. If you want, if you're part of our program, you can send us the trade for review the night before, and we'll get you a turnaround and tell you if you're missing anything. Place the conditional contingent trade, and you're on your way. Rinse and repeat every time this pattern shows up. Again, we expect this pattern to show up. If not, this week, it'll probably show up next week. That VIX has been coming down nicely. So in the last 6 minutes, how would you like to, number one, never miss a pick, not just the VIX trade, but we're going to be talking about all things options, especially premium selling. I like being a seller. How would you like to never miss a pick? Minimize the amount of time you spend away from your loved ones or your passion or your career. Have support whenever you need it, because that's what it's all about. It's about saving time, creating clarity, and of course, getting the results, right? So would it be okay if I just take the next, it's only going to be 5 minutes to tell you a little bit about the materials that I've created, the trainings and tools to see if they might be a fit for you? Thank you. Just a quick little brief thing. Someone who doesn't want to pay for multiple data subscriptions, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things, doesn't want to do this alone, wants step-by-step instructions. Basically, in summary, this is for people who want consistent and reliable results, right? I'm going to skip that testimonial. It's a good testimonial, but here's what you're going to do if you join the program. We focus on having a winning trade in the first 7 days. So you're going to do your onboarding call with us. Then you're going to go to one of our screeners. We have screeners for just about every type of trade you might want to do. Pick a symbol that's in your price range. Bring your symbols to one of our Thursday workshops. Submit them. We'll talk about what's good, what's bad about them. We'll then, if it's a symbol worth doing a trade plan on, we'll set it up for you. We'll plan it all out. We'll talk about risk management, how much of your portfolio you should put into it, all of that good stuff. And if your trade, if the symbol you brought doesn't pass kind of our checklist, somebody else is going to bring a symbol. So you will walk away from the workshop with something to trade, right? And a plan to trade it. Plug that symbol into the worksheet we give you along with your personal portfolio specifics so we can get the position sizing accurate for whatever, we want to make sure we limit the risk to what you can afford. You could send us the trade. We offer all of our program participants trade reviews and then trade the trade. And if you're in doubt, paper trade until you prove it to yourself. That's what we like to do. We like to actually learn while you earn. So we got video tutorials, monthly live classes and all their replays going back to 2010, screeners, planning tools, weekly live workshops and their replays, trade reviews. So think about all those things if you decide to come with us, what that would be worth to you. And know that we also offer a double your money back guarantee. So we ask our kids in our charity to spend 6 months with us, and I'm asking you to do the same. So at the end of 6 months, if you're not profiting from your trades, show us that you're not doing something other than what we've been teaching you, and we will gladly give you back not only what you paid for our program, but 2 times that. That's how confident we are. Also, I want to give you a strategy with one of our coaches. We do have coaching for people who want more hands-on, or should I say hands-off learning. One of those coaches will come and spend some time with you talking about where you are and where you want to be in your 6 months and help you chart the best path to get there efficiently. And also trading audit session. This is a kind of a bonus where I know you've all been doing your own sort of trading, and I'm really versed in trading in general. So I'm going to have a personal session with you. You just have to schedule it with me. And let's look at what you've been doing, and I can iron out some of the issues you've been having with the type of trading you're already doing. So now let's add that in, double your money back guarantee, the bonus strategy session with a coach, a session with me. Because if you go to our website, you'll see this 6-month program is $597, flat fee, 6 months of access, not going to charge you anything else. For you at Traders Corner, we're dropping it by $100. You just have to go to optioninvesting.org/Traders Corner. If you've got your phone, you can scan that QR code. The key is to put that promo code 100DISC. In fact, sometimes I don't know if my team sets that up. So I'm going to I have it right here, optioninvesting.org. Let's just test it live, 100. And cross your fingers, there it is, 100, capital DISC. Apply, cross your fingers. Yes, 497. Do not pass go. Do not collect $200. I'll see you in the program. And otherwise, have fun with that VIX trade. It's coming up probably, like I said, either tomorrow or next week. So be ready to hedge your portfolios. Thanks, everybody.
Thank you, AJ, and be sure to check out his promotion there. Use your phone, or just go to https://optioninvesting.org/traders corner and use promo code 100 DISC. Thank you so much, AJ.
Thank
We
you.
really appreciate you being here. Yeah, great presentation. Thank you. And now to move on to our final presenter of the day. Our final presenter today is David Wise of Rightline Trading. David specializes in momentum trading, institutional order flow analysis, and high probability options trading systems. Today he'll be presenting a recipe for consistent options gains. David will reveal how high volume Heikin-Ashi signals institutional activity, momentum analysis, and the SPY super system work together to identify explosive options opportunities while managing risk. Everyone, please welcome David Wise.
Hello, Anthony. Thank you very much.
Yeah,
Appreciate it. had a long day for yourself, I think. I just, again, this is Dave. I'm going to do a webinar today on the SPY Super System, which is a piece of software that I use for actually identifying high probability trades, identifying when institutions are in the trades, and also some things called the SPY Super System trading methodology. So we have software and a trading methodology. I have an options trading room that I'm in live every day from market open to market close. I do take some lunchtime, but other than that, I'm in there every day, and I have a text alert service this is from Right Line Trading that I've been doing this for about 5 years now, 4.5 years, a little bit more than 4.5 years. And I've been a professional options trader for 17 years. Basically, been doing this quite a long time. All right, so we're going to get started. We're going to go over that. We're going to talk a little bit about Fibonacci candles. We're going to be talking about the SPY Super System and how to use it on intraday trades and on swing trades. Okay, so we get started here. Again, the first thing I have to do, of course, is a disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, off we go here. If you have any questions along the way, just put them in the question box. I'll try to answer them. If not, if you just put your name and number in the question box or the chat box, somebody from Right Line will get back to you. Rory, most likely, to answer any questions that I can't answer. That would probably be related to subscriptions and stuff. Most of the technical stuff I can answer. And here's his phone number here, 786-732-4656. I'll put that at the end of the presentation as well, so that'll be available to you. Or if you want, you can use your Teams username. So he can contact you on Teams. All right. So in the room and on the alert service, these are basically the strategies we use here. We use these are all option strategies. I do some stock trades from time to time, but mostly option strategies. And we do straight calls and straight puts. This is the most common one, of course. We just had one for Apple the other day that we got in on I think got in on Tuesday or Wednesday for about $10 a contract, and we get out for $14 a contract the next day. Pretty 40%, nice 40% gain. But we do straight calls, straight puts. We also do straddles and strangles. These are non-directional trades. You don't care which way the stock goes. We just want it to move in one direction or the other fairly quickly. So those are straddles and strangles. I use debit spreads using weekly options expiration. Time spreads over earnings. This is something I use before earnings occurred, just before earnings occurs, that is also non-directional. We don't care which way the stock goes. We just want it to stay within a specific range. And they've been pretty much, the stocks recently on earnings have been breaking way outside of what the market makers expected for the range. So I haven't been doing a lot of these lately. I did one on NVIDIA, which worked out really beautifully for about a 75% gain. But I've cut back on them recently because of the volatility in these stock movements. It makes it more difficult to be profitable in them. Weekly ATM strategy. I have one on right now on Cisco. This is where I sell puts every week against a longer term dated put. In other words, on like in Cisco, for example, I have the $118 puts that I'm selling on a weekly basis, and I'm holding the $115 puts out in July. So that protects me to the downside. And it's a very nice little strategy, very forgiving. You can make decent money on this thing without really doing a lot of management. And then we do credit spreads to capture premium over a few weeks, typically. All right, I have a credit spread now on TJX and Microsoft. All right, so we also have two specific, these are intraday trading strategies. Now, intraday trading strategies we're talking about trades that you open and close the same day. Now, these are typically fairly quick. Most of these SPY Super System trades and UMCAT trades are only going to last several 5-minute candles, maybe 3, 5, 10, 15 5-minute candles. And we have two different methodologies here. They all use the SPY Super System software. One is called the SPY Super System for very high probability trades. This is typically used for the SPY, the Qs, IWM, futures, or even stocks. It's a standard SPY Super System trades that I'll go over with you. These use in the money puts, in the money calls. Then I have another specific strategy that I set up in November. This is called the UMCAT for high momentum, high volume trades. UMCAT stands for out of the money catalysts, We're just trading out of the money puts, out of the money calls. Never a good idea to do that unless you've got a very specific setup. I want to recommend that you don't ever take out of the money puts and out of the money calls for anything that's going to be a swing type trade or even a longer term day trade. These are very, very quick trades. It's called UMCAT. Out of the money catalyst is what it stands for. Right? I started this back in November. We've been using it since then, and it's very, very effective. They're very quick. I can't alert on these, and I can't post them in the trading room, but I do call them out. Okay. Now the reason I put this UMCAT strategy into existence back in November, there's a thing called PDT. It's called Pattern Day Trader, and the Pattern Day Trader rule that was in effect was always that you had to have $25,000 in your trading account to do more than 3 pattern day trading trades within a 5-day moving period or 5-day period. You can do just 3 of them. But in April they made a change to the PDT rules, and it was when I set this up, it was anticipated in April. They actually activated in April, and it's effective beginning on June 4th is the first time any platforms can start to do this now. Tasty Trade is switching over on June 4th. Thinkorswim switching over on June 9th. Tradier on June 4th, and I assume all the rest of them, which would be Robinhood, Webull, all the rest of the Schwab, all the rest of the Fidelity will be moving over to that very, very quickly. What this means is if you have a small account somewhere under 25,000 down to about $2,000, I think 2,000 is going to be about the smallest you'll be able to use. But if you have a $2,500 account or a $5,000 account or a $10,000 account, you're going to be able to trade intraday trades starting in a week or two, right? So this is a big deal for a lot of people who have small accounts, because PDT rules really does make it difficult to trade successfully when you can't, if you put a trade on you, you're forced to hold it when you don't really want to hold it. But with this PDT rule expected to drop, which it did, down to $2,000, there's going to be millions of new traders gaining full access to intraday trading. There's going to be a lot of new traders coming into intraday trading. That shift demands more fast, in my opinion, disciplined, momentum-based strategies. So we added the UMCAT strategy now to prepare traders for the far more accessible, far more active market environment that's coming up. There's going to be a lot of new traders coming in that have never been able to trade a lot of intraday trades before that are going to be jumping in to do this. And they're not going to be frank about this, they're not going to have the same information and the same advantage that we do because of the software we've got and because of the methodologies we've got. So you're going to have a lot more people out there that you're going to be able to take money from. That's basically what it boils down to. Okay, this is just a graphic on the text alert. We call it Compass, but it's actually SPY Super System. It used to be called Compass, so we left the alert service as Compass. This is where we send alerts out of high probability trades out to your phone. You get them in about 5 to 10 seconds from the time I send them out. And again, that Apple trade we had that we made a 40% on last week was alerted on. This was a really, really nice trade. Okay, now I want to go over one thing here quickly, just to kind of make you have you explain to what drives the market if you don't know. Because what drives the market is we've got 2 groups of traders. Okay, we've got retail traders here, these little marbles right down here. All right, these are myself as a retail trader, most everybody here. And the important thing to understand is when we're in the market and we're the main traders in the market at the time. When I say that, what I mean is the institutions are always in the market, but that doesn't mean that they're actually trading in the same direction. You're going to have traders, institutions that are buying. You're going to have institutions that are selling the same stock, the same ETF. They're not working in conjunction with each other. They're not pushing a market one way or the other. When that's the case, it's basically just choppy. And when retail traders are in here and without an institution or institutions moving the market, then you're going to get a lot of chop and a lot of chaos. Okay, so it's very, very difficult to make any money in that kind of market. And the best thing to do is sit on your hands and not trade when the institutions are not showing that they're moving the market in one direction or the other. So that's what we do. We use our software to identify that. We don't take trades when the institutions are not supporting the trade. And now institutions, by the way, are made up of 4 groups. They're made up of investment banks, Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America, all the big investment banks that you know about. They're also made up of hedge funds. There's hundreds of hedge funds. They're also made up of pension funds, police pension funds, state worker pension funds, and fireman pension funds with billions of dollars. And then lastly, there would be mutual funds. And that would be like T. Rowe Price, Vanguard, more billions and billions of dollars. That's where the money's coming from. This is what the group called institutions, and this is what drives the market. And it's important to understand that a lot of the institutions, especially investment banks, don't manually trade. They use algos. They've got programs written to identify specific setups to take trades, and they can see where people's stops are. In case you've ever had a trade on that you put a stop on and it got taken out, and then the market bounced right back up again, or the stock bounced right back up again. Typically, if there's a lot of folks with stops at around a specific level, the institutions can see that, and they can basically drive the trade down that level, get through that stop, and then bring it back up again, and take a bunch of stops out on people, right? And they also identify news. They have optical readers where they actually read news. If you've ever watched the market when the Fed reports on a Wednesday at 2 o'clock, and you see at 2 o'clock the Fed comes out, if you look at the market at 2 o'clock and 1/1,000,000th of a second, you're going to see a big pop in the volume on the SPY or the Qs. That volume is not coming from people pressing mouses or pressing buttons. That's coming from computerized algo systems doing this automatically. So about 85% of the trades that the institutions put on are algo trades. And they can identify they have programs for lots of different things. They have different levels that they look for, and we'll talk about that. But that's what drives institutions, is what drives the market, and that's what we want to know if we're going to be able to make money consistently. Okay, quickly, I just want to run through this quickly. This is a blackjack table, and it probably seems a little bit off topic for everybody. This is a blackjack table. Here's an ace and a jack and a spades, a couple of $100 chips. What in the world has this got to do with trading? Right? And the reason I brought this up is the question is always, is trading stocks and options gambling? And the reason I put this out there is because a lot of people, if you talk to them, they're going to tell you that's what it is. You can't trade, you can't make money, you're gambling, it's fixed. All right. So why am I bringing this up as a subject? Well, the reason the blackjack table was there was when I was much younger, I made my living playing blackjack as what's called a card counter. Lived in Las Vegas and played as a card counter. And card counting, just for clarification, you're not actually counting the cards. What you're doing is you're tracking the composition of the remaining cards in the deck. Because mathematically, if there's a lot more big cards in the deck than there was when you had a neutral deck, then the advantage switches to the player. If there's a lot more little cards in there than there were when you started in the deck, then the advantage swings in more to the house. They get a larger percentage. So what we did was we just tracked when the little cards were removed, the deuce through sevens, and when the big cards were removed, the 10, jack, queen, king, ace, we kept track of whether we had more little cards or more big cards in the deck than we should have at that point. Right? That's basically just looking at the composition of the remaining cards in the deck. And what we did is when the deck was in our favor and we had a lot more big cards than normal in the deck, we would go ahead and make bigger bets and take more hands. And when it was against us, we take the minimum bet and take one hand. Right? That's it. Card counting in a nutshell. It's a lot more complicated than that because you've got to know basic strategy and how to change the basic strategy based on that. But that's how it works. But what this gave me was an edge. Again, in other words, when I was playing blackjack with the casinos, I had an edge. They were actually I was more the casino when they were the player, because I was betting big when I had an advantage and betting small when I didn't. And if you do that over time, enough hands, you're going to make money consistently. All right, so trading options and trading stocks and options is very similar in that without knowing what the institutions are doing, you don't have a big edge. You don't have an edge. So in essence, they are gambling. All right, so without some sort of a strategy that can identify the institutions and also a trading strategy that is a successful trading strategy, we have a win rate of about 85 to 90% on our trades. And you have to have a very good strategy for that, but you also have to know what the institutions are doing for that. It's really critical. Now, I want to point out something here about this gambling as well as the trading. even with an edge, when you're playing blackjack or when you're trading stocks and options, even with an edge, if they both require discipline and emotional control, right? If you're not able to maintain discipline, which in the case of trading means have specific strategies and methodologies that you use and stick to those. Don't be jumping around from one strategy to that you heard somewhere else, or you saw some stock on X, or your brother-in-law's cousin told you about a hot stock. You have to stay away from those things and stick to the methodology that we're going to lay out here today. Just take the trades that the institutions are in and that you're going to have an edge with. You want to stick with those. That's discipline. On top of that, you've got to have emotional control. And this is really important because emotional control will destroy more traders than anything else. And one thing I would recommend is when you're trading, don't be looking at your P&L. If you're looking at your P&L, and since that's you see it red, you see it green, that's instilling emotion into you. You're trading fearfully, or you're trading greedily when you're watching your P&L. And now you're trading based on the P&L, not based on the technicals of the stock that you should be trading, right? So, and emotional control is deeper than that. It's not just fear and greed. It also includes anger. If you have 2 or 3 losing trades in a row, you get angry. You do what's called revenge trading. You start trading to try to get your money back. You make bigger bets, right? You're trading out of emotion. It's going to end in disaster. It always does, right? And another thing is that a lot of people don't think about is when you have a good run of trades, you win 3, 4, 5, 6 wins in a row, and you feel basically feel kind of invincible. I've got this down now. I know how to trade. This is easy. I can nail these things. It was probably because the market was doing well at the time. But when you do that, what happens is you have this feeling that you can't lose, and you start making bigger trades. And when you have wins, when you get a win, a couple of wins, you get it like a dopamine hit in your head. It makes you feel good, and so you're basically trading with that emotion. So you be aware of those emotions when you're trading, and back away if you feel like you're trading out of emotion. Very important. So that both of these are important. But that being said, the SPY Super System, which is the software I'm going to show you, it's our card counting system. This gives us an edge over other traders, allowing us the ability to become consistently profitable traders. Right? It's important. We're trading against other retail traders. We're not going to take money from the institutions. And the SPY Super System, in conjunction with identifying the best high probability trades, can lead to consistent profits. And this is what we're looking for. We want to be profitable. You want to be consistently profitable. You don't want to have these big swings of, up $2,000 this week, down $4,000 next week, up $1,000 the week after that, down $400 next week. You're looking for some consistency here. I mean, you're obviously going to have variations, but you want to try to keep them under control. Okay, this is what the SPY Super System looks like. I run this on Thinkorswim, and I do not trade on Thinkorswim. You don't have to trade on Thinkorswim. You can trade on any platform you want. But I run this on Thinkorswim. It also runs on Ninja. Okay, but this is what the software looks like. There's a scanner and stuff, and I'll show you some live charts a little bit later. But this, just to give you an idea of what we're looking at here, there's things down here. These are the indicators, and what we're looking for is this is the actual oscillator. That's it's called a gear. It's modified. It has the divergence stripped out of it. It just has momentum. But these are the indicators that we use. This is current time frame momentum. This tells you what the institutions are doing on the current time frame. Now, the current time frame would relate to whatever time frame you're on. This is a 5-minute chart. So this would be what the 5-minute momentum is, right? If you were on a daily chart, this would be what the daily momentum is. This one is the multi-time frame momentum. This is across 3 different time frames. This is across the 5, the 15, and the 45, or on the daily, which is where it's more likely to be used, is 1 day, 3 days, 9 days, right? So if you're doing a swing trade, you want the current time frame momentum and the multi-time frame momentum to both be bullish or both be bearish. Bullish if you're going long, bearish if you're going short. These need to agree. They don't have to be the same color, but they need to agree. Now the color scheme is blue and green are bullish, red and yellow are bearish. So that's what you're looking for here. On a daily chart, you're looking for these things to line up, right? On a 5-minute chart, we're not going to talk about intraday trading, SPY Super System trades, UMCAT trades. We're just using this one. The current time frame momentum is what we're trading off of because we're not going to stay in the trade past this one day. It's got to be less than that, probably more like 15, 20 minutes or a half an hour. Then up here, we have the long-term trend on a swing trade. This is what gives you additional confidence that that trade is going to work in your favor if this agrees, the color here agrees with the colors down here, right? So these are your indicators. This gives us an idea what the institutions are doing. Okay, now up here, this is a 5-minute chart. So this would be what we use for intraday trading, right? Now we've got 3 different key lines here. We've got the volume weighted average price, the VWAP, and you should have VWAP on your 5-minute chart, not on your daily chart, but you should have VWAP on your 5-minute charts because all the institutions use the VWAP. They all use this VWAP. This next one up here is the green line. That's the 15 exponential moving average. Put that on your chart. And the 8 exponential moving average. You can put that in your chart. I would recommend the 8 and the 15 EMA on all time frames. I use it on the daily. I use it on the 5-minute. I use it on the hourly if I'm using hourlies. This is on all time frames. These 3 levels, the VWAP, the 15 EMA, and the 8 exponential moving average, those are your support resistance levels that you're going to use for intraday trades. This is where you want to be entering trades. If this goes green and this breaks and the price breaks above the VWAP, then that's a good place to take it, or it breaks above the 8, or it breaks above the 15. Now notice for trend purposes that the 8 exponential moving average, when it's above the 15, when the white line is above the green line here, that's a bullish trend. When the white line is below the green line, then the green line would actually turn red. When the 8 is below the 15, that's a bearish trend. So that's a good way to identify what the current trend is, right? Now, as far as the colors of the candlesticks, we have obviously red and green candles. Those are standard candlesticks. But you're going to notice here that we have candles that are white and candles that are yellow, right? White candles are high volume bullish candles. That's a green candle, but with extremely high volume. The yellow ones are bearish candles or red candles with a high volume. So this tells you that the institutions are bullish here, but not only are they bullish, but they're coming in with force. So this is really important, and it's going to come into play on the SPY Super System and on the UMCAT trades, very much so. And this, we have an indicator here called market internals. This tells us what the market is doing. And when I say market, I'm talking about all 6,000 stocks. VOLD, this is basically looking at the volume up, volume down, and it's looking at green and blue would be bullish, red and yellow would be bearish. And this tells you what's going on with the overall market, not with the stock that you're looking at, but the whole overall market, so you can identify whether the trend here is matching the trend in the market at the same time. It's just help of kind of an aid for that, right? So that is the SPY Super System, and that's what the software looks like. I just kind of wanted to show that to you before we get into the rest of the presentation, so you can see it's pretty simple. But the colors are very important because these are being calculated through using some fairly complex calculations on momentum, obviously volume, also trend, and money flow. And all of these things can tell us what the institutions are doing. Okay. All right. And I want to show you a couple of trades with this, so you can see what I'm talking about. All right. So this is the SPY Super System software. This was a UMCAT trade that I took in Oracle. I forget when it was. It doesn't make any difference. Back in February. I'm going to show you some live ones in a bit here. But this was an UMCAT trade on Oracle. We got in right here. Right. You see this? You see this? How Oracle is moving sideways. See this right down here? The current time frame momentum is red, bearish. It's a bearish setup, right? Institutions are selling this thing. They've been selling it for a while. You can see the sell-off here, and then they compress. The price compresses. Then we get this yellow candle. That's a high volume bearish candle that institutions are selling, and they're selling with some force. We get this blue arrow. This is what the SPY Super System puts in place when there is a break of compression to the downside. Right, it uses pink ones for breaks of compression to the upside, pink for break of compression to the downside. So you're taking a stock that's breaking compression to the downside with high volume, and the institutions are selling it. This is the perfect setup for an UMCAT trade right here. Right, so this is where we took it. Now we took out of the money, so out of the monies were very cheap. We only paid $72 a contract for these UMCAT trades. The stock was trading, I think, around 149 or so, 100. So I think we took a 147 put to get it cheap out of the money because we had high volumes. Remember, I told you UMCAT trades must have high volume candlesticks. So we get high volume candlesticks. So we get in here for 72 cents. We get out here, but 6 candles later, but 30 minutes later, 35 minutes later, for $1.25 a contract, 125 a contract, 74% profit. Right? So that's what an UMCAT trade looks like looking at the SPY Super System software. Okay? All right. And here's one more. I mean, this was a huge trade. This is not normal to get this big a move, but we did this on this one. This is in Frog. Again, institutions selling it, and then they went back to buying it. And then right here, they switched back to selling it again. And we were watching this compression, and it broke down below the 8. See the 8 right there, the white line? That's the 8 exponential moving average. Broke down below the 8 with high volume candlestick. Right? Institutions selling it, they're selling it, and they're selling it with force. We rode this down. It was trading at about $43, $44. We took $39 puts, way out of the money. And you've got to have these high volume candles to do that. You could take in the money if you wanted to, but you wouldn't get as big an ROI, but you still would have made a lot of money. But we get in right here for $30 a contract, and I get out right here for $200 a contract. Right? That was 566% gain. This thing was just it doubled like in 2 candles, and it just kept going down. Because we were out of the money, that those $30 options just kept going up and up and up in price because this moved, but it moved in such a quick time frame that they just moved those options right up, and we actually got into the money before these things closed. Whoops, sorry to do that. Okay, so those are what we look for, and those are a couple of UMCAT trades right there. All right. Okay, so we have a couple of rules in the room and in the alert service that we trade by. We call trade the best and skip the rest. This means we're looking for trades that are only set up as the very highest probability trade setups, which means institutions are in these trades. And we skip the rest. If the institutions aren't in the trade, or we get nearby support, resistance, multiple other things, we skip those. We don't take them. So we're not taking a lot of trades. And it's important to understand that a trade that you don't take that was going to lose money is just like as good as taking a winning trade, because obviously it's money in your pocket. Right? So trade the best, skip the rest, and our objective in the room is not to make trades. Our objective is to make money. And this is meant to guide retail traders to cut back on the number of trades they take. Don't be over trading, because a lot of retail traders think that just because they're a trader and they're sitting in front of a platform that they need to be trading all the time. They always have to have a trade on. You don't always have to have a trade on. Our objective is not to make trades. Our objective is to make money. That's what we're trying to do. How frequent are the UMCAT trades, Nick? Pretty frequent. It depends on the day and what kind of market you've got. But today I had, let me see, I had one in ONDO. I had one in QBTS. I had one in Lunar, LUNR, and a small one in GRRR. Some days there'll be 2, 3, 4. Some days 6 or 7. You have to be able to find them and trade them because they're pretty quick trades. But there's a lot of trades, and I'll show you the results I've had with them. There's an awful lot of trades, but you're responsible for these yourself, because I can't post them in the room because they're much too quick. I mean, when you get into a trade, by the time I actually tell everybody there, you got to get in there and take it yourself, because the option premiums can move pretty quickly. So we have quite a few, Nick, but multiple ones every day. Obviously, you can just take the ones you want. Okay. Another key here is we want to maintain discipline. That means follow the strategy. I'm going to show you exactly what we look for. Make sure you're in trades that are high probability trades with institutions. So that means learn the process and follow the process. That's the methodology. And remain patient. Again, I keep trying to get retail traders to please don't feel like you're forced to take a trade. Wait for the trade to come to you. Wait for the setup. The setups come. Just wait for them, because you don't want to get stuck in a trade. Okay. Profitable traders, we need an edge. All right. And our edges, we have 4 of them. We have the SPY Super System software that I showed you that tells us whether institutions are in the trade or not. We trade relative strength and relative weakness. Remember now, relative strength is not RSI, right? I don't use RSA. I don't use RSI. I don't use MACDs. I don't use a lot of those indicators. I'm using the momentum indicator, and I'm using price action and the moving averages that we talked about. right? So relative strength means how is your stock moving in relationship to the SPY, right? So if you've got a stock that's moving up, stacking green candles, and the SPY is moving sideways or down, that stock's got relative strength. That's what relative strength means. And vice versa. If the SPY is moving up and your stock's moving down with stacking red candles, that's relative weakness. Those stocks perform much better than stocks that are just moving with the market. Because if the market reverses on you, they're not gonna be hit as hard because they had relative strength or relative weakness to start with. And this is a very big deal, this relative strength, relative weakness. And I don't know an awful lot of retail traders that use this, but this is really important to make a determination. It should be one of the criteria that you look at when you're taking a trade. Trade with the market trend. Everybody knows about this. Try to trade with the market trend if there is a market trend. Today the market was trending up. It was a bullish day, bullish what you considered a trending day, but it was choppy within that trend. There wasn't an awful lot of moves that went for a good long time. There were several, but there weren't an awful lot. And then buy near support, sell near resistance, right? And those are the ones I showed you there, the VWAP, the 8 and the 15 EMAs. If you're looking at a daily chart, those would be things like the 50, the 100, and the 200-day moving averages. Those are support resistance levels. You want to get in as close to those as possible so that if the stock reverses and goes against you, your loss is going to be minimized. All right. The compass system, which is actually called the SPY super system now, we just run through this. It identifies the highest probability trade setups while sidestepping setups that look good but will fail more often they succeed. Again, we do this by identifying when the institutions are in the trade by looking at several different things, especially momentum. And it's going to display the information in colored candles. This is an old graphic, but it's showing it in colored candles. And this is really important for new traders because the fact that they're displayed in a screen in a color using colors, right? It's easy for someone to identify whether institutions are in a trade or not by looking at the colors. There's not an awful lot of price action that you have to know to do that. Okay. Okay. Getting an edge over retail traders, because this is who we're trading against. We're not trading against institutions. We're trading against individual traders. Only take trades that are being driven by institutions. Trade stocks that have relative strength or weakness versus the SPY or the Qs, and trade in the direction of the overall market. Now, it's important to understand that relative strength and relative weakness with the stock and institutions being in a trade, they don't necessarily get into a trade at 10 o'clock in the morning and stay in it all day. It comes and goes, and you have to take that into consideration when you're trading. For swing trade, you're really just interested in the daily chart. But for an intraday trade, you're looking at the 5-minute chart. Those relative strength, relative weakness, institutions involved, institutions not involved, those can change during the day. And it's going to help you make a decision as to when you should get out of the trade. Right? So how does this give us an edge? Again, our trades will be supported by institutional buying or selling. Stocks will be outperforming the SPY or the Qs, and they'll be moving in the direction of the overall market. If you do these three things, you'll be head and shoulders above about 95% of the retail traders in the world. Most retail traders, as you probably know, lose money, and they're just not good at this. They just are not able to maintain discipline and maintain emotional control. Okay, this is a graphic for the SPY super system. We've got one. This would be the one I put on here first. This was basically when we were using the SPY super system for trading the indexes and the futures, but you can also use it for stocks. When I use it for stocks, I call it the Institutional Momentum Stock System, IMSS. The only difference between this SPY super system and this is in this particular case, since you're trading stocks, you have relative strength and relative weakness to use as one of your criteria. You do not have that when you're trading the ETFs, right? The institutions. But when you're trading stocks, you do. So these are the same thing, but this is for no relative strength, relative weakness comparison because you're trading the futures or SPY Qs IWM, trading the indexes. And this one you can trade anything on this. Tesla, Apple, Meta, orange juice. You can trade anything. You can trade anything on here. Anything that you can do relative strength, relative weakness comparison. Okay, so again, the SPY super system is used to trade the SPY Qs and IWM as well as futures. Remember, the SPY super system is the name of the software. It's also the name of the strategy. The institutional momentum stock system is used to trade individual stocks, similar to the SPY super system, but also uses relative strength and relative weakness as one of the criteria. It's really not that complicated. All right, color codes, we talked about this. Green, bullish is strong. Blue, bullish trend. Yellow, bearish strong. Red, bearish strong. Yellow, bearish trend. Okay, those are your 4 colors. And here it is again. We've seen it, already seen this one time. I don't want to take too long. Now, I do want to spend a couple minutes on Heikin-Achi. I had some folks who are interested in Heikin-Achi, so I'm just going to run through this fairly quickly and just kind of show you how to read Heikin-Achi candles. You can put these on any chart that you've got, and they can help you, especially in swing type trades. They can help a lot, but you can use them on 5 minutes as well. All right, so Heikin-Achi candles. All right, this is a chart of the British pound Japanese yen. That, you know, it's forex. It doesn't matter. This could be anything. It could be Tesla. It could be gold. It could be SPY. You know, it could be Meta. It could be anything. This is what the candle structure looks like. These are Heikin-Achi candles. When you change the Heikin-Achi candles on your platform, this is what they're going to look like. The couple of things here to take away from this is really important. Flat top candles. Flat top Heikin-Achi candles are bearish candles. Flat bottomed Heikin-Achi candles are bullish candles. These are Heikin-Achi both bearish. These are Heikin-Achi bearish. Bullish right here, the flat bottoms. Right, and you can see the trend pretty easily in them. They don't get as much noise as you do in a 5-minute chart with these. But something where you typically look for, if, for example, you're assuming that this was like SPY or Tesla or something, and it was coming down, but it was bullish for the day, and you were looking to get into this trade when it reversed back and headed back up again. You're looking for what's called a Heikin-Achi reversal, from a bearish move to a bullish move. Right? You're looking for that, and you're looking for that move to take place somewhere near support. So here's your Heikin-Achi candles coming down. And one thing to notice about these, that they always start halfway down the previous candle. Always start halfway down, because it takes 2 regular candles to make a Heikin-Achi candle. See, going up, halfway up, halfway up, halfway up. Right. So if you were looking to trade this, you'd watch it coming down, and you start seeing wicks and tails, wicks and tails, wicks and tails. There's a flat bottomed Heikin-Achi candle right there. Right. This is a Heikin-Achi reversal candle. Bullish Heikin-Achi reversal candle. But there's something you got to take into consideration. How big were the candles that created the trend? These are pretty big. These are pretty big candles. When you get a Heikin-Achi reversal like that, to me, that's too small. It's not telling me that there's enough force in this yet. Now, if you took it here, it would have worked, because it popped up here for about 5 candles. It would have worked, but I would be waiting for this candle right here. As it goes up, comes down. Now I'm getting in a Heikin-Achi reversal candle with a flat bottom, with a big, big candle. That is offsetting this downtrend. Now we've got a confirmed uptrend on a Heikin-Achi candle. And when you're talking about confirmation, when you take a trade, a lot of times you're looking for confirmation that the pattern has changed or the direction has changed, and you want it confirmed. Usually you have to wait for 2 candles to do that. But with Heikin-Achi, it's built right into the candle itself. Heikin-Achi candles are, by definition, a confirmation of the reversal, or confirmation of the direction. Right, so this is where you would have taken it, right here, and you could have taken it anywhere in this candle. You don't have to wait for the candle to close when you're using Heikin-Achi candles. You get a flat bottom, you just buy it here, and then you just ride this thing up. And then when you start getting wicks and tails and a red candle, this is where you get out of the trade. There's your trade right there. That's a Heikin-Achi reversal candle to the bullish side. All right. If there's any questions, just pop them in there. I'll answer them. All right. So here's what it looks like in a more of a regular chart. Again, you can see the coming down. Again, let's assume that this blue line here is a support resistance level. You're waiting for it to go through, to break through and head back up again, because you're bullish on this stock, but you want it to break through, for example, the VWAP or the 15 EMA. You see how it breaks through it right here on this blue line with a flat bottom? Either that candle or that candle is your entry. Either one of those is your breakthrough resistance, and with a Heikin-Achi candle after a reversal, that's where you take the trade, and you stay right in it all the way up here. Now, as it breaks, your support resistance levels are right here, and it's getting pretty far removed. So when you get this far away, you've got to be watching the trade closely, because you want to take this off. You don't want to give it a chance to head back. So this is where they're marking it to take an exit. I would have taken the exit right here. I wouldn't have waited for this thing to reverse, go all the way back up and reverse, because it could have reversed right here. So this is where I would have taken the trade, only because I had so much profit in the trade at this point, right? I'm not going to give up that kind of profit, right? But there's your Heikin-Ashi trend right there. That's a bullish trend, right? So the things to remember on Heikin-Ashi candles is Heikin-Ashi candles, bullish ones have flat bottoms, bearish ones have flat tops. Okay. Bullish Heikin-Ashi reversals are identified by flat top candles, followed by flat bottomed Heikin-Ashi candles. They don't have to come one right next to the other. You can have dojis in between. And then a bearish Heikin-Ashi reversal, exactly the opposite. You get flat bottom candles, followed by flat top candles. That is a bearish Heikin-Ashi reversal, right? That's how Heikin-Ashi candles can be used in a trend. And some of the big advantages is it smooths out price action. If you've got Heikin-Ashi candles in your chart, you're not going to see as much noise as you do on regular candles. And the regular candles, one of the reasons this helps traders a lot is because those noise on those candlesticks, when you're getting these big whips up down, if you're not actually seeing those because they're not really showing up in your Heikin-Ashi candle, you're not going to be so likely to be emotionally impacted by the candlesticks. If you look at a 5-minute chart with a big red candle or a big yellow candle all by itself, it can cause quite a bit of fear in a trader. If you're using Heikin-Ashi candlesticks, you're not going to notice that unless it happens for at least 2 candles, which is much less likely, right? So again, it smooths out the price action. It makes identifying trends much easier. It improves identifying confirmation of trends or trend reversals, and helps identify potential exits when candle bodies shrink or reversals occur. One thing I will say, I switch over to regular candles when I'm getting ready to get out of a trade, so that I don't have to wait for the 2 candles to confirm the reversal, because I'm going to take profits anyway, and I want to be able to get out as quickly as I can. All right. Now I'm going to show you a couple of charts here. This is a platform I use called TC2000. This is my charting platform that I use, and I do some scanning on this, although we do a lot of scanning in the SPY Super System. This is Uber back in 2023. But what I want you to see here, this is Uber, and I want you to look at May 1st. This is a key date right here. This is Uber as it comes down. You see it comes down and bounces right here on May 1st. This is the May 1st candle right here, right? And you see gap up, gap up. Now, these are regular candlesticks. Now, I'm going to show you these on Heikin-Ashi candles, right? Here's May 1st right here. Notice no gaps, no gaps. Here's a flat bottom reversal. This is a bullish Heikin-Ashi reversal. See the bearish trend right here? Flat bottom candles coming down, wick in the tail, have flat bottomed Heikin-Ashi bullish reversal candle right there. This is where I would enter the trade on May 1st, somewhere in this candle, right? May 1st, somewhere in this candle. And then I would have just rode this thing up until here. Candles get small, I get red, I'm getting out. But you see where on May 1st, let's look where that is on this candle, on here, right here. This is where we would have entered the trade, right here in this. This is the move you would have got by taking that right there, right? So that's pretty impressive, and it's much more difficult to take a trade gapping up like this than it is to take it here. You're going to see it much more clearly. This is what it would be on a daily chart that you're doing there. Okay, so we're going to look at some live Heikin-Ashi reversals. If anybody has any charts they want me to look at, any names of any stocks, I'll look at some current ones. But I'm going to bring up the SPY Super System right now. This is live SPY Super System right here that we traded today. This is on the SPY that's up right now. This is 5-minute candlesticks. I'm going to switch this over to daily, because this is what we're going to be looking for Heikin-Ashi candles on for swing trades. I'm going to switch this over to Heikin-Ashi. All I did was go to daily, and I switched style, and I switched candle type to Heikin-Ashi right there. Right, so these are now Heikin-Ashi candles on a daily basis. Right, so I'm going to look at a couple of trades. Let me see what we got here. I'm going to pop up. I got a little scanner on another screen off the other screen that I can look for some Heikin-Ashi reversals. Let's see. Okay. All right, let me take a look. We'll take a look at Shopify. So here's Shopify on a daily basis. All right. You can see that it's been coming down, and then it starts to compress. Now we get a Heikin-Ashi reversal candle here today, right, with a flat bottom candlestick right here. All right, so looks great. Is this something you would take? But think about something here. Current time frame momentum daily looks great. Institutions buying. Whoa, They are not doing it across multiple time frames. I cannot confirm that the institutions are actually in this trade to stay in this trade because this is still red. If this goes to blue, then I can take it. But you got a Heikin-Ashi reversal candle here, but I can't take the trade based on that. Right? It still looks good. I would definitely have it on a watch list, but it still looks good. Let me see if I can find another one here. How about T-Doc? Is T-Doc right here? Now we've got Teladoc Health right here. Right, so it's been moving up nicely, kind of compressing. This is the 8 and the 15 on the daily chart. Moving right along. See the Heikin-Ashi reversal candle here? Actually, kind of like a continuation, but a Heikin-Ashi reversal with a break out of the box. We got a arrow here, right, to the upside. It's a bullish compression break. And look at our indicators down here, all bullish across the board. This is one that I would be writing down for potential entry tomorrow on T-Doc because it's got everything. It's got everything I want. I'd be looking at the daily chart for additional resistance levels, but that's what I would be using, right? How about Oracle? Oracle's got a Heikin-Ashi reversal candle right here. Not white, doesn't have high volume, but it's a nice candle reversal. That is a potential long. Blue and green, those are both bullish. So Oracle's a potential long for tomorrow as well. Okay, let's see, anything else here? NBIS, let's look at NBIS. Okay, it's NBIS. Bullish Heikin-Ashi reversal candle right there, right? It's been in a pretty good trend. And we do have green and green. Institutions are in here. Momentum's up nice and high. Definitely something you could look at for tomorrow, this NBIS. This is actually a pretty nice setup. I'm actually going to write it down right now for potential for tomorrow. It would have to open green for me to take it, but it definitely is a good setup for what you're looking for here. It's got a yellow candle but that's just because it's closed here below the high. But this is actually a high volume candle. It's really important. All right, and let's see anything else. I talked about Lunar, WNR, when I traded today. Here's Lunar. See that candle today? Heikin-Ashi reversal candle, high volume, coming right off of the institutions buying. They've been selling, buying. They're back to buying again across all time frames. Beautiful setup on Lunar to the long side. Right. This is when it actually traded today. I'll show you here in just a minute. Okay. Google, you want to look at Google? Yep, I don't blame you. Google's been kind of in a rut here lately, but it's been moving sideways. So here's Google on the daily chart. This is looked really good over here. All right. Back on 430. It actually even looked pretty good in here. But now we're back to selling. So right now Google is not a really. I'm actually in this trade. I'm in a Google swing trade because the setup was so nice when I get in it, and I'm riding it because it's staying above the 8 and the 15 on the daily basis. But the 15 is right down here. But I wouldn't recommend getting into it right now until it breaks up above here. And if that does that, these things will probably go green or blue. That's Google. Okay. You're welcome. You're welcome. No problem. That's what Google looks like. All right, and I'll just look at a couple of bearish ones just so we can see. See what I can see for Tyson would be probably a good one here. TSN. Bearish Heikin-Ashi reversal candle right here. Moved up nicely here. Pulling back down again. Breaking to the downside. Beautiful Heikin-Ashi reversal for a bearish trade in Tyson starting tomorrow. Notice yellow, red, red. Very low here on the momentum. Coming down with a high volume bearish candle. TSN. That was one you'd want to note for sure. But tomorrow, it's got to be red before you can take it. It's got to keep going down. Likely would be better if it closed below today's low. Kirby's another one, KEX. Beautiful. Coming down, compresses. Heikin-Ashi reversal candle. Actually, it's a Heikin-Ashi continuation because we're actually already in a reversal. But this is a continuation with a flat top candle right there. Let's see. One other one we'll take is Zillow Group, and then we'll move on. Right, the Zillow Group. Now this is a Heikin-Ashi continuation. See how it comes down with Heikin-Ashi reversal here? moves down along the 8. You see how it's following the 8 down? This is why I say the 8 is very important to have on your charts. Very important to have on your charts. It's a very, very good support resistance level that a lot of times once it's below there, as long as it stays below, you can stay short. But this is a decent, it's not a very big candle, but it's decent as a short for CG. Again, that'd be another one I'd be watching for a short tomorrow. Okay, so that's Fibonacci candles on a daily basis. That's what you look for. All right, so let me just go back to the webinar. I don't want to get out of line here. All right. Now again, on this SPY super system chart, again, I have updated this since November. I added the ADMA, which we just talked about, and I added the high volume candles. These were big deals here, and I did this specifically to take advantage of the UMCAT trade, the out of the money catalyst type trade. All right, so using the SPY super system indicators in conjunction with the high volume candles, find the best entries. So, and this is going to tell us when we have a break, if the institutions are in there, if they are, and if they're coming in with a lot of force, right? Which they are. So here's the SPY super system again. I don't have to keep showing it to you. I just like to make sure everybody's familiar with that. Again, this runs on Thinkorswim. You don't have to trade on Thinkorswim. I trade on Tradier. I just use Thinkorswim to put my SPY super system on to get my indicators, and you can put it on Ninja as well. All right, so here is the strategies that we use. This is the key, what I call a trade funnel setup. And look at the daily chart first if I'm going to have a swing trade or even an all-day trade. If it's going to be an intraday trade that's real quick, I don't look at the daily. But for anything else, I look at the daily. And actually, I do look at the daily even for the 5-minute because I want to see if the stock price right now is close to any support or resistance level on the daily chart, such as the 50, the 100, or the 200 SMA. So we look at the daily chart, and then we go to the 5-minute chart to try to find our best entry for a swing trade, for example. And then we want to trade with the trend, both stock and market. And so if you've got a stock that's moving up on a day when the market's moving up, that's ideal. The context is the stock's bullish and a bullish market. It doesn't happen all the time, but that's what you'd like. And then the SPY super system must align. This is the key. The indicators on the SPY super system, if you're going to go long with a swing bullish, you've got to have the current time frame and the multi-time frame momentum both be bullish. Really important. And both bearish if you're going to go short. Then you look for stock. Maybe you've got 5 or 6 or 8 stocks. Then you look for the ones that have relative strength or relative weakness to the market. Take the best ones, and then try to enter near support or near resistance. And you can set alerts on the support and resistance levels if you want to, so they'll alert you when that happens. Okay, this is the logo for the UMCAT strategy, the out of the money catalyst. Right? Only take out of the money calls and puts in this kind of a setup. The setup has got to be precise, right? Out of the money catalyst right here. Right, these are the results of the UMCAT trades that I did myself. Now these are my results because I can't post these. I do call them out in the room, but I can't post them all. So from November 17th to February 11th, I had 170 wins and 27 losses, 86.2% win rate. You want to watch that because you'll see as we move forward how that is sticky. At a profit factor of 5.21. Last week when I looked at all the trades so far, it's running at 5.11. This is a very high profit factor. If you know what a profit factor is, and if you don't, look it up. Go into one of your AIs and ask about a profit factor of 5 on option trading, and you'll see just exactly how good it is. And for this period of time, from November 17th to February 11th, $17,900 profit on 500 per trade. I'm just using 500 per trade. Most of the time when I'm giving results for the room, I'm estimating that we use 2,000 per trade is what I'm using, basing my results on. 500 per trade, 17.9. All right, so this was going from November 17th through April 3rd, 333 trades. So somebody asked about how frequent are they? Obviously, they're fairly frequent. 333, 286 wins, 47 losses. Again, 86% win rate. Profit factor went up to 6.11. This is going to be almost impossible to try to maintain anything at 6. 6 is really insane. I had some really high winning trades in there, but 6 is very difficult. But then the profits went to 30,256 at 500. Okay, this is just a little graphic of the UMCAT trades. That was the profit from November 17th through May 10th. And again, 86.5% win rate. Profit factor was about 5.5 and 500 per trade. And that's kind of what you get here. You're going to have losing trades. Believe me, there's going to be some. But the way the methodology is set up, they should be fairly small. Yeah, the profit factor, Nick, is really, really high on these things. On the regular trades that I do in the room, I have a profit factor of about 2.8 to 3, which is really still high. But these are insane. And it's because we're trading momentum stocks with out of the money puts and calls. So when you're out of the money, the ROI on one that works is really, really high. And the fact is, if it reverses on you, you're in an UMCAT trade and it starts to compress and you're getting time decay, you got to get out of the trade. You can't stay in them very long. So they either work or you get out. Okay, and this is if you use 2,000 per trade, this is what it would have been through the May 10, 152,000. Probably not realistic for most people, but people ask me that all the time because I use 2,000 as a basis for the ones in the room. Okay, now I'm going to look at some examples of UMCAT trades. I showed you these already, but what I'm going to do is I'm going to go and look at some live ones. Right, so these will be live trades, and I can look over the last couple of days, and I'll go back and bring up the SPY super system right here. All right, so here's a SPY. We're going to be using 5-minute candlesticks. I'm going to go ahead and just use regular candlesticks on these. Okay. Now these are scanners, by the way. This is a cascading up scan. This shows relative strength stocks. This shows relative weakness stocks. This shows bullish swing type trades right here. If I click on these, when I'm running during the day, this is where I find my UMCAT and SPY super system trades from. I just click through them and I see, do they have high volume candles or not? Hood came up a couple times today. I didn't trade this today, but it came up. This was really a pretty nice one from this morning. That's an UMCAT trade right there. See the white candlestick coming off the 8 with a pop out of the box, everything green. That's what you take it right there. Right. So that's these we run through today, and this is how we find some of these. Same thing on the bearish side. Right there, you're looking for high volume candles. See that breakdown? Oops, right there. JBS, ZTS. All right, so let's take a look at some trades today. And I'm going to move the scanner out of the way so we can just kind of focus on this. But I want to focus on some of the ones that I used there. QBTS. QBTS was a pretty nice stock. So here's the 5-minute chart QBTS. Where did I take this? Okay, it's where I took it. This morning right here, it was moving side. If you look at the day today, this was the first candle. It was all over the place. The daily chart was really nice. I didn't take it this early. I waited, and this is where I took it. As it compresses right here, the institutions are buying. I took it right here, right? It was trading about 28.47 or something. This is where I took it, and I rode this thing up, and I think I got out right here. These candles got really tiny. I started to get out, and I get out. I think I actually get out right here, just before I hit this yellow line right here. That was a nice little trade. It was about a 45% profit in about 7 candles on QBTS, right? So that was one that worked pretty nicely today. I'll show you Lunar. Let's go right over here. Okay, so here's Lunar. Where would I take this trade? Take a look at this thing this morning. Just chopped around, you know, it's just chopped around, chopped around, chopped around, chopped around, chopped around. When I see it, this is where I took it, right here. I get this white candle, right on the green candle right off the 8. So I took it here and wrote it up here, and I get out here. And I get out right there. And then it did do a nice pop over here later in the day. But that was that little move right there was good for about 35%. Out of the money options on these things. All right, let's see what else was out there today. Any stocks they want to look at on UMCATs, I'll be happy to, or even SPY super systems, which would be using in the monies. The thing that was really hard to trade today was if you're trying to trade the SPY, because it had so much ups and downs. It kept putting in new highs, but I really couldn't find anywhere that I wanted to trade. Right? You see this it's keeping making new highs, but look at this up and down. You see any high volume candles in there? Hardly any. Hardly any. So this was you could have done this here, but this is late in the day. It's 3:30. So I wouldn't have taken that. So the SPY was difficult to trade today. So I immediately in the room I said, this is not a good day to be trading the indexes, SPYs, Qs, IWM. Focus on stocks that have relative strength and relative weakness. Find something that's got relative strength, relative weakness, and get some consistent movement in it. And if you look at Hood today, Hood was a beautiful setup here today. His hood from this morning. This is where it opened. Right, moved up pretty nicely. He just was waiting for his opportunity to get into this thing. Now I didn't trade it because I didn't see it because I was doing other things, answering questions, etc. But people in the room did take it, and there it is right there, green, coming off the 8 with a high volume candle right there, right? So you got one candle that goes from 81.46 up to about 83.29, about $1.50. You got to take, if you took the 82 or the $83 calls of this, that's good for about 45 or 50% profit on that on Hood. Hood was really, really strong today. Let's see. Let's just randomly look at some stocks. Apple today, not much to trade. Not much to trade. See how it just keeps, no big high volume candles, just chopping around. So it wouldn't be any UMCAT trades on Apple today. This is a big volume, but this happens at the end of the day. You get a lot of volume. All right. And again, if anybody has any stocks they want me to look at, I'd be happy to. As far as this is concerned, Sats had some pretty good movement here today. This was a decent trade, but this is not UMCAT. When you get a trade like this, where you get a stock breaking above the 8 and the 15, and the institutions are coming in, but you got regular candles, you would buy in the money calls on these. You would not buy out of the money calls. Okay. And let's see one other thing. Let's take a look at AMD. Everybody knows AMD. Not much to trade today, except right here and this morning, right here at 11 o'clock. Stock's moving sideways. You get high volume candles here. You move above the 8 with a pop out of the box symbol right there. Institutions are buying it this way, you would take it. AMD went from $513 up here to $525. That's $12 on AMD. And if you took it out of the money call on this one, say it's trading at 510. Let's say you take a 515 call on this, and it ends up trading up to 526. Let me tell you, that is a big, big profit. I didn't take this. I didn't see it this afternoon, but that right there would have been like one of those frog trades. That would have probably had about 200 to 300% profit on an AMD trade on that. All right, so that's what you're looking for. That's what the UMCAT trades look for. Okay. Hopefully that clears it up a little bit. And again, I'd be happy to answer any questions or show any stocks that anybody has an interest in looking at. Okay, let's move along. All right, so we looked at those. Again, what we're looking for is we're looking for institutions in the trade with momentum and high volume. Are they coming into the trade with high volume? That makes it even a better trade than if they're coming in with low volume. It's much more forceful. It gives you much more conviction that the institutions are rolling into that trade. All right, so these are some more charts of this is NVIDIA. This was a 5-minute chart before we actually had the UMCAT setups. As you can see, this is where you take the trade. Went from selling to buying right there, above the 8, to the pop out of the box symbol, you just take it right there. That's your NVIDIA trade on a 5-minute chart. SPY chart right here. Institution selling right there with a pop out of the box symbol to the downside, coming down below the VWAP and the 8, you just write it down. Okay, so I think you kind of get the idea. This will be it's a trader who's trading with the FOMO, jumped into a trade because he didn't want to miss it, and it turned around on him. He wasn't in at support resistance. He got near the top, and he's watching his P&L, and this is what you feel like. And if you've been trading, you probably know this feeling. And this is the feeling you get when you actually have some methodologies and strategies set up that you know are going to work 85% or more of the time, and you maintain discipline, and you just take those trades and you take your losses when you have to. That's it. Okay, this just tells you to please don't focus on your P&L to see if it was a good trade or not. You know, trade is only good if the technicals are set up on it correctly. You can take a trade that's terrible and still make money on it, and that's probably the worst thing that can happen because you're confirming that bad trade is a good trade. Okay, so in an alert service I just want to talk about briefly, it's designed for day trades and short-term swing trades. It's not for investments. It's going to be designed for traders who can't watch the market all day. It's going to come up with real-time alerts, and all the trades that we go out on alerts They're high probability trades that I try to send out before 3:30 in the afternoon. I try to don't send them out after 3:30 because I'm trying to give the alert members time to get into the trade before the market closes. Okay, now this was the performance in the room. Now this is the room performance 2025 based on $2,000 per trade. Right, the win rate was about 83% of show. I'll show you the results, but this was the profits 57.8 of 2,000 per trade. Okay, that's basically what it looks like, and it's pretty much the same every year, based on 2,000 per trade. Here's the results we've had in 2023. Put 2,000 per trade, a little over 60,000. Pretty good. I mean, this is a lot of money for 2,000 per trade. 2024 about 55,000. 2,000 per trade, and 2025 55,000. Stays the same. And in the profitability, a lot of it's going to be dependent on what the market's doing. Trending markets produce much more profits than choppy markets, and so we have to get in and out of trades quicker when it's choppy. We have to take smaller risk on trades when it's choppy. Then when you get it moving, when you get a good trending market, then you can stay in the trades longer and you can take a little bigger risk. All right, so this was January to March of 2026. Just to kind of cover the results that we had. This is pretty much what you're going to see for results. 25, 40, 34, 15, 20. This is the kind of percentage results. This is not the UMCAT trades. No, all of these results are these are posted trades. UMCAT trades, SPY Soup System trades that I call out, but those are my own trades. Those are not included in any of these results. This results is just the ones we posted in the room or sent out alerts. So these are the kind of percentage gains you're going to see. I don't want you to think that you're going to get 200% profit all the time on trades. It's not practical, right? So in January, we had 13 and 2. January through March, 35 and 8. That's only 43 trades. That's a small number of trades. The market was terrible. It was just terrible to try to trade. We did produce $5,800, but not that great. April, this was April. This was a good month in April. Just closed out less than a month ago here, just closing out. Again, we had some nice profits in here. We had this Oxy for 103. That was a strangle. But you know, you got a strangle for 7%. But notice most all winners. The alerted trades were 5 and 1. 2,000 per trade in the alerted room was 32.20. Option trades, we had 17 and 2 in our room. The trading room, 89% win rate. 2,000 invested in each trade, produced 88.33 in April. Pretty good month. Right, so these are I just kind of want you to see that. I've got a lot of results in here, and I'm not going to go through them all because I have an awful lot of them, and I don't want to take too much time for you guys because I know everybody probably wants to call it a day. But this was like May 2026. This is a current month. This is what we've done right now. This is all the trades we've taken this month so far: 10 and 1, 2,000 per trade, netted up 41.90. Right, we had this AA weekly HM that was a loser. But everything else, you can see 25 to 30, 35% most of the time. All right. All right. And again, I'm not going to go through each one of these. Again, these are posted trades. These are not UMCAT trades. The UMCAT trade are amazing numbers, but those are ones that I've taken, and I can't guarantee that's what you'll get. I can tell you how the strategy is. I have a video on exactly how to trade them. I have a video how to trade all of these setups. Exactly how to do it. But again, I can't tell you that that's the results you get on UMCAT trades because they're very quick. Same thing with SPY Super System trades. But again, you can see the win rate here, January, February, March of 2025, on between 80 and 89% every month. Right? This is May. I'm just going to skip through a lot of these. It just I have so many results from all the years that we've been doing this, but I don't want to go through this. This June last year I was on vacation. Only 11 trades, but 91% win rate. In July, we had a huge number of trades in the room. Huge number of trades. 30 wins, 3 losses, 91% win rate. 16,829 last July. A big month. It's not common. Not common. This is more like it. About 6,000, right? Which is still pretty good money for 2,000 per trade. All right, so I'm just going to run through these. I'm not gonna take the whole afternoon to go over these things, but I do want you to understand the results here. This is the kind of percentage, again, this is September 2024. The reason I brought this up here is because this is a losing month I had. The only one since January of 2022. The only losing month. 1786 loss in the room, $295 loss on the alerts. And then I followed this up with October with a $7,000 win, 7,700, I think. All right. Now on the alert service, this is what you're gonna get. You're gonna get this date. You're gonna get the name of the instrument, Nike in this case. You're gonna tell you to buy April 11th, 67 puts. Right. So that is your April 11th is your expiration date. 67 is your strike price. Puts means you're going to be buying puts, which means we're short the trade, and this is how much you should pay for it. 285. You know, it may send 280 to 290, but about 285. That's the whole alert. Then you'll get another alert with a sell order to tell you what to put for sell order in it. Then you'll get a closing trade when we close the trade. Okay, and there could be another one in here if we adjusted the sell order from 9 to 950 or to 850. There'll be another one, but this is what they look like, right? Those will come on your phone. All right, and how do we achieve such stunning results? Again, we follow the process. We only take trades that are trade the best, skip the rest. The institution's got to be in them. We're looking for market internals as well that are heavily bullish or bearish. Things that the whole market is fairly bullish or bearish. And when those are in our favor, we take the trades. All right, and again, how does we do this? I think I've talked about this enough. Triple screen assessment across momentum, trend, and some money flow. Right, and here's some more charts. This is if you get the system. You get a chart that looks like this. You also get one that looks like this with just the current time frame momentum. This is for folks who just want to trade intraday. Right, I trade intraday all the time, but I just keep the big one up there, the one with all of the indicators on it. Now this was a SPY super system Iconite reversal trade here back in 2021, 25. This is where you get into the trade. You see how we went from buying to selling right there. Here's you pop out of the box symbol. It's breaking down. You just ride this trade down. As long as it stayed below that 15 EMA, the red line, you stay in the trade, you stay in the trade, you stay in the trade. That is a long trade right there. SPY super system. I'm not really going to run through this too much. This is when you're trading SPYs, Qs, IWM, and futures. And this is when I first started this a couple of years ago. I was cataloging my results through each month. And again, I have a video on how to do this, but I can't count these as something that you are going to have this kind of results because I can't post them. I can tell you that they're there, and I'll tell you when I'm taking them. But you have to learn these yourself to do this. But they produce some pretty amazing results, pretty high. Again, the profit factor on these are about 4.3 on this SPY super system trades. All right, but again, it's fairly impressive. Again, you're only in one trade at a time, and you're in the short duration trade, so you just got to watch it when you're in these trades. I mean, you can put an OCO, one cancel the other. You can put a stop on the thing up above and below if you want to. All right, so those are SPY super system trades. Here's one right here that we took back right here. You see how this is an old graphic, but this is when the current time frame momentum went bullish. This doesn't exist anymore, and popped right out here with a pop out of the box off the VWAP, moved right up. That's $220 profit per contract on a SPY super system trade. Just trading the SPY. All right, there's another one here. Again, 2 candles in and out. So that's what these things look like. All right, and I think if you've looked at these enough, you're going to be able to see these breaks. You can see it right here, and here's some recent charts. This is a line that we did. We made 51% an hour. This was going to be a swing trade, but we get in here. Notice they went buying and selling. We get in here and we followed it down and we get out right here. 51% an hour. I'm not going to pass up 51% in an hour. Just too good. Too much money to leave on. I don't want to take a risk on taking it overnight. This is a date. This was a swing trade on SMR. We took it right here and wrote it right up. As it notice it went from yellow. This was on earnings. It went from yellow to green. Buying, institutions in it. Nike, we had this. I showed you this Nike one. This was we took it here on the 28th, I think, and we sold it on this gap down. This is when they put the tariffs on. Nike tanked. We had puts on it. The puts went up 216% on this move right here. Pretty unusual. And again, it was lucky because of the tariffs went on and Nike collapsed. Didn't stay down long, you notice. All right, Insurrector was another short that we had. Again, these are swing trades. You notice how the institutions are selling the heck out of this. Just a matter of finding a good entry place. HIMS, this is a swing trade. A long. Notice institutions are all over this. Buy, buy, buy. They're just buying like crazy. You just got to find your spot. All right, so that wraps up what I want to cover here. Again, I don't want to go over too much of the profits and losses. We got so many of them. Can you scan for these volume thrust setups using the compass system? I can't. You may be able to, James. I do it on TC2000, but what I found is when I go over here, because what I'm looking for, I'm not looking for specific. I'm looking for when I look at these tell me I've got multiple candles that are bullish. All right, multiple candles in a row, 5-minute candles. So I want to see what those candles are consisting of. So when I was looking at Hood today, all right, this came out on the scan, and immediately you can see it high volume candles, high volume candles. You can see that when you do that. I'm not, because I don't want you to think just because you have high volume candles, if you don't have high volume candles, just because they're regular volume candles, that you shouldn't take the trade, because you would just take in the money calls on these things if you didn't have the white candles. Right, you would take in the money calls. They work just as good, and I want to know about them here. It's just that I'm going to be taking in the money calls on them. Sometimes I'll even take in the money calls when I've got white candles, depending on what the option chains look like. But I scan for these things in T2000, but I found that just looking from here, most of them always appear out here. I mean, they appear here on this scan because I've got multiple bullish candles, and if they're white, I can see them. Because you can really get too much into the weeds in this, and you got to remember UMCAT is out of the monies, but you don't have to take out of the monies. And if they don't have volume, you don't want to be taken out of the monies. You want to be taking in the monies. But those work just as well as well. I mean, they work great. You're just taking the option's going to cost you a little more. You're in the money, but that also means when you take an in the money option, that means you can stay in the trade longer. Right, you're not going to get shaken out as quickly out of a SPY super system trade where you're in the money calls and puts as you would when you're in an UMCAT trade where you've got out of the money puts and calls. Because when you're using out of the money puts and calls, if the stock starts to compress, goes sideways, all right, you're going to get a lot of time decay. So you really don't want to be in the trade very long when you're getting decayed like that. If you were in the money call and the stock starts to compress, you can just watch your technicals and decide whether you want to stay in or not, because you're not going to get decayed as much. Okay. All right. Let me go back, wrap it up. All right. So again, we've talked about exactly what we use in the room and on the alert service. And again, here's your intraday trades. These things are great. You can have videos of all this, how to do these things. We talk about them in the room all day long. Again, I'm in there all day long from market open to market close, answering questions. People posting stocks that they want me to see, we bring them up. We talk about them on the 5-minute chart. We talk about them on the daily chart. We look at support and resistance levels. We try to do a lot of education. All right. Now here's the offers that they're offering right now. Again, this is for the trading room and text alert service. Got 2 different offers here. One for the trading room and text alerts, and one for the software, the SPY Super System software. This is the text alerts and trading room. Quarterly membership. You get a free 2-week trial and $396 a quarter. Right, that's the text alerts, the trading room. You get all of the trades, all of the videos I've got. I got about 32 videos on these strategies that we use. How to, all of the strategies on the indicators, how to use them, how to use SPY Super System trades, how to use UMCAT trades, how to do put credit spreads, debit spreads, just about weekly ATMs. All of the strategies are defined. And then you also have a Discord chat access. We got a couple of professional traders and a bunch of people in the Discord room. $396 after 2-week free trial. You can quit anytime you want, of course. In the first 2 weeks. Then it's $396 for the quarterly. For the annual, $14.98. This gives you everything we just talked about, right? But you get it for a whole year. And then there's the one-time payment. This is the where you get the alerts and the room forever. Again, so we get text alerts, trading room, all the videos, the Discord room, all for $24.98 for the forever. And that's a pretty cheap deal, a pretty good deal for that. You know, you can come and go as you want. You don't have to be in there. I have a lot of people that join. They can't be in the room all day, but they can be in the room for a couple hours in the morning, a couple hours in the afternoon, and that way they just come and go as they want to. All right, now on the super system, this is on the actual software that we talked about that has the indicators and the scanners that just the ones I just showed you. It looks exactly like mine. They'll put it Rightline will take over your machine and install it on your Thinkorswim. Thinkorswim, you don't have to pay for it. You can just download it. If you don't have it, they'll put it on there, and then they'll go ahead and install the system on there. Again, you get the SPY Super System software, $19.98 for an annual membership. You get a month free in the trading room. You get the scanners, of course, in the trading room. Well, you actually get the scanners on the software. You get the videos, the training videos, and you get it installed and set up by Rightline. It doesn't take very long to do it. It'll look exactly like mine. What they're offering right now, and they've been doing this since Memorial Day, lifetime access. You can buy the software for the same price, $19.98. That's forever. But you can get it forever right now for the same exact price. You get 3 months in the options room when you do that, plus all the other perks that you had over here. The training videos installed by them, and the high-tech the scanner that I showed you is in there as well. I didn't spend a lot of time on the scanner. We've got several other scanners in there that you can use. I didn't go over them all. It takes a while to. Anyway, so there is your SPY Super System. I believe in the chat box, Rory has posted in the chat box the link to go ahead and take both of these offers, either one you want or both of them if you want them all, to go in there and trade this and buy this Super System, $19.98. A really, really good deal for that software because it's unbelievable how much that's going to help you trade. And then the text alert in the options trading room where you can listen to me talk all day if you want to. Ask questions of me all the time. There are a lot of people in there in that room, you know, hundreds of people, and I enjoy it. I mean, I love doing this. I love trading, and I love reading charts. I've been doing it for a long time, and you know, I think you have to really, to do what I do, you really have to love trading, and you have to love reading charts. But you know, I'm not thinking that everybody wants to be a full-time trader. I'm thinking a lot of people just want to be consistently profitable. They want to stop losing money. I think that's pretty important. Okay, thank you very much, everybody. I appreciate it. Nick, I appreciate that. Thank you so much. Appreciate the compliments. And I'm glad everybody could hang out today. I know it was a long day if you were in the Traders Corner. I want to thank Traders Corner so much for hosting me here for this presentation. So thanks very much, everybody. And trade well. Hopefully see you in the room.
All right, thank you, David. Sorry for the delay there. Fantastic presentation, excellent trading insight, and to close out today's event. Apologies for being a bit late. David's link is in the chat box, so check it out. And that concludes today's event. On behalf of Traders Corner, I'd like to sincerely thank all of our presenters for sharing such valuable information and market insights with our audience today. And most importantly, thank you to all of you participating, being valued members of the Traders Corner community. We truly appreciate your support and participation in our events. We hope today's summit helped to provide new ideas, strategies, and perspective for navigating today's markets. Have a wonderful evening, everyone, and we look forward to seeing you again soon at another Traders Corner event. Thank you, everyone.